Is it connected? Am I live? Can you help me with this? Connected, please. Thank you. Okay. Nice. Hello, hi, good afternoon. How many days left for the exams? Anyone from Feb here? आप ऐसे ही मजे ले रहे हो? When is your exam, sir? No, the one right of you. November, okay. Hello, hi, good afternoon. Feb candidates, how many days left? Today we have CFA level 1 results from the previous season. So it's a day with a lot of anxiety and excitement. Hopefully no or low disappointments today. Okay, we have few folks. Vaibhav says exam on 5th of November. Himanshu has 20 days, yes in Feb, 7 Feb, 4 Feb. Very few days, of course, 19th. How is the feeling then? 20 days away from the exams. How long are you going to take this session? It's going to be long. We've total 11, today we are studying Quant. And even though it's a crash course, I like to do it slow. I mean, otherwise I feel I'm not doing justice to your time, which is extremely valuable now. So it is a crash course, but I'll be doing it comprehensively. Everything that I feel is important, both theory as well as calculations, will be covered in today's session. We have total 11 learning modules, and we have lots of calculations today, right? So the easier ones will do them once. The easier calculations will do them once. The slightly challenging ones will do 2 practice questions. So that will take us a little bit of time. I'm estimating, my team is looking at me carefully. Vishal is thinking, मेरे को घर जाना है भाई, दो की ज़रूरत नहीं है. I think about 8 to 9 hours, that's the guess. We'll see. There's always okay, thank you very much, Mohammed. Appreciate your kind words. I need little motivation today, because I was teaching on the weekends full time, and then Sunday night I had to travel, at some work in Bombay. So I just came back. So yeah, some motivation is helpful. Thank you. Sir, can the FEB candidate access Challenger pack? Can a FEB candidate access Challenger? No, not at the moment. It's a work in progress. I think we're doing just some fine tuning and fine print. Okay, there's someone else asking for Challenger pack. You know what? I'll answer that to you in day after tomorrow's session, depending on where we've reached. But you don't need Challenger pack right now. I would not recommend you to do it. Do the mocks. Focus on FinTree mocks. You'll find them very, very useful. Okay, someone is asking, I'm a level 1 student, my attempt is August 26, will this help me? I think so. I think even though I'm doing this session for FEB candidates, most of my audience in the classroom today is August, May. I have some folks in November. You're in May. May this year? Oh, okay. Nice, good. Is 79% mocks and decent? If it's FinTree mocks, that's really good score. I'll do the mock first time today. Good luck, enjoy, have fun. All right, let us start. Can I start Vishal, the mic is not consistent. Is it battery or what? Can I start my prep watching these sessions? I think you can. It's still not capturing the camera. But पहले तो आवाज़ fix कर. थोड़ा आवाज़ बढ़ाओ. It's a little inconsistent. I don't know why. Is something interfering in that radio frequency? Is that thing connected properly? Jai Baba ki, okay. Should we spend money on the CFA mocks? I don't think so, not at level 1, not necessary. If you have access to FinTree ecosystem, we've much more, probably better curated. Please give me a minute. Is it working? This is good. आवाज बरोबर है, okay. All right. Everyone settle down, please. People are still coming in my classroom. We need to still fix the classroom camera, Vishal sir. Students, I understand you can manage to attend on a weekday afternoon. Working folks, I don't. Right? And typical answer I'm getting is work from home, which is kind of scary. That's why my team doesn't get work from home. You still get the work done? Good, glad to know. And you have to say that, and we have cameras here, right? So. I don't like cons. I love cons. I don't know what's your feeling about cons? I'll tell you what, you get hang of the subject, going to be the easiest subject to get through on the exam. And cont is not maths, contrary to what a lot of people think. No, not yet. It's statistics. It's fairly deterministic. You know which subjects are tough at level 1? To me, if you'd ask me which is the toughest one. Ethics. I think ethics is toughest. FSA, no. FSA is pure account. See, anything that's a very deterministic subject. Deterministic means a set of formula, a set of rules, structure, easy. Anything that has a large level of subjectivity becomes a little, because then it's more application oriented, right? More practitioner oriented. That becomes a little tough. I find ethics to be a little challenging. The theory parts in certain readings could be a little tricky. I don't think Quant is that difficult. Quant is the only difficult subject. Okay, fine. We'll see. You tell me at the end of the day. Let's hope to make it a little easy for you. I'll try my best. Gaurav Manja. I'm guessing that's a name, or is this a new meme now? All right. Are we ready? Should we start? Everyone settle down. Are you folks comfortable? Is the AC working? ठीक है, पंखा चालू करना है? ठीक हो? पढ़े? Okay. Let us start. So, what's on the menu today? This is our spread. We have 11 LMs to have fun with. Really love this piece. At least 30 to 40 different variations of calculations today. Okay. Some of them are straightforward, just formula, apply, get done. Some of them are a little deep layer more than that, where you need some conceptual understanding. I'll help you with those sections. Screen now. Sorry, I'm still getting used to this new software. Okay. So these are your 11 LMs. We'll start in the sequence. The best way to study cons is our juice notes. And I know I'm kind of in the self-appreciation mode at the moment, but I genuinely, for two subjects, I feel extremely proud of the juice notes that we produced, fixed income and quant. And do you know why? No, because I made them myself. And I made them on a vacation, and I chose to spend those few days that I had building them. And then I ensured that everything that's there in the CFA curriculum, which is useful for learning and exams, is captured. All the blue boxes that you have, all the examples that you have, I created a replica examples, and I've put them here. So when you do these juice notes, it covers all the theory in an infographic form, but it also covers all the example and practice questions, all right? So now, enough of self-praise, let's start. Reading number 1, rates and return. Again, I'll be highlighting the important pieces for you. We'll make our notes as well, parallelly. By the way, in case if something goes wrong in streaming, we'll stream back on the same link, because my computer is not showing very healthy signs right now. So in case if something goes wrong, we'll come back in the same link. You might have to be a little patient, but I'll continue till the time it's working. Rates and return. Here we go. The first and the two FinTree fruits are about interest rate component. Now, how do you think about them? When you see an interest rate, let's call it YTM of some company, maybe 15%. Okay, so YTM stands for yield to maturity. It's primarily broken down into two parts. A nominal RFR plus the spread for various risk. Okay, now the way you want to learn to think about this is, let's assume a corporate bond, maybe bond issued by HDFC Bank, is yielding you 15%. But in your country, government happens to offer, let's say, 10%. So then obviously any other bond has to give you a return which is slightly higher than the government bond. So that is your compensation for taking variety of different risks. That's 5%. So we say that any interest rate can be broken down into the smaller components, right? So nominal RFR plus spread. Now nominal RFR in turn is made of two components. Help me out, which two? A real risk-free rate of return plus an inflation, you're right, plus an expected level of inflation for a year or whatever tenure. Let's assume a scenario where real RFR is 4%. Real means after removing the impact of inflation, and expected return, let's say, is 6%. Okay, expected inflation is 6%. Now, in the economics class, you would also learn there is actually a small hidden subcomponent here. Okay, and what is that? So, again, for general thought process, when I'm looking at this inflation, should this be inflation of last 1 year or next 1 year? Next one, because I'm getting return for next 1 year, right? Now, right now I think inflation is 6. But do you know for sure that it will be 6? Can it be 5? Can it be 7? Is that a risk? So every time there's a risk, what we want is a compensation for that risk. So there's a small compensation or a spread, okay, for inflation uncertainty. But generally this is so small, generally this has been so small that we don't write it separately. But let's say for this example, we will make this as maybe 5.5% and maybe this as 0.5%. Okay. Now let's go to different type of risk. The first risk, if you're investing into a bond, has to be what? A credit risk. Okay, risk that the company might default. Plus, there might be some other risk. Yes, there might be some liquidity risk. Okay, and whatever the breakdown could depend. Now, there could be some other risk also. For example, you're investing into a bond of a very small company. So maybe there is a risk attached to the size of the business. So we typically call it as a size premium. Okay, generally associated with equities, but can be done with bonds also. If you're getting into a sector which is not popular, maybe there is a risk attached to that. So different component of risk added together eventually creates your expected return. Is this clear? Make sense? Okay. Now, now we have to do HPR, GM and AM. Next concept. Let me just set up our class notes and also save the file in case if something goes wrong. You will easily need about 50 pages today. Just a minute, please. Just trying to save the file. Keyboard shortcuts are not working today. Okay, we'll figure out on the go. Next concept. HPR, AM, GM, HM. Mincerized mean, trimmed mean. Let's work on HPR first. Easy concept. You invest 100 rupees into an asset, it became 105. How much return have you made? How much? But you didn't ask me for what period. You didn't ask me because what if I made this in a day versus I made in a month versus I made in a year? You just didn't ask me that. Because for HPR it doesn't matter, right? Whether it's 1 year, 2 year or 10 years, it's 5. Time period does not matter. That is called holding period return. Okay. Now, a lot of your family members or friends once in a while will come and tell you, say, listen, I bought a property or a real estate 20 years ago and it became 5x in value, or it became, people will tell you stories like these. Now when people will tell you stories that it appreciated so much, became 5x, they're giving you a HPR, correct? Not necessarily how much is what they have earned on an annual basis. Now arithmetic mean. Let's say we have following numbers, 10, 15, 20, another 15. We know what an AM is. Add up the numbers, divide by 4. How much would that be? That will be 15. Okay. But what if you want to calculate a geometric mean? Arithmetic mean is 15, which is just adding the 4 numbers divided by 4. Okay, but how would you do geometric mean? Assuming these are percentage, 1 plus 10% into 1 plus 15% into 1 plus 20% into 1 plus 15%. Since I have 4 values here, under root 4, and we've added 1, so we need to deduct 1. That's your GM formula. Okay, so pick up some speed early in the session. Do this with me. 1.1 into 1.15 into 1.2 into 1.15 equal to 1.74. Now press the under root x button twice. When you do it twice, it will give you under root 4. 1.14 minus 1. So it will give you 14.94%. This is called geometric mean. Geometric mean is the only metric we use when we are dealing with compounding rates or compounding returns. Correct? Whenever you want to figure out at what rate something is compounded, GM is a metric you use. Now, I'm going to spend 1 extra minute here because there's something about GM I want you to learn, which is what? See, I told you there's an asset that has given you these returns. Okay, I asked you for GM. What I really asked you when I asked you for GM is a simple number called a CAGR. CAGR stands for compounded annual growth rate. Okay. Now this you can do on your TVM row also. How will you do it? Please have 100 rupees on your screen. Just type in 100. Say plus 10%. So 100 rupees plus 10% will be 110 plus 15%. So now it's about 126 plus 20%. See what I'm doing? I'm just compounding it. 150? Okay. And plus 15%. 170? 4.57. 174.57. Okay. Now, your 100 rupees have become 174 rupees. Your 100 rupees have become 174 rupees. Let's compute at what rate have you compounded your money. Second clear TVM. 100 negative is present value. Why am I keeping it negative? To avoid error 5. If you keep both PV and FV positive, you will get error 5, right? So 100 negative present value, 174.57 future value. This is happening over how many years? 4 years. So 4 is N, compute IY. That is the meaning of your geometric mean. It's just giving you one rate at which your money has compounded over a period of time instead of 3-4 rates. Notice this one rate at which money is compounding is geometric mean and not arithmetic mean. Arithmetic mean was how much? 15. Also notice that geometric mean is lower than arithmetic mean. Is it okay? Alright. Now here's my first exam question for today. We have 2 data sets. I don't want you to do the math because it's a conceptual question. We have 2 data sets. Let us say a 5, 10 and 15. Okay. Please tell me what should be an AM for this. 10. Arithmetic mean is 10. Let us say 1 and 28. What is an arithmetic mean for them? 10. Now let's assume these are returns that you've earned on some investment. Both of them are giving you arithmetic mean of 10. In which investment do you think you would earn a better return? The one on the left or one on the right? Let me change this question a little bit. Okay, maybe that will help you understand this. First year I'm earning 28, then I'm earning 1, then I'm earning 1. Now tell me in which asset, which let's call it A and B, where do you think I'm earning more money without doing math? How many of you think it's on portfolio A? And why is that? Huh? There is no outlier. Therefore, A is better. You're saying if there is no outlier, you make more money? How many of you think it's portfolio B? Why? Why do you think portfolio B?
There is a risk involved, but then there's a chance also that you might earn more than.
There's a risk involved, but there is a chance. Okay. Now, let's do the fun part. Let's compute GM for both of them. Because GM is the rate at which you've truly made your money, right? So let's figure out what the GM is. You'll enjoy. We'll do the shortcut. You do this with me. Visualize the formula first. 1 plus 5% into 1 plus 10% into 1 plus 15% raised to 1 by 3. Raised to 1 by 3 is nothing but third root. Are you able to keep pace with me? We have to take the third root. Therefore, raised to 1 by 3 minus 1. Okay, so let's do it together. 1.05 into 1.1 into 1.15 equal to. We just multiplied. Now, y raised to x, bracket open, 1 divided by 3, bracket close, equal to minus 1. 9.92 percentage. That's my geometric mean. All right. If I have to do this on the TVM row, super quick, how will I do it? Let's do it together. 100 plus 5% plus 10% plus 15% equal to 132.82. Second clear TVM. 100 negative is your present value. 132.82 is your future value. 3 is n, compute IY. 9.92. With me on this? Now, if this number is more than 9.92, then B is better. If this number is less than 9.92, then A is better. There's a learning here. Okay. Let's do the second one. 100 plus 28 percentage plus 1 percentage plus 1 percentage equal to 130.57. Just by looking at the amount, what do you think? You're going to earn a little bit lesser. Okay, let's compute second clear TVM. 100 negative present value, 130.57 future value, 3n compute IY. 9.29. So, see now, how confusing can this be? Arithmetic mean is same, but geometric mean is sizable difference. There's a difference of almost 60 odd basis points. Right, about 63 basis point or 0.63. That's a huge difference when it compounds over a long period of time. What do we learn from this? What we learn is, and very testable on your exams, is we might have same arithmetic mean for two data sets, but the one with higher volatility will typically result in lower geometric mean. So what we had is, we had a higher volatility for data set B, therefore it resulted into a lower geometric mean. If I were writing questions for you, I would like to put something here. Now, why is this relevant? Because imagine two different fund managers. Okay. Now, if fund manager B is smart, and when they are presenting their returns to the shareholder, they should not show GM, they will show AM. Right? And they will say, you know what, I'm as good as A, but actually that's not true. Even though arithmetic mean is same, geometric means are sizably different. Now, connecting this to your ethics, CFA Institute has provided a guidelines on when you show returns to your shareholders, or not shareholders, but investors, you follow certain rules. What are those rules called? Or what are those guidelines called? GIPS. You know? Under GIPS, AM display to the client will be prohibited, because of course they know that this is affected by these parameters. Now, one more theory question, again highly testable, and this is, my guess is this is the flavor of your exam. Okay, it's going to be fairly conceptual. I have two data sets. 28, 1 and 1. These are the returns. 1, 1 and 28. Which one will have higher GM? Now say understand, in the first one, I have earned 28% upfront. Then I'm earning 1 and 1. Let's call it portfolio A. Second one, I'm earning 1, 1, then 28. Which one will give me higher returns? A? How many of you think A? Okay. How many of you think it's B? Okay. The answer is, they are same. Think of maths formula, 1 plus 28% into 1 plus 1% into 1 plus 1%, third root minus 1. Think of this formula, 1 plus 1% into 1 plus 1% into 1 plus 28%, third root minus 1. Tell me, A into B into C, is it not same as C into B into A? Yes. So the sequence here does not matter. This is what they would test on the exam, right? The conceptual depth, these small things. We'll cover as many as we can today. Did you enjoy this? Clear? Can we move on? Okay. Harmonic mean. Now, remember this. When do you use harmonic mean? What is the right time, right place to use harmonic mean? Whenever you're dealing with average of some of, help me, ratios. Okay, an example could be, let's say a P ratio, which is price divided by EPS. When I want to take an average of P, a correct average would be harmonic mean. Let's do an example. Let's assume in your portfolio, you have 3 stocks, A, B and C. The price of the stock is 100 rupees, 100 rupees and 100 rupees. The EPS of the stock is 5 rupees, 10 rupees, 20 rupees. Please calculate a PE ratio first. Help me out. What is the PE ratio of the first stock? How do you calculate a PE ratio? Price divided by EPS, 20. How about second one? 10. How about third one? 5. So we have 20, 10 and 5. Okay. Now, let us calculate a harmonic mean of this. How do you calculate an harmonic mean? And let's also calculate an arithmetic mean. Okay, help me out with arithmetic mean. 20 plus 10 plus 5. 11.66. Okay. Now, let's calculate an harmonic mean. How do you calculate an harmonic mean? If anyone knows. Correct. So here it will be what? It will be 3 divided by 1 by 20 plus 1 by 10 plus 1 by 5. Alright, quickly do the math. Tell me how much is that? 8.57. 3 divided by 1 by 20 plus 1 by 10 plus 1 by 5, 8.57. Everyone okay with computation? Okay. Now, logically, which of the two numbers is correct? How do you know? Because it's a ratio. Logically, which one of the two is an average P ratio of my portfolio? Is it harmonic or is it arithmetic? How do I know? How can I verify? I can verify. I'll tell you how. What is the EPS of the entire portfolio? पूरे portfolio का EPS कितना है? What is the EPS of the whole portfolio? 5 plus 10 plus 20. Help me out. How much? 35. What is the price of the whole portfolio? 300. So price of the whole portfolio is 300. EPS is 35. What is the P ratio of whole portfolio? 300 divided by 35. 8.57, which is what? Which is your harmonic mean. Is that okay? Now, would you be able to handle this on the exam? Okay. Because you would be able to handle this, this is not the question I'll give you on the exam. Here's the question I will give you on the exam. I think by the time you finish the session, you're glad I'm not setting paper for you. We have 3 stocks. Okay. A, B, and C. The price of the stock, 100 rupees, 200 rupees, and 700 rupees. EPS of the stock, 10 rupees, 40 rupees, 140 rupees. Now, let's compute a P ratio for each one of them. Tell me, P ratio of the first one, 10. P ratio for the second one, 5. P ratio for this one, 5. Okay. Now, I ask you what is the P ratio of the portfolio. You will tell me, Utkarsh, we've just studied this. We have to do what? Harmonic mean, right? So let's do an harmonic mean then. How would we do harmonic mean? 3 divided by, tell me. 1 by 10. 1 by 5 plus 1 by 5. Okay. So please do the math. Tell me what is the harmonic mean here. How much? 5.26. Is this the P ratio of your portfolio? Yes? Confident? Okay, let's check. Calculated? It's telling? Okay, fair enough. Let's calculate price. 100 plus 200 plus 700. How much is that? 1,000. Let's calculate the total EPS of the portfolio. 190. Please calculate 190 divided by 1,000. 5 point? Really, it's matching? Okay. Wait a minute then. Let me just alter numbers a little bit. I have to create a larger gap. Keep the EPS of this stock as 700, please. My apologies. Let's see if we can create a slightly differentiated example. Sorry, I'm making you do double work. This is 1,000. Now what is the total EPS? 750. Okay. Please calculate so 3 divided by 1 by kitna hai? 10 plus 1 by 5 plus 1 by 1. How much is this coming to? 1.33. Okay. Let us calculate EPS of the portfolio now. 1,000 divided by 750. How much is that? You know what? Fine. This is going to work. So you're glad I'm setting the paper then. Okay. Fair enough. I'll move on to next question. Next question. Trimmed mean and Winsorized mean. We have to do a little bit of theory here. See now, let's assume you're dealing with percentage returns on a strategy. Okay, and the returns are like this. 2,000%, 10%, 7%, 5%, 1%, 10%, 9%. How many values? 1, 2, 3, 4, 5, 6, 7. Okay. Maybe we should have one more. Let's say another minus 2%. Now, if I were to calculate an arithmetic mean for this, do you see there is a problem here? What is the problem? Outlier. What is an outlier here? This one, right? Now, this one number is going to completely distort the true data. Yes or no? And there will always be outliers in real life. Okay? For example, one particular outlier you would always see in financial markets. I'll give you a live demonstration. you'd always see some stocks, okay, which will have some really insane metrics. For example, now I'm going to write a screen where I'm going to say price to earning is greater than 1000. Okay, and we have 29 stocks like those. Okay, so let's take some bigger ones. Let's take Eternal. Eternal has a price to earning ratio of 1498. Now, some early entry stage investor or some beginners in the market will look at this number, they'll be scared. Okay, they'll be like, oh, that means if every year Eternal earns 1 rupee, I'm paying them a valuation of about 1500 rupees. That means it will take 1500 years to recover the money. मतलब अगले 15 generation के लिए investment चल रहा है. You know, but it's not like that. It's basically that the company is transiting from loss to profit. So when you transit from loss to profit, in the first year your profits are very small, right? But the markets have already anticipated future profit growth. Now, the problem with stories like these is, let me take Sapphire Foods for example. Okay, these guys run Pizza Hut and KFC in India with a PE ratio of 3,300. Now, if I go to peer group and look at their PE ratios, okay, look at this, it's going to look absurd. If I look at their price to sales, I have two outliers maybe. Which two? This Travel Food. Travel Food are those folks which have restaurants in airports. Okay, and this Spice Lounge Food, which also looks like a lounge, I guess. Look at this. Would you say these are outliers on price to sales also? 13.84 as well as 8.97. So how do I deal with these outliers in practice? Okay. The way to deal with these okay, you know what? You guys were making mistake with harmonic mean. Okay, I'll come back to harmonic mean. I'll come back to that in a bit. Let me just finish that. How do you deal with these outliers? You have two options. Okay, there is one option which is called Winsorized, I don't know how to spell it, it's Winsorized mean. What you do in Winsorized mean is, you take the outlier value and you say, you know what, that's too much, I'm not going to use it. I'm going to replace this outlier value with the nearest value. Nearest value is what? 10%. So this 2000 would be replaced with 10% and then we use. And then my arithmetic mean would be 10 plus 10 plus whatever that is, plus 9 or minus 2 divided by number of observation n. Okay? Did you understand? मतलब वो उसको फेंक ही दो. Just remove that and replace that with the closest value. An alternate option you have is you do something called as a trimmed mean. Trim literally means trimming. So what you trim? So you trim maybe the extreme value on the top, one value at the top, then you have to trim one value at the bottom. Now either it could be just one value trimming, or it could be 5% of the values you throw out, or 2% of the values, you decide, right? But you trim out the extreme values and then you do your arithmetic mean. So 10 plus 7 plus 5 plus 1 plus 10 plus 9 divided by 1, 2, 3, 4, 5, 6 divided by 6. That's called trim mean. Now, if you have a smaller sample, tell me which one will you like to use, Winsorized or trimmed? Winsorized, because you already have a small sample. But if you have a larger sample, then maybe a trimmed mean is a more logical way to deal with this. Okay. Coming back to the harmonic mean example, I want to cross-check if this is actually coming out to be true. Can you please help me with this? 3 divided by 1 by 10 plus 1 by 5 plus 1 by 1. It is different, no? Can we all solve this together, please? And next time if you're giving me a number, please be super careful with that. 10 inverse STO1. There's an inverse button on the calculator, 1 by x. 10 inverse STO1. 5 inverse STO2, 1 inverse STO3. 3 divided by, bracket open, RCL1 plus RCL2 plus RCL3, bracket close, equal to. How much are you getting? 2.30. Is it matching? No, that's the point I was trying to prove. Okay. So you don't want me to be a question writer after all. Okay. Why is this not matching? I'll tell you. Did it match in the previous example? Yes? It matched here, no? But it's not matching in this example. Why is that? Look at the difference. No. There's a difference somewhere here, okay? Look at this example. I took total of price, total of EPS, P ratio of the portfolio matched with harmonic mean in this example. I did exactly the same here, it's not matching. Total of price, total of EPS, 1.33, but harmonic mean is 2.30. What is the difference between a blue box example and this, let's call it yellow example? What's the difference between the two? Correct. Correct. The price is same here. So when the price is same, that means the weight is same. Okay, so a direct harmonic mean will work. Here, the price was different. Therefore, the weight was different. Therefore, a direct harmonic mean will not work. So then what will work? Anyone, what will work? A geometric mean? No. What will work here is a weighted harmonic mean. Okay. How do you calculate a weighted harmonic mean? I'll show you. Everyone please look at the screen carefully. See, prices are 100, 200 and 700. Okay. 100 means what percentage? 10%. 200 means 20. 700 means 70. These are the weights. Alright. Now, when I did regular harmonic mean, I did 3 divided by these values. I assigned equal weight to each one of them. Okay. What is that? Do you know what it is as 3? That 3 is nothing but, okay, if you would allow me to do it, it's actually 1 in the numerator. And each of these values are multiplied with 33.33%. Okay, this is multiplied with 33.33%, 33.33%. Because I am multiplying everything with 33.33%, I can take 33.33% common. And 1 divided by 33.33% is how much? 3. That's why the 3 in the numerator. So when I have 5 values, what would be numerator? 5. Why? Because in the denominator, weight of every value will be 20%. So 1 divided by 20% is how much? 5. But in this example, okay, the weights are not same. In the previous example, weights were same. Okay, so then how do you deal with it? So you say, I will put 1 in the numerator. And then, for this one, I will assign a weight of 10% into 1 by 10. Second one, I will assign a weight of 20% into 1 by 5. And the third one, I will assign a weight of 70% into 1 by, what was the P ratio here? 1. Okay, I'll help you with this. These numbers are already there in your memory slot, right? Let's do it one more time. Please have 10 on your screen. Please have 10 on your screen. Press inverse. That's 1 by 10. You know? Multiply that with 10% now. STO1. Please have 5 on your screen. Inverse. Multiply with 20% equal to STO2. Now please have 1 on your screen. We don't need to take an inverse here. Multiply with 70% STO3. 1 divided by, bracket open, 1 divided by, bracket open, RCL1 plus RCL2 plus RCL3, bracket close, equal to. Now it's matching? Okay. Because there was a little confusion here, so I'm going to give you a summary metric so that you don't feel confused. Okay? It's not that difficult. See, if I have two portfolios where each portfolio has 500 rupees of price, okay, let's have 4 stocks, and the P ratio is 2, and then 8, and then maybe 10, and then maybe let's say 4, okay, versus I have another portfolio here where the price is 100 rupees, 200 rupees, 300 rupees and 400 rupees, and the P ratio is 2, 8, 10 and 4. The example on the left here, the weights are same. How much is the weight for each asset here? 20%. But example on the right, weights are different. Okay, what are the weights? 10%, 20%, 30% and 40%. If the weights are same, it's okay to use 4 divided by 1 by 2 plus 1 by 8 plus 1 by 10 plus 1 by 4 formula. This will work. But when the weights are different, if I were to do 4 divided by 1 by 2 plus 1 by 8 plus 1 by 10 plus 1 by 4, this will not work. Have you understood why will it not work? Yes or no? So the reason why this will not work is because the weights are different. So what is the correct way to do here? The correct way to do it is the numerator will become 1. And then the first asset will get a weight of 10%. So 10% into 1 by 2 plus 20% into 1 by 8 plus 30% into 1 by 10 and finally plus 40% into 1 by 4. This is called a simple harmonic mean. A simple harmonic mean. This is called a weighted harmonic mean. On the exam, I think the question will not be on calculation, but more on the concept understanding here. Hanji.
So it should be 25% on the left side.
What is 25%? Yeah, my apologies. You're right. This is 25%. 4 assets, so 25% each. Thank you for correcting me. Okay. Okay, now Hemansh is asking why to even use weighted harmonic mean if I can find it directly by taking the total. That is true, you can do that. But what if the question is not on calculation, but the question is on a theory statement? That if I am computing a P ratio of my portfolio, which of the following is an appropriate mean? Option A, a weighted arithmetic mean. Option B, harmonic mean. Option C, weighted harmonic mean. Which one? Weighted harmonic mean, right? So that's why we're just learning the concept, not necessarily this is the exact way we have to do it. Okay, is everyone clear with the 3 means? AM, GM and HM. The nuance we remember is GM is affected by volatility, higher volatility, lower GM, keeping AM constant. Okay? Harmonic mean is useful when we are dealing with ratios. 2 scenario, are the weights same, are the weights different? If the weights are same, we use simple harmonic mean. If the weights are different, we can use weighted harmonic mean. Okay. Then Winsorized mean, we replace largest value with the nearest outlier value with the nearest value. That could be 1, that can be 10, depends. In a trimmed mean, we trim some percentage of data at the top, some percentage of data at the bottom. Someone on YouTube chat box asked, what if we have 2 outliers? Sure, if you have 2 outliers, then for example, if this was 2000 and this was 5000, replace both of these with the nearest value 7. You could always do it. Remember, if you have too many outliers in your data set, then maybe your data set mean is an outlier itself. Maybe the smaller numbers are outliers, not the larger numbers, right? So it's always contextual. All right. No doubt, sorry. I need to maintain certain speed today. Next concept, TWRR and MWRR. Again, lot of very, very juicy area. I'll put my money on this. Give it a 3-star. Maybe a 5-star. Okay, especially MWRR is extremely, extremely useful. Can anyone tell me how TWRR is computed? It's a geometric mean of various holding period returns. How is MWRR computed? It's a simple internal rate of return. Okay. Now, if you are connecting what we learned in the previous session of the crash course with today, if you have a open-end fund manager, okay, an open-end fund manager, which mean do you think is more appropriate for them? Which method? TWRR or MWRR? TWRR. An open-end fund manager, mutual fund manager. This is exactly what CFA Institute proposes under JIPS. But if you have a closed-end fund manager, then appropriate return for them would be MWRR. Now, you should ask why. Okay, and I'll tell you why. Because an open-end fund manager can select stocks, okay, but generally cannot select timing. Matlab? What do you mean by that? Timing of the cash flows. Who decides timing of the cash flows? The investor. Now, if I do SIP and if I give that fund manager money every 5th of month, that fund manager doesn't have a choice but to take that money and invest, right? So there's a very limited flexibility in terms of timing the market. Of course, they can sit on some cash, but there's a limit to it. Whereas a closed-end fund manager, once they have your money, there is no redemption or subscription coming in. They're not forced to buy because of you. They're not forced to sell because of you. So it gives them a substantially more flexibility to enter and exit. Which means, for any investor, the money to be made with two sources. Okay? What are the two sources of making money? One is you select really high quality stocks and hopefully your stock selection is superior. Plus second, you try to time the market. Right? Warren Buffett has done both. If you see over a period of last 50, 60 years, there have been times when Warren Buffett has been sitting on large amount of cash, like how they are sitting on cash today. Which means you will sit on cash and because you feel markets are overvalued, and when the markets fall, then you will deploy your cash. That's called timing the market. And then the stocks that you select, so you select Apple or you select whatever stocks you feel are appropriate, that's called selecting the security. So those investors who can do one, which means these investors can select stock, appropriate return for them is TWRR. They are not allowed to typically time the market. But those investors who can do both means select the stock as well as time the market, for them appropriate return is MWRR. Okay? Now you would say, why are some investors not allowed to time the market? Because of mandates. What is a mandate? So I worked with one such client in the past. They had a very simple rule. At any point of time, 100% of the money has to be deployed in equities no matter what. That was their rule, right? Now, if 100% of the money is to be deployed in equities, then as a someone who is advising them or as a fund manager, you have very limited flexibility in terms of if you feel markets are overvalued, you don't have a choice. You have to remain invested. The only thing you can do is maybe move your money to different cadre of stocks or cadre of stocks. But some investors will say, you know what, you take the call. If you feel markets are overvalued, okay, sell the stock, sit on cash. When the markets will fall, you buy. Now those investors can time the market and those investors can also select the stocks. The first category of investor, which return? TWRR. The second category of investors who can do both, which return? MWRR. Convinced? Okay. Now how to do the math? Here's a comprehensive example. Let's say there is a stock trading at 100 rupees. Then it goes up to 120 rupees, gives you a dividend of 3 rupees. Then the stock price falls down to 70 rupees, gives you no dividend. And then the stock price goes to 140 rupees. This is time 0, this is time 1, this is time 2. I like to add a little dividend at time 3, let's say 5 rupees, and let's say this is time 3. Now on the exam they'll give you data like this, and then they will ask you, please compute MWRR and TWRR. Of course the data will not be given in a graph, but in a paragraph. Okay. Now I'm going to give you a very neat technique, and once you get hold of it, you don't need to memorize formula, you don't need anything else. Okay, the technique is like this. You create the first investor, okay, and let's call this guy as a buy and hold lazy investor. A buy and hold lazy investor, like whom? Like the famous Pulak Prasad. Does anyone know who Pulak Prasad is? He's the fund manager for a very famous legendary fund called Nalanda. He sits out of Singapore, and he buys stock with an intention of never selling them. So some of the stocks in his portfolio are sitting for last 15, 20 years. And they would sell very, very rarely. There's a fantastic book also by him, which is called What I Learned About Investing Through Darwinism. Now, what Pulak Prasad will do, Pulak Prasad will buy one stock and then he would just chill, not do anything else. When you calculate return like that, for this type of investor, that would automatically become TWRR. Okay? Now, how would you calculate return? So it's like this. See, if when 100 rupees become 107, how much is your return? 7%, right? How do we calculate that? 107 divided by 100 minus 1. You agree with this concept, right? Closing value divided by opening value minus 1. So we do the same. What would be written here? 123 divided by 100 minus 1. Okay, that's my first holding period return. What is the second holding period return? 70 divided by 123. 120? Yes. Because it's that 120 rupee stock that has become 70. 3 you took in your bank account. Correct? So this minus 1. This is my holding period return. And finally, the last one, 145 divided by 100, sorry, not 100, divided by 70. 70 minus 1. This is my third holding period return. We calculate HPR1, okay, we calculate HPR2, and we calculate HPR3. Now these three HPR, we have to take geometric mean. Which means, what will be my formula? My formula will be 1 plus HPR1, okay, multiplied with 1 plus HPR2, multiplied with 1 plus HPR3. है ना? ऐसे होगा? And then it will be which root? We have 3 returns, so it will be third root. It's nothing but your simple geometric mean और कुछ भी नहीं है. Now don't write, just listen to me carefully. In the formula of computing HPR, we have to reduce or deduct that 1. You know, because it's a little bit like 100 rupees becoming 107 rupees. So when I do 107 by 100, it gives me 1.07. That formula tells me 1 rupee will become how much? 1.07. When I deduct 1, it gives me 7%. Yes? Now when I'm computing geometric mean, do you notice I'm adding 1 again? So towards 7%, I'm making it 1 plus 7%. So we can build a very elegant shortcut here. Why deduct 1, compute return and then add 1? A very elegant shortcut simply is just do 123 divided by 100. Finish. Because 123 divided by 100 minus 1 is how much? 23%. Then in this formula, when I add 1 plus 23%, what will I get? 1.23. This is anyways 1.23, right? So I will simply do 123 divided by 100 multiplied with 70 divided by 120 multiplied with 140 divided by 70. 3 years, so under root 3 minus 1, done. That's it. Let's do it together. 123 divided by 100 into 70 divided by 120 into 145 divided by 70 equal to, what number are you getting? 1.48. Now, we want to take third root of this. So y raised to x, bracket open, 1 divided by 3, bracket close, equal to minus 1. So no yawning, please. Minus 1. 14.1. That is my TWRR. What do you guys think? Easy? Now, on the exam, if this question were to come and if I were writing level 1 exam, I will actually not do this. Depending on how much time I have, but I'll probably not do this. I'll tell you what I'll do. I'll think a little bit like Bania. Okay, and what is my Bania Buddhi telling me? I invested 100 rupees into a stock. First year, it gave me 3 rupees. Second year, it gave me nothing. Third year, it gave me 5 rupees. Plus my 100 rupees became 140 rupees. Correct? Now, I'm going to ignore a little time value of money, but what my simple Bania Buddhi is telling me is 100 rupees has become 140 rupees plus 3 plus 5. How much is that? 148. Maybe a little bit more because I received 3 earlier, but this happened over how many years? 3 years. Okay, so if this were to come on the exam, I will orally calculate that 148. And then I will simply do TVM row. Do this. Second clear TVM. 100 negative present value. 148 future value. 3 is N. Compute IY. 13.96. This will give you a fairly solid approximation of 13.96. Actual answer will be a little bit more than the approximation, not less. Why will it be more than the approximation? Because time value of money on that, 3 rupees which I received earlier. So if I were rushed on the exam, I'll quickly compute that, okay, I'll search for answer around 14, take on it, move on. Because I don't think the options will be too close. Did you understand this logic? Okay. So TWRR is out of our way. Now let's compute MWRR, for which you think of a new investor. Who's a good investor like this? I think our India's Warren Buffett. Let's take his picture. Okay, now what was special with him as an investor, and many other famous investors that you know would probably follow what he proposed, which is this. Some of you might have heard of Vijay Kedia also. In one conference, he said, at times he would study and observe a stock for 7 to 8 years before he makes his purchase. Okay, not because it takes 7 to 8 years to study, because it takes 7 or 8 years for market to give you opportunity to buy big at attractive valuations. So now, imagine you are in this genre of investor who are much more active, okay, in their orientation, or let's say more aggressive with their orientation. Now what would you do? What would you do is, when the stock is 100 rupee, you will buy one stock. Okay? When the stock is going 120, you would say, you know what, good momentum, let me buy one more stock. When stock went to 70 and you're confident about the business, now you're already sitting on the stock for 2 years, you know how that business works, great opportunity. Let's buy 50 stocks. This is called backing up the truck, right? So you get a fantastic opportunity, you're confident about the business, and then when it goes to 140, then you sell all. Who do you think is going to make more money? Second investor, right? Now what second investor is doing is they're selecting the stock, which first investor also did. But what second investor is also doing is timing the market. They're timing it. When they thought that gir gaya to main, I will buy big. Now for these type of investors, the return metric that is appropriate is MWRR. If you compute TWRR, that would only reflect their stock picking skill. It will not reflect their timing skill. Okay? So how would you do it? So let's do it together. You would set time. Time 0, time 1, time 2, time 3. Stock price. Okay, stock price is what? 100 rupees. Then 120 rupees, 70 rupees, and 140 rupees. Okay, then okay, dividend. Dividend that I'm getting is 3 rupees, not here, not 3 rupees here, right? 3 rupees here. Okay, my keyboard is working now. Nice. क्या तारीख है आज? Thank you. Dividend of 3 rupees and dividend of 0 and dividend of 5 rupees. Okay. And what is my action? My action is I will buy one. Here I will buy one. Here I'm going to buy 50 stocks. And here I'm going to sell all the stocks. Yeah, sorry, getting my screen fixed. Just a minute. Okay. So again, sorry, apologies YouTube, it should be visible now. Time 0, 1, 2, 3, price 100, 120, 70, 140, dividend of 305, and action buy one, sell 50 and sell all. Now let's compute inflow and outflow. Let's do outflow first. Okay, outflow means how much is money going out. Then at time 0, you tell me how much is the money that's going out? 100. At time 1, how much is money going out? 120. Inflow will compute separately. Outflow is 120. At time 2, how much? 70 rupees, 50 quantity. 3500. I'm ignoring the dividend for the timing. And finally, at time 3, outflow is 0. Okay. Let's compute inflows now. At time 0, do I have any inflow? No. At time 1, do I have any inflow? Yes. How much? 3 into 1 is equal to 3. I have one stock, so I will get 3 rupees of dividend. Okay. At time 2, no dividend. So technically no inflow. At time 3, dividend is 5 rupees per share. How many stocks do I have now? 1, 2, 50. I have 52 stocks. How much is that dividend? 260. Plus, I'm going to sell all my stocks at 140 rupees. So 140 rupees into 52 is how much? 7280. So total is how much? 7280 plus 260? 7540. Okay. And finally, the most important column, net cash flow. Okay. So year 1, net cash flow is total of A plus B. So please help me do the math. Year 1 is how much? Minus 100. Year 2 would be how much? Minus 117. Year 3, minus 3500. And year 4, 7540. Is everyone with me? Is this making sense? Now, all that I need to do now after this is take these numbers, put them in my cash flow function, and compute an IRR. Okay? So your cash flow 0 is negative 100. Cash flow 1 is negative 117. Be careful with signs. Cash flow 2 is negative 3500. And cash flow 3 is 7540. Please plug them in the cash flow function and give me the IRR number. 85.63. It's really crazy how two different investors on the same stock can have significantly different outcome. Right? And what is the difference layer of skill here? First skill is what? Selecting the stock. But second skill is what? Timing the market. Right? And of course, it's not relevant, but that's why I keep on shouting 24/7. Maybe I should get tattooed on myself. The money is made in buying, not selling. And you want to buy something, an asset. You don't make money by buying great stocks. You make money by buying great assets. And great assets are one that you get to buy at a reasonable to lower valuation, cheaper valuation. So that's something that you feel is 500. If you can buy it at 400, okay, but there is no margin of safety. Right? But something that you feel is worth 500, if you can buy it at 200, 250, then you're creating a little bit of margin of safety. But those deals are not always available in the market, which means it's an extremely patient game. But when you have a deal like that in front of you, then you pounce on it. Right? And that's a skill some of these large investors have developed. Okay. We'll stop for a small break. Is the speed okay for you? Good. First two readings has a lot of this small calculation. Then we'll be able to pick up a little bit of speed later on. It'll be a... How much time do you want? Okay, 20-minute break. Vishal, this camera is still not working. Now my camera is gone. Why aren't we making an app? We don't see a point, because the app that we saw were type of apps called wrapper apps, which will just look like an app, but it will behave like a browser. Will have the same features that the system has right now. So we want to build an app, but then want to have a lot more functionalities on it. Oh, yeah. So those are the features a wrapper app will not provide. For that, we'll have to build a very different system. So you basically want a feature of offline videos, huh? Okay. Fine. Camera seems okay. Everything seems okay. It's stuck though. My camera is stuck. No, it's not. It's not. Sorry. Maybe I just speak very slow. Struggle is real. Very smart marketing on the chat box. Someone came and said, believe it or not, if you're here after watching, let me explain channel content and come back here and watch this. You're never ever going to forget anything. Okay. Nice, very smart. How is the Whoop brand? I mean, it's okay. It's any other fitness tracker. It's just a little fancy, I guess. Better sampling rate. Yeah, I honestly don't know. I don't even know if I use it. I mean, since the time I bought it, every day in the morning I open it, it tells me you haven't slept enough. It just makes you feel even even bad. I think I was better off without it. Okay. All right, ready? We sent you a survey towards the end of last year, beginning of this year, on what features you would like us to work on. How many of you participated in that feedback? Okay. If you have something to say, write it there, because we actually read, and we will be working on some of the important features that we feel will make difference this year. Of course, there are some features we've already started implementing. One is getting industry folks to come and talk to you. Right? So that's one area where this year we want to do a lot of work. Internally, we're targeting at least 12 folks from 12 different spheres, including some of the very famous celebrity fund managers, venture capital folks. But yes, if there is anything else you want us to work on, I'll get my team to send the feedback again. So please fill that in. All right, let us start. FF10, which is your non-annual compounding rate. Okay, I'm just going to do one example, which is on conversion. Let's say if I give you a rate which is 10% per annum compounded monthly, okay, and then I ask you to convert that rate to some rate which is compounded per week, okay, and some rate which is compounded per day. That means just converting frequency, compounding per day, and maybe the same rate you can compound, let us say compound on a semi-annual basis, and the same rate you can compound on a quarterly basis. How do you convert these rates? And let us say the same rate you compound on an annual basis. Compounded annually. Okay. So this is called your interest rate compounding frequency conversion. Now I'm just going to do one example. It's easy, but those of you who don't know it, I think it's a good time to work on it. There is a very beautiful function in your calculator called the I conversion function that you can access by pressing second and then you press 2. When you press second and 2 on your screen, it shows you nominal. Nominal is always a rate that's given to you. By the way, this nominal and nominal that of the session, nominal that we just saw at the beginning of the session are used in slightly different context. Here in I conversion function, any rate is nominal rate. Okay, so we're starting with 10% per annum compounded monthly. So in your nominal, you have to enter 10. All right. Now, not 10 percentage, just 10. Hit the enter button. Then go and hit C by Y, which is after a couple of downward arrows. And remember that this nominal and C by Y are attachment to each other, which means whatever is the rate you have entered under nominal, that rate's compounding frequency you have to enter in C by Y. It's important that you remember this. Unfortunately, in Texas calculator, they are not placed right after one another. The way they've designed the calculator is there is nominal, then effective, then C by Y. Could be confusing. These two are attached. Now, what is the frequency for this rate? Monthly. Monthly means compounding how many times a year? 12. So make C by Y as 12. And then press downward arrow and come to effective, EFF, and tell me how much is that? 10.47 percentage. This is called your effective annual rate, 10.47, EAR, effective annual rate. Okay. Now, the trick is that no matter which conversion you want to do, for example, on the exam question could be monthly to per week. On the Texas calculator, you can't do that directly with this function. So the way you want to do it is move from monthly to EAR. Once you've got your EAR, lock that number, which means don't change that in your calculator. Now go and change C by Y. Okay, this is frozen now. So now go and change C by Y to week means how many weeks in a year? 52. So make C by Y as 52. Go to nominal, press compute. 9.96. Then make your C by Y as 365. Go to nominal, press compute. 9.95. Okay. Then make your C by Y as 2 and please compute nominal. 11, 2, 5, 21, 10.21. And quarterly, make your C by Y as 4, compute nominal. 10.08. Is this easy? Okay. Now, if I were writing a question, here's the question I will ask. You'll have to think a little bit carefully before you answer this. Let's assume there are two banks. Okay, one is offering you 10.08 compounded quarterly, but the other one is offering you 10.21 compounded semi-annually. Which one would you prefer? You would say they are same. Why is that? Effective annual rate is same. So that's another category of questions where you have to compare different rates with different frequency. Just convert them to EAR and then you're good to go. Okay. All right. Then continuously compounded return. Okay, this is a fantastic question. Let's assume there's a 100 rupees stock. Okay, and 100 rupees stock falls down to 50 rupees. And a 50 rupee stock goes back to 100 rupees. Okay. Now from 100 rupees to 50 rupees, it's fallen by how much? Minus 50%. But 50 rupee goes back to 100 rupees, how much return do you make? 100% return. Right, and that's why again, if you think about it, not relevant, but why I keep on talking about your entry level purchase has to be right. Because imagine if you were able to buy the stock at 50 rupees, correct? You were able to buy the stock at a cheaper price. It just went back to the previous level, but because of the base effect, your returns are 100%, right? Substantially higher. Now, why is the return more and why is the return less here? Because of the base effect. The denominator is changing. This is true when you're dealing with something called as a discrete returns. Okay, in discrete return, your base changes. But when you deal with something called as a continuously compounded returns, okay, something very interesting happens. Okay, and what is very interesting? How to calculate continuously compounded return? Closing value by opening value, log normal. Okay, so 50 divided by 100 log normal, what is the loss? 50 divided by 100, ma'am, please press equal to and then press log normal. 69.31%. Okay, now you're going to be blown away with this. This is minus, by the way, it should be minus 69.31. Try the return here, log normal, 100 divided by 50 minus 1. How much is that? Not minus 1, sorry. 100 divided by 50 and then press the log normal button. 69.31 positive. When you use continuous compounding return, that base effect disappears. This is what I'll frame a question on, maybe a theory question. Okay. For example, I would simply write something as simple as 100 rupees stock became 80 rupees and then went back to 100. If you're computing return on a continuously compounded basis, will the percentage decrease and percentage increase in absolute terms be same? Most of the people will say no, because they will think of a base effect. Base effect works when you use discrete compounding. But when you use continuous compounding, the base effect doesn't work. Why? Because your base is constantly shifting. Is that okay? Now, what kind of questions on continuous compounding? So here's a summary table for you. Present value, future value, time period, rate. Present value 100 at the rate of 10% for 1 year. Present value 100 at the rate of 10% for 5 years. Present value 100 at the rate of 10% for 3 months. Second category of question. Future value 100, 1 year, 10%. Future value 100, 5 years, 10%. Find out present value. Okay. And the third scenario. present value 100, future value 150 in 2 years. What is the rate? Present value 100, future value 150 in 0.7 years. What is the rate? These are the three scenarios in which continuous compounding will be put to use. How to solve scenario 1? I am solving 1, I want you to solve rest of the 2. Future value is equal to present value into e raised to RT. Okay. So here it will be equal to 100 rupees multiplied with e means the exponential function, 10% raised to 1. 110.51. Did you get the logic here? Easy? Those of you who don't know how to do it on Texas calculator, please press this 10 on your screen, then press the percentage button, then multiply with 1. So that means solve for RT first. So on your screen now you have 0.10. Now press second, press e raised to x button. Now on your screen you have something called 1.1. 1.1 ऐसे कुछ होगा ना? That is called future value factor, multiply with 100. Are you able to do this? Now can you apply the same logic here? What should I do? 100 multiplied with e raised to 10% into 5. How much is this? 8. 100 multiplied with e raised to 10% multiplied with 3 months means how many years? 0.25. 3 months is 0.25 of a year, right? So same drill, 10% into 0.25 equal to second e raised to x multiplied with 100. 102.53. If you are super comfortable with this, either give me an I pass or a hand raise. I pass on the chat box, hand raise here. Are you comfortable here? Okay, good. Now, how about coming backwards, which is I have future value and I want to do present value. Good news for you, same formula. Okay. You do the same thing, 100 multiplied with e raised to 10% into 1. The only trick is that you make this exponent negative. So when you want to go forward, e raised to positive RT. When you want to come backwards, e raised to negative RT. So let's try if this works. 10% negative into 1 equal to second e raised to x into 100. How much? 90.48. Then in the same way, you help me. 100 multiplied with e raised to, tell me what should I write? Minus 10% into 5. So do it then. 10% negative into 5, second e raised to x into 100. 60.65. So in summary, what is the formula? If I want future value from present value, it will be e raised to RT in the exponent. If I want present value from future value, tell me what will this be? Future value into e raised to minus RT. I want to go forwards, multiply with e raised to RT. I want to come backwards, multiply with e raised to minus RT. Okay, now what is the last formula? How do I find out rates if I have present value and future value? Then the way to do this will be 150 divided by 100 equal to, press ln. Okay, 150 divided by 100, make sure you press equal to, so you get 1.5 on the screen. And you know what that 1.5 is? It simply means 1 rupee became 1.5. Okay, in a discrete fashion, that's a holding period return. The moment I press ln, it becomes continuous return. So now that will give you how much? 0.40. Now that 0.40 is what you have earned over a period of 2 years. So just divide this with 2. So how much is that coming to? 20.27%. Okay. Apply the same logic here. 150 divided by 100. Then press the log normal button. This time I should divide with how much? 0.7. So do it then. 150 divided by 100 equal to ln divided by 0.57. Sorry, 0.7. 57.92%. So the third formula is R is equal to future value by present value log normal divided by T or N. That is how continuous compounding is going to work. All right. Next concept, and I think this is the last one in this reading, and then we are done. Next concept is levered returns. Okay. Now we are going to connect this. We learned somewhat similar concept in equity crash course. When I have taken leverage, what's my return? And we learned somewhat similar in FRA crash course when we learned the concept of DuPont. And today we are learning it for the third time in Quant. And then I'll be reintroducing this concept one more time in portfolio management. 4 times. Anything repeats 4 times in the curriculum, automatically by simple statistics has a higher probability of being tested. Okay. So 5 star. Now I give you that simple technique. I'll repeat that again one more time. Whenever you want to find out ROE under DuPont, DuPont is a formula. ROE stands for return on equity. What you can simply do is find out what is your ROA, which is return on asset, multiplied with financial leverage. Financial leverage is always calculated as the value of asset divided by value of equity. Okay, so same stuff can be used in these subjects. I'll give you a simple example. Let's assume it's a 100 rupee asset. It became 120 rupees. What is your return on asset? Return on asset is 20%. Okay. But what you basically did is you took a little bit of loan. Okay. And how much loan did you take? So let's assume you took a loan of, let's assume you put in equity of 20 rupees. थोड़ा बढ़ाता है. Let's take equity of 25 rupees. Equity of 25 rupees. And you took debt of how much? 75. Okay. For the timing, we'll ignore the interest cost. Just for the timing, just ignore the interest cost. Okay. Now, if this is the case, what is my financial leverage ratio? What was the formula of financial leverage? The value of asset divided by value of equity. Asset means 100 rupees. I've invested how much? 25 rupees. How much I have? 4. Financial leverage is 4. Okay. Now, observe this carefully. I want to figure out what is my ROE here. Okay. Return on equity. How would I compute that? Here's one way to do it. I can find out what was my equity investment in this project. What was the equity investment? 25 rupees. And what is my profit on this project? 20 rupees. Ignoring the interest cost, profit is how much? 20 rupees. So 20 on 25, how much is the return? 80%. समझे ना कैसे? I invested 25 rupees from my own pocket and it gave me a return of 20 rupees. So 20 rupees of profit divided by 25 rupees of my own investment, return on equity 80%. Or a very faster way, take your ROA of 20%, which is the return that the asset has earned. Okay, 100 rupees becoming 120. Multiply that with financial leverage. Financial leverage is how much? 4. So 20% into 4 is how much? 80%. Very easy, quick math. Have you understood the logic here? Now, let's do one more example, but this time a little more practical. Let's assume a 100 rupee asset. Equity is 25 rupees. Debt is 75 rupees. 100 rupees became 120, but interest on debt was 10%. Okay, what is my unlevered return versus levered returns? Now, here your unlevered return, unlevered means ignoring the debt, assuming debt was not there, would have been how much? 20%, easy. But what would be my levered returns? Okay, levered returns will be how much money did go out from my own pocket? How much is that? 25. So the money that went out from my own pocket is 25. How much is the profit made for the year? 20 rupees. But wait a minute. Now I have to also consider what? Cost of debt. How much is that? 7.5. Okay, so 20 minus 7.5 divided by 25. How much is that? This is 12.5 on 20. This will be 50%. Is it okay? Is there a shortcut to do this? Yes. So this formula actually is hidden in one more subject. In corporate issuers, there is something we learn called Modigliani and Miller theory. Okay, under, I don't know how much you remember, under no taxes, with taxes, remember proposition 1, proposition 2. So what was this theory? There is a formula that the theory gives you. ROE is equal to ROA, okay, plus difference between your return on asset, and I don't know if ROA is the right word, but let me rephrase it. ROE is equal to the unlevered returns, that's the correct word. Unlevered means ignoring the debt, unlevered return plus unlevered return minus cost of debt multiplied with financial leverage. No, here it will be debt to equity. Let's see if this method works. Unlevered return were how much? 20%. Difference between 20% and 10% how much? 10%. And what is my debt to equity ratio? 75 divided by 25, 3. है ना? Debt to equity कितना है? 75 divided by 25, that's 3. 10 into 3, 30 plus 20, 50. Matching with this? Yes. One more time. If you're finding it difficult, no problem. It's not that difficult. Let me write down formula for you clearly. Return, okay, using leverage, that means considering leverage, is equal to returns ignoring leverage. Leverage means loan, by the way. Returns ignoring leverage plus difference between return and cost of debt multiplied with debt equity ratio. Okay, so one more time. 100 rupee became 100 and let's say 25 rupees. What is your unlevered return? 25%. Okay. Now let's say 40% is equity, 60% is debt. Let's say debt is coming to you at 10%. Debt is coming to you at 10%. So you tell me, what is the difference between unlevered return and cost of debt? 25 and 10, what is the difference? 15%. Understood how that 15 is derived? 25 minus 10. Multiply with debt equity ratio, 60 divided by 40. 1.5. How much is this? 47.5. That's my return using leverage. Can I verify with direct method? Sure, we can. What would be verification with direct method? How much is my equity investment in this deal? 40 rupees. How much profit was made? 100 rupees became 125, 25 rupees. But how much loan was paid? 6 rupees. So 25 minus 6, 19 by 40. Do the math. 19 by 40. Please do the math. How much? 47.5. Are you comfortable? Okay. Good then. Reading number 1 is finally over. 10 more to go. It's a long journey, but it's fun. It's going to test our mental endurance today. The closest real-world example to this is if you decide to do anything in life that requires a lot of endurance. For me, probably a good example would be when I first started trekking after my college, and I initially started with some smaller treks and then went for a fairly longer trek. Now what happens if you're on a long trek is you're just walking and there is no sight of summit. So you just keep on walking, and it's very scary because what if you're midway and you give up, right? Then either some people need to carry you on their back or it becomes difficult, right? So there was a guide, right? And what he taught us, very simple. He said, just walk for next 1 hour. Don't think about next 7 days. Just walk for next 1 hour. So put your head down, look at the road carefully and just enjoy next 1 hour. Uske baad wala sochenge. And you finish an hour and then you do 1 more hour and 1 more hour. And then you just think very, very short term for a larger goal. It becomes easier. So for us, 1 hour is done. Here's your next hour. Time value of money. TVM. This is easy. Now, again, I do not like how syllabus is constructed in this curriculum, because in this reading you have everything. You have bond valuation, you have equity valuation, you have derivatives, all of it, which anyways will be covering in depth when we go to respective sections. So I'll be skipping a lot of sections here. For example, now in equity crash course, we learned Gordon growth model. The same thing is repeated here, right? So no point repeating those elements here when we can do it separately. So I'll only focus on the unique areas. The first concept here is valuation of bond. Okay? And I'll recommend you to do the same. When you're learning valuation of bond, don't learn in this reading. You're anyways going to learn it in fixed income. Then let's look at second concept. We'll do only the unique concepts here. This one will do. PV of perpetuity and amortization. In fact, PV of perpetuity is, I believe, is a testable concept. Some people have difficulty, understanding this, which honestly should be fairly easy to understand. If I tell you that I have 100 rupees with me, okay, and you do the same on the exam if you forget formulas. I have 100 rupees with me. I put that money in a bank, and bank gives me 10% per annum. Okay? Then every year, I will get how many rupees? I will get 10 rupees. And assuming the FD does not mature, that means it's a perpetual FD, then this is my equation. Every year I'll keep on getting 10. Notice my equation has 3 parts. What is that? This is my present value, amount invested today. This is my discount rate, the rate that the bank offered. and this is the cash flow that the bank is giving me. Do you think if I give you any two, we can find the third one? Yes. So what if I want to find the present value? Can you please tell me what should be the formula? Cash flow divided by discount rate. There you go. That's your perpetuity formula. Right? So here it would simply be 10 divided by 10%. That gives me value. Is this clear? Now, any perpetuity you want to value, this is the framework you want to use. Cash flow divided by discount. But what if it's a growing perpetuity? Now, what is a growing perpetuity? Perpetuity means forever. Growing means it's not a constant amount anymore. So let's say year 1 you get a 10. Year 2 you get 10.2. No, 10.2 ज़्यादा हो गया. 10.5. At what rate did it grow? 5%. Okay, now on your calculator please. 10 plus 5% equal to 10.5 plus 5% equal to 11.025 plus 5%. 11.57, and then enough, because this we can do for the whole crash course for next 5 days. Right? It's a growing perpetuity. It will keep on growing like this forever. How do you find out value of this growing perpetuity? So here the valuation is, I will take the cash flow that I get in year 1. I take the discount rate in the denominator. Notice up to this the formula is same like last one. Cash flow divided by discount rate. The only tweak I make is in the denominator I do minus growth rate. So then it captures that additional growth component. Where is this formula coming from? Is it made by Gordon? No. We call this Gordon growth model. No. It was not made by Gordon. This is a simple limits formula. You are applying limits on that growth perpetuity. Gordon applied that to equity valuation. Therefore, it became a Gordon growth model. Okay. So 10 divided by, let's assume discount rate of 10%. So 10% minus, what is the growth rate here? 5%. So how much would that be? 200. Is this clear? Now, similar scenario. First year cash flow is 10, second year is 10, third year is 10, 10, 10, 10 till perpetuity. Okay, apply the same logic. Cash flow of year 1 divided by discount rate minus G. Okay, cash flow of year 1 is how much? 10. Discount rate 10%. What is the growth rate? 0%. Which formula is this? Cash flow divided by discount. A simple perpetuity. So technically these are the same formulas. Growing perpetuity and growing perpetuity. Constant perpetuity and growing perpetuity, same formula. It's just that in a constant perpetuity the growth rate is 0. Because the growth rate is 0, in denominator we just write cash flow divided by discount rate. But the moment you have growth rate, then the formula becomes cash flow divided by discount rate minus G. In a constant perpetuity, growth is going to be 0. Are we okay? Now one small nuance that you need to know. And what is that nuance? In this formula, if you want to have a valuation of time 0, your numerator has to be cash flow of year 1. There will be some cases where you have to do maybe valuation of year 3. Then what should be the formula? Cash flow of year 4 divided by K minus G. Now that you have to be super careful with. The numerator has to be cash flow of the next year. If I have to do valuation in the third year, numerator has to be cash flow of year 4. Okay? Fine. Next concept is amort table. Amort table means how your loan is paid off over a period of time. Again, fairly simple. We use this in FRA when we do accounting for leases. I think that time I covered this. I did cover this, right? So every installment that I pay is made of two parts, right? Which two parts? Some part of it is principal repayment, some part of it is interest. I pay those installments in such a way that over a period of time my loan value will become 0. So since we've already covered this in FRA, I'm going to skip through this part. Of course, in Juice Notes we have a beautiful example if you want to look it up. Next concept is your dividend discount model, already covered in equities, so we'll skip. But in this model, in equities what I did not cover is what I want to do now. Can I reverse compute growth rate and discount rate? So that's what we want to do. So let's do an example. Example 1. Dividend of year 1 is 10 rupees. KE is 10%. Growth rate is 5%. Please find out valuation. Please find out valuation. So it will be 10 divided by 10% minus 5%. How much is that? 200. Example 2. Valuation is 200. Dividend of year 1 is 10 rupees. Growth rate is 5%. Please find out KE. Now we know the answer. We know the answer, right? Of course, it's the same question. But how would I do it? So here's how we'll do KE. K is equal to D1 by P0 plus G. Derived from the same formula, or D1 plus V0 plus G. Now, is there a memory trick for this formula? Yes. Okay, what is a memory trick? You're an investor. You're buying stocks. How do you make money? You get dividends plus you get capital appreciation. D1 by P0 is nothing but dividend yield. In percentage term, how much dividend I'm getting. Capital appreciation is nothing but growth. If you think like this, the formula is very easy to memorize. D1 by P0 plus growth. Of course, you can derive it from this formula. No big deal. But if you want to do it fast, this is an easy framework. Okay. So think about it. 200 rupees stock giving me a dividend of 10 rupees. So 10 rupees on 200. How much I'm getting? 5%. And growth is how much? Another 5%. So what is the cost of equity? 10%. Done. So you can quickly figure out what's my cost of equity with this framework. Okay. This part also we covered, a quick primer. We learned the concept of justified P ratios. Okay, I covered only one with you, now I'll do both. I told you that on level 1 exams, I'm expecting only leading P ratio to show up in the equity syllabus. But in the quant, they've discussed both, leading as well as trailing. There we did derivation of this also. Now I'll just give you the formula. A leading P is equal to, anyone remembers? Payout ratio divided by K minus G. Okay. Now, how about from leading P ratio, you want to go to trailing P ratio. Now, the first thing, ये leading trailing होता क्या है? Okay, so both the ratios, a P ratio means a formula is very simple, P divided by E, price divided by EPS, which we saw in the previous example. Can anyone tell me what's the difference between leading and trailing? In leading, the denominator is of next year. That means I'm forecasted EPS of next year. Leading matlab agle wala, forward P. In the trailing, denominator is of current year, E0. Okay. So leading justified P ratio formula is payout by K minus G. Trailing justified P ratio formula will be same, payout ratio divided by K minus G with one attachment. What is that? Into 1 plus G. So difference of the two ratios is 1 plus G. And this is slightly confusing for some people because You might think leading P ratio will be higher, but it's not like that. Trailing P ratios are generally higher by a factor of 1 plus G under this formula. Leading matlab आगे वाला, trailing means पीछे वाला. So the formula that you use, payout by K minus G, is for leading. If you multiply that with 1 plus G, you get trailing. Example. Let's say there is a firm that has a EPS of 10 rupees. It decided to pay dividend per share of 4 rupees. The cost of equity is 14%. Growth rate is 4%. Okay. Let's calculate two P ratios. Let's calculate a trailing P ratio first. Let's calculate a leading P ratio. Now, for trailing P ratio, what is the formula? Help me with this. Payout divided by K minus G. 10 rupees of EPS, 4 rupees of dividend. 10 रुपया कमाया, 4 रुपया दे दिया. What percentage are you paying? 40%. So, payout ratio 40%. That's called dividend payout ratio. Divided by K minus G. 10 minus 4%. How much is that? Sorry, 14 minus 4%. So 40% divided by 10%. How much? 4. So my trailing P ratio is simply 4. Now, okay, my mistake. This is leading. This is trailing. Thank you very much. Now tell me, trailing P ratio. What should I do now? Just take this 4 and add 4% to it. So that should become 4.16. Enjoying this? Okay. Those of you who've not studied this reading and maybe seeing a lot of new concepts for the first time, try to absorb as much as you can. There, I'll strongly encourage you to take some running notes. If you're not a FEB candidate, that means if your exam is not now, it's sometime in the future, just keep on taking notes. I promise you this will come in very useful when you actually learn the subject, because you've already gone through the whole thing one time. Then next FF is on forward rate. This I will be covering in depth in the fixed income sessions. So I'm skipping it here. Then there is one discussion on interest rate parity. This I will be covering in economics. Okay, and I'm sorry I'm going to say a lot to this reading, but that's the stupidity of the syllabus developer. Because the simple rule of constructing any curriculum is you add a structure to learning, right? Not throw random topics together. When they have done this, they have assumed that people know these concepts, which clearly interest rate parity will be learning in depth when we do economics session. Everything will be covered, so don't worry about this. Then option pricing we'll be learning in derivatives session. So that's your reading 2 over. Okay. Reading number 3. Now actually the real con starts. Because what we studied prior to this was not even con, it was just basics of time value of money and interest rates. Statistics actually starts here. Now, this reading is fairly basic. It talks about if you have large amount of data, how do you make sense of it? Generally, you make sense of it by calculating something called measures of central tendency. Okay, now let me ask you a question. Most of you, all of you in fact, are studying for CFA level 1. Now once you pass level 1, what do you think is the kind of salary you are going to get? What is the salary for level 1 cleared? I don't see a lot of optimism here, which is good. Secret recipe to be happy in life is expect less. Bolo, how much? After level 1. 5-6 lakhs. Oh, you're not expecting less. No, she's right. Maybe my guess is you meant 5,000-6,000 rupees a month. 5-6 lakh rupees. Oh. Some people are saying 12 to 15 lakhs. Yeah, some of the folks which were sleeping suddenly would get salary. Okay. You know what, I don't think you'd get 5-6 lakhs. I'll be honest. I think 3 lakh. Yes. 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 3 lakh, 4 lakh rupees, that's how much you should expect. You would get more if you go into profile where you not get to learn. Like you go to ops type of GCCs, they'll pay you more, you not get to learn. If you go to good profiles, probably people will not pay you much after level 1, and that's okay. But anyways, that's not the topic. Topic is, you told me 5 lakhs. Now, there are maybe 20,000 CFA level 1 cleared candidates roaming around. Some people are earning more, some people are earning less. You summarize that entire 20,000 data with one number. You said 5 lakh rupees. That is nothing but a measure of central tendency of data or measure of location of data. One number summarizing 20,000 data points. And that's what statistics is. So, what are the measures of central tendency? One is your mean. We know mean. One is your median. Now, median has a formula, but honestly, conceptually, median is just the center point. Okay, now medians are very, very useful metric when you have outliers with your data set. So let's think of medians. Let me just plot the reading name, statistical measures. Statistical measures. See now, I'm computing scores of candidates. Some of the people are leaving chat box after 3 lakh rupees. Okay, some people are computing. Let's assume we are computing scores of candidates. Let's take salaries, that excites you, right? I'll tell you FinTree examples. I think we've done, the highest we've done maybe at level 1, if my memory serves me well, is about 14 lakhs or something. Level 1 cleared candidate. Not that we were great or something, that guy was very smart who came in, and he was recruited at a firm where they needed that kind of a skill set, right? But let's say we have someone who's made 14, and then we've done plenty around 9, 10, 9, 10. And let's assume we have maybe 2, 3 around 9, 9, 9. And then we will have a bunch of folks at maybe 3, okay, 4, 3, 4, 3, 4, 3, 4, 4.5, 3, like this. Now, if I were to take an average of this, what will happen is these 14 or 9 number, okay, they're going to push the average upwards. They're not truly representative of what a salary is. Therefore, if you look at this large colleges, at least the ethical ones, they don't report a mean pay, they report a median pay. Because a median is not affected by outliers. So how would you do a median in this data set? Very simple. Just calculate the observation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 and 14. So I have n is equal to 14. What you want to do is, you want to take this 14, add 1 to it. Okay, and divide it by 2. What do you get? 7.5. So you need 7.5th observation. Now, to find out 7.5 observation, I need to arrange my data in a sequence. Okay, so 14, 9, 9, 9. How many times 4 do we have? 1, 2, 3, 4. So 4.5, 4, 4, 4, 4. And then 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. These are my numbers. We have to go and find out 7.5th in rank. So this is 1, 2, 3, 4, 5, 6, 7, 8. अच्छा 4.5 दो बार गिन लिया. Okay. So 1, 2, 3, 4, 5, 6, 7, 8 doesn't change our answer, but 10, 11, it doesn't matter, right? Now 7.5th observation, this is 7th, this is 8th observation. If I have to find 7.5th, I have to take an average of these two, which luckily in this case will be 4. So we'll say median salary of level 1 candidates is 4 lakhs. Are you getting hang of it? Okay. So that's median. Now, the curriculum talks about odd number, even number, that really doesn't matter. Okay, I mean, it's the same formula. N plus 1 by 2, th observation. Matlab wo n plus 1 by 2 is not your median. 7.5 is not your median. 7.5th observation is your median. If I am constructing a paper and if I decide to write a question on this, I will keep 7.5 as one of the 3 options. And I'm sure there would be at least some candidates who do this, they'll look at 7.5, take and move out. So be very careful with that. Easy here? What else? Mode. Mode is what? Data point that's repeating with highest frequency. What if there is no such thing? Everything is repeating only once. Then we say no modal. No modal data. What if there are some values which are repeating with a frequency of 6. So let's assume salary data. 3 lakh is repeating with a frequency of 6. 4 lakh is also repeating with a frequency of 6. Then we'll say it's bimodal. That means my data set has 2 modes. One is 3, one is 4. If you have outliers, what options you have? You can use either a trim mean or you can use Wins rise. Even better, I feel, just use a median. Median solves all those problems. Then, what is quintile? Look at this. This is quantile. Okay? Don't confuse with quantile and quintiles. A quantile is a generic term. It simply means dividing your data set into equal parts. Okay? So for example, I have data set of 100 candidates. If I decide that I will make 20 groups of 5 candidates in equal parts, then those are quantiles. Sound better? If I decide that I will divide my data set into 4 parts, those are called quartiles. Divide data set in 5 parts, quintiles. Divide data set in 10 parts, deciles. Divide data set in 100 parts, those are percentiles. Now on the FinTree weekly test, what do we present? We present quartiles. That means we take all the candidates, divide them into 4 parts. Is this useful in finance? Extremely useful. Okay, so I'll give you a quick real life example so it will be easier for you to recall this. Now, where is this thing used very heavily is, let's assume I have to select a mutual fund manager for a client. Okay, and currently I'm working on some data on this. I told you we'll be publishing it in some time. Now, how do I select the best mutual fund manager? So let's say for client, you've selected a category which is called FlexiCap. Now FlexiCap, we have some star fund managers, right? We have Parag Parekh and we have XYZ. So how do you know which category is best? So let's assume you have 20 fund managers. Or simplicity ke liye kehte hain, let's assume you have 40 fund managers. Now what I can do is I can take all the fund managers and give them a rank. So this fund manager has the highest return, 22%. So rank 1. This fund manager made second highest return, rank 2. Okay. In this fashion, rank 3, rank 4 up to rank 40. Then the ones which have the top 10 rank, they will become my quartile 1. You know? The ones which have next 10, they will be quartile 2. Then next 10, quartile 3. And next 10, quartile 4. Correct? Now, quartile 1 are the winners. Quartile 2 are okay, doing alright. Quartile 3 are losers because quartile 2 is nothing but your median, right? Dividing data set into half-half. You know? So quartile 3 means they have earned return less than the median, and quartile 4 are the worst category, and सबसे lowest in the class. Now you want to select a fund manager. Tell me, should you select from 3 and 4 or 1 or 2? 1 or 2. That's obvious. You want to be with the winners, not with the losers, right? These guys are underperforming the category as a whole. These guys are outperforming. Which one will you select? Will you select quartile 1, the top 10 fund manager, or would you select quartile 2, the next 10 fund managers? You would obviously select the Q1, right? Now, I have a working theory on this. This is of course borrowed, and now we're doing some work on it. We feel that these are not the funds you should be selecting. Okay, and the theory is this: in order to reach quartile 1, the fund manager obviously might have exposed their portfolio to higher level of risk, right, with whichever factor. Now, those fund managers which result in quartile 1, because the portfolios are designed risky, in the subsequent few years, there's a chance that these guys will also go to quartile 4 when the market cycle turns. So these are the folks who oscillate between 1 and 4 extreme results because high risk portfolio by design. Ideally, you want some fund managers which can manage to remain in quartile 2 consistently for a long period of time. Because these fund managers, and again, this is a working theory, I don't have data to prove that at the moment, but we're working on it. But what we believe is that these fund managers who probably did not do as good as quartile 1, but they insulated portfolio from risk. So when the market turns, they will still be able to do reasonably okay. They will not fall into quartile 4. So ideally you want funds which are closer to this region rather than on the extreme. Okay, so that's one use case of how you look at quartiles as a data set. Then a concept called interquartile range, which is the difference between Q3 and Q1. Now, if this range is higher, what does it tell you? It means data set is very volatile, right? Large distance between Q3 and Q1. If the range is smaller, means data set is relatively concentrated. Okay. Then a box and whisker plot. Now all the FinTree candidates should be hopefully super comfortable with this. Why? You see this in your weekly test every week. This line here is your highest scorer or highest value. This line here is your lowest value. This is your box. This thing is your quartile. ये quartile 1 होगा. Or upper boundary of quartile 2. This is your median. Mean could be anywhere in between. And this becomes your quartile 3. Lower boundary for Q2 means technically this is your Q3. This is Q1, this is Q3. Difference between Q1 and Q3 is what? Interquartile range, which is the width of this particular box. That's it. Easy? Then measures of dispersion. First is range. Range formula is maximum value minus minimum value. Then a formula of mean absolute deviation, which is a standard deviation formula, but with some differences. Here we take x minus x bar, but we don't take the sign, we take the absolute value. We don't square it, we just sum it, we divide it with n. Okay. Standard deviation formula, x minus x bar square summation divided by n or n minus 1. Take under root of variance, you get your standard deviation. How about downside deviation? How does that work? Also called semi-deviation. How does it work? You take all the values which are below mean or below target, right? Your n remains same, n does not change. Let's do an example of all of them, super quick. One comprehensive example on dispersion. Let's assume these are your x values, 2, 3, 5, 10, 10, okay, we'll stop here. Now, with this data set, I want to calculate first a range. Tell me what is the range here? Difference between 2 and 8, 2 and 10, how much is that? 8. Let's calculate MAD, mean absolute deviation. How would I do it? I will calculate x minus x bar, okay, and then sum it up. We'll have to calculate x bar first. So that will be 30 divided by 6, is it 5? 30 divided by, okay, that's 6, that's correct. This is 6. So this would be 2 minus 6, how much? Help me out, 2 minus 6, how much? 4. But we'll take the absolute value. That means it will just be 4. Okay? 3 minus 6, 3. 5 minus 6, 1. 10 minus 6, 4. 4. Please add it up. 8, 11, 12, 16. Is it 16? 16 total? 16. So then what would be my mean absolute deviation, MAD? 16 divided by 6. That's it. Sorry, 16 divided by 5. 3.2. Done. Alright, next. I'll take the same x minus x bar now, but I will take a square of it. Okay, so 4 square 16, 3 square 9, 1, 16, 16 total. How much is total? 58. Now please take an under root of 58, divide that with 5. Under root of 58 divided by 5. Sorry, my mistake. 58 divided by 5 under root. 58 divided by 5 under root. 3.40. What is this number called? Standard deviation. Is it population or sample? Population. What is the difference? Population denominator is n, sample denominator is n minus 1. Is this okay? Now the real question. Please calculate a semi-standard deviation. Now this one I want you to be with me. Look at this carefully. What do you mean by semi-standard deviation? We'll do the same thing, x minus x bar, but this time the formula will be x conditional minus x bar square. Okay, and what is the condition on x? I will take only those x which are below the mean. It's 2 below the mean. Yes, so I will take that 16. It's 3, what is the mean value here? Mean value is 6. Okay, so remember that. It's 3 below the mean. Yes, so I will take that 9 in my calculation. Is 5 below the mean? Yes, so I will take that 1 in the calculation. Is 10 below the mean? No. This 10 below the mean? No. So that's it. So this is 25, 26, and then everything else is same. 26 divided by 5 under root. So what did I do? I used the same standard deviation formula, but instead of taking all the values, I took only those values which were below the mean. How much is this? 2.28. Easy? Now, instead of semi-standard deviation, what if the question says target standard deviation? Now, what is target? Target would mean that you're targeting a particular rate of return, and any return which is below your target is what you need to consider. Let's keep a target of 4%. If I keep a target of 4%, then my x new condition minus x bar square will look how? Can I take this 2? Yes, so 16. Can I take this 3? Yes, 9. Should I take this 5? No, no, no. So 16 plus 9, 25 divided by 5 under root. 2.23. Did you understand the difference between semi-standard deviation and target standard deviation? In semi-standard deviation, I took only those values which were below the mean. In target standard deviation, I took those values which were below the target. The denominator remained 5 irrespective of how many values I combined in the numerator. I am not changing my denominator to 2 or denominator to 3 here. Notice I took only 3 values in the numerator, but my denominator still remains 5.
The calculation will change now if we keeping the target as 4. So
Yes,
minus target.
correct. You're right. If I keep target as 4, you spot on, then I have to do x minus, my apologies, this should be x minus target. She's right. I made a mistake. I shouldn't have taken x minus x bar. I have to take x minus the target. So 2 minus 4 square. Thank you very much for helping me there. So that should be 4. 3 minus 4 square, this should be 1. And therefore, this should have been, kitna hota hai? 5 divided by 5 under root 1. So when I'm using a target standard deviation, the formula changes in 2 ways. One is I take only those values which are below the target. I replace x bar with the target number. Okay, can I move on? Are you okay with this? It's basic, so I want to have a little speed with this. Okay, then one more metric, coefficient of variation. The formula is standard deviation divided by mean, and you want this number to be lower because sigma is in the numerator and return is in the denominator. Okay, we have a comprehensive example in the juice notes for those of you who would like to have a look later on, but I'm going to skip through this now. And we'll stop for a break. I'll be giving you more number of breaks today. कितना देर चाहिए भी आपको? 15 minutes is okay? After the break, the technical kind of aspects will start. All right, I'm ready when you are. Let us start. We have to take more number of breaks today, so we have to be a little more efficient with in and out. Okay. So now the shape of a distribution. What is this? Yeah, something probably looks a little bit like normal distribution. Characteristics of normal distribution: it is bell-shaped, it is symmetrical, which means ada, half of the data on the left, half of the data on the right. And this is mean, median, and mode right in the center. Skewness of normal distribution is 0, and kurtosis of normal distribution is 3. Now, normal distribution is fairly common. Let's do a AI search. Does normal distribution occur in nature? Yes, normal distribution is frequently in nature in many measurable characteristics like human heights. Right? So in India now, I don't know, what's an average height of an Indian? कितना होगा? 5.3? 7? कौन है भाई? 5'7". Okay. Let's assume 5'5". Then there would be people who would probably be, I don't know, 6.5 feet. I'm sure there are 7 feet rare species as well, but there would also be, shorter ones, right? But on an average, majority of the population will cluster in the center. And then half of the folks will be on the right, half of the folks will be on the left. 50-50% symmetrical, which means if we have less number of 7 feet people, then we will also have very few grown adults who are just 3 feet or 3.5 feet or 4 feet, right? Whatever is that parallel. So that's human height. Birth weight. Birth weight is normally distributed. Reaction times to something is normally distributed. And you can go and read it's in thousands of things. This is normal distribution. Very, very powerful metric. Now, okay, some funny comments, but I don't want to read them. Now, if the distribution looks like this, okay, so if the distribution looks like this, okay, very bad job with this, but a little bit like this. What does it mean? It's skewing towards left. So we call this distribution as a left skewed distribution. What is a real life scenario of left skew for you to visualize? A left skew means something extreme happening in your data on the negative side. Okay, so maybe something like your portfolio makes 10% return per annum for months and months and months. So your mean of the portfolio is maybe around 10%. But suddenly you have some months where you make minus 70% or minus 60%. Then that is called as a left skew scenario. What you want to be very careful in finance is avoid left skew, right? What you want instead is you want to build a right skew portfolio. A right skew portfolio would be skewness on the right hand side where you earn 10% for months and months and months, but suddenly once in a while you get lucky and you earn a positive 70% or you earn a positive 80%. That is called as a right skew characteristic. So when you're looking at returns, do you like left skew or right skew? Obviously right skew, right? You want to avoid left tail and you want to get into right tail. You want a right skewed distribution. Then, what is kurtosis? Kurtosis means if this is my normal distribution, okay, again, I'm doing very poor job with drawing this, but this is my normal distribution. If you have a very fat tail, I'm ashamed of what I've done here, but this is the tail. Now, how do you read? Okay, how do you read the concept of tail, and what do you mean by fat tail? Okay, so I'll simplify this for you. So the way to think is left tail, okay, and also left tail or left skew, also called negative skew. Okay, simply means let's build some real world example. Let's assume you ride a motorcycle, you take out your motorcycle, leave your house, and you suddenly meet, go on a bridge and the bridge collapses. So bridge collapse is what type of event? A left skew event, okay, or a left tail event. What would be a right skew event or a positive skew event? That means you start riding on a motorcycle, and let's say suddenly after a few kilometers some very pretty girl is asking you for a ride. And I'm not sure if that's exactly a right skew. Probably in India you should be scared if that's happening. But let's say क्या हो सकता है right skew? Let's say pretty girl asking for a ride. Pretty girl, यार शायद आपके parents को दिखाओगे आप ये I can't और क्या पढ़ाता है? Let's say you find on the street, बोलो, free fuel. It's a skewed, you want something large. So let's say you find a kg of gold lying on the street. Is that crazy? Is that happy event for you? Of course, yes. Now this is the meaning of left skew, right skew. It's happening one-off, but it's extreme. It's extreme, right? That extreme, even just one event creates that skew in the tail. Left means negative, right means positive. What do you mean by a fat tail? A fat tail simply means, okay, a fat tail simply means बार बार होता है. That means it happens frequently. What frequently? These events. So when something that's unusual but happening again and again and again, that's a fat tail. Fat tail talks about frequency. Tail talks about severity, intensity. What you want in life is you want a right skew and a fat tail. Then that's the beautiful thing to have, right? You want to have a life like that where you have a right skew and fat tail, which means imagine you buy some stupid options on some random stock. You buy them for 10,000 and suddenly they become 50 crores. Right? That's a right tail event. And then that happens to you again and again. Right? Then that's your fat tail. So fat tail and on the right side, fantastic. What you do not want is a left tail with fatness. Left tail will fatten means you're going on a motorcycle, and you reach on a bridge and the bridge collapses, you fall down, let's say you lose your limbs. Then they put you on a wheelchair, again going on the same bridge. Right? That's what you do not want happening. Are you getting this conceptually? Unfortunately, now you learn this in alternative investment class. Alternative investments generally exhibit a leptokurtic left skew behavior, which means alternative investments have a left skew and a fat tail on the left side. So all these fancy hedge funds and all of these alternative categories, they have a left tail, they have a left skew behavior. Left skew means every now and then they will give you extreme negative returns, and they also have a fat tail there, which means that every now and then happens again and again, very frequently. Okay? So again, coming back to this, we understood skewness, now we have to understand kurtosis. So kurtosis is fatness of the tail. Okay? So if this is my normal distribution, if I were to have a distribution which looked a little bit, okay, looked a little bit like this blue thing, then we will say, look at this, we have a higher frequency in the tail of the distribution, right? So this is called as a fat tail, and this distribution has a name. This is referred to as leptokurtic. Okay? This normal distribution is referred to as a mesokurtic. Just some fancy Latin names. They have no relevance. I mean, you could have just memorized them as, fat tail or less thin tail, but we have to, since it's an exam, for exam purposes, we have to do it. And if you have a distribution that's like this, okay? Not very good at drawing this, but maybe I have not done a good job, but at least you would get a gist of what I'm trying to do. If you find a distribution which is kind of fairly flat here at the top, and it has fairly thin tails this side compared to mesokurtic, then we call this distribution as a platykurtic from the word plateau. So platykurtic, mesokurtic, leptokurtic, highest peak, then medium peak, and then flatter peak. Memory technique to remember this, it's in alphabetical sequence. So at least in case if you get confused on the exam, at least it will help you memorize it. Okay? Mesokurtic has a kurtosis. Kurtosis is some sort of a measure of wo pahad kitna uncha hai, how tall, how vertically tall the mountain is. So mesokurtic kurtosis is 3. Therefore leptokurtic has to be more than 3. So this is more than 3. And platykurtic obviously will become less than 3. Now, in the world of kurtosis, we generally measure something called as an excess kurtosis. Okay, what is an excess kurtosis? How much over and above 3? So for mesokurtic, that excess kurtosis will be 0 because it is 3. For leptokurtic, that excess kurtosis will be positive. For platykurtic, that excess kurtosis will be negative. That's it. So that's your concept of kurtosis, that's your concept of skewness. Is that okay? This is your normal distribution, mean, median, mode. Okay, there's one thing. Now, if I have to write this question on the exam, what will I write? Let us say we have a data that has a mean of 10, median of 10, and mode of 10. What do you think is the skewness of this data? What can you tell me about skewness of this data? Skewness of this data is 0. Why? Because mean is equal to median is equal to mode is a property of normal distribution. Normal distribution is neither skewed on the left nor skewed on the right. It's symmetrical. Symmetrical means not skewed. Let's say I have a data set which has a mean of 10 and a median of 7 and a mode of 5. What can you tell me about the skewness of this data? What do you think is the skewness of this data, positive or negative? Is it left skewed, right skewed, positive, negative? Left and negative is same, right and positive is same. So is it positive or negative? So I'll give you an example. Think of your monthly income. You are earning, इसको तो हंसी आया, जैसे मैंने बोला think of monthly income, he started laughing. He thought that was a joke. So let's assume your monthly income is 10,000 rupees a month. Now suddenly you go out and suddenly you win a lottery, and 1 month you make some crazy 10 crore rupees a month. Then you come back to your 10,000 rupees a month. Okay. When I take an average of this, do you think my mean will go up? But my median will still remain 10,000. My mode will still remain 10,000. So which means in what situation my mean is becoming higher? When I'm winning that lottery? That means it's what type of skew? A positive skew or a right skew. Okay? And let's think of your monthly income. 10,000 rupees a month. क्या नाम है आपका? White shirt. आप कहाँ? पारस. इतना गुस्सा क्यों हो रहे हो भाई? Chill करो, कोई नहीं. So 10,000 rupees a month. And then suddenly Paras is inspired by F&O classes. And he says, Abhi, I'll do a nice trade. And he keeps his house, his family's house as collateral, takes a loan, does a trade, loses, let's say 10 crores. Now, if Paras loses this 10 crores, what would be the mean monthly income? Do you think it will be very low? But median would be higher, mode would be higher. So if I have an inverse scenario, which is mean is 10, but median is maybe 12 and mode is 15. So easiest way to think in the context of mean. What's pushing my mean upward? That means there is some positive large event. What's pushing my mean downwards? There is some negative large event. This has to be a negative skew. This might be tested on the exam. Are you with me on this? Okay. Now, there are formulas for skewness and kurtosis. Very unlikely this will be tested from a calculation perspective. I don't think the questions are written like those. Okay. But in case if it shows up, it's same as standard deviation formula of sorts. X minus x bar, but now not raised to 2, raised to 3, divided by standard deviation raised to 3 into 1 by n. Good news, if you have to do kurtosis, same formula. X minus x bar raised to 4 divided by standard deviation raised to 4 into 1 by n. This is the formula of kurtosis. This is not necessary. Why have I deducted minus 3? For excess kurtosis. But just the kurtosis is same formula. Notice these are approximation formulas. There is no equal to sign, it's an approximate sign. Very unlikely you will do the math. You should just know the concept. Okay, you should know the theory around it. Okay. Now, a little bit about how to make use of this normal distribution for estimating probabilities. Now, this will be repeated in the subsequent reading, but I want to cover that now in one go. Let's think of mean monthly income of a CFA charter holder. Let us say it is $10,000. Is it nice? Is it nice? Nice here, not nice there. In India, of course, if you get this, then it's decent, right? So mean monthly income, let's say $10,000. Let's assume this mean monthly income follows a normal distribution. Okay. Standard deviation of this monthly income, let's assume, is $2,000. Standard deviation of this monthly income is $2,000. Now, With this information, what percentage of charter holders will earn more than 12, okay, more than 14, then less than 10, less than 8, less than 6. All these questions we can answer. And we can answer them very, very easily by learning a beautiful technique that we have in the class, which we call, does anyone know? We call this technique as Hathi Ghoda Chuha. Okay, so I'm going to show you. Now, ideally, to solve questions like these, you have to refer to normal distribution. But we are going to learn not looking at normal distribution and still getting the answers right. Okay, and the way it's going to work is, you build this mean here in the center. Okay, mean salary is $10,000. So I'm just going to write 10 here. What you do is, you add one standard deviation on the right hand side. One standard deviation on the right hand side becomes $2,000 standard deviation, so I'm making it 12. One more standard deviation on the right, it becomes 14. And one more on the right, it becomes 16. In the same way, one standard deviation on the left, help me out. 10 minus 2 is 8, then one more 6, and then finally 4. What you're going to remember, and I want you to remember this because, I mean, this showing up on the exam has a low probability. Okay, like this referring to table and reading, I don't think they do that on the exams for CFA. I think if they have to make you read the table, they'll print a small table in the question itself. They'll not ask you to read the whole table somewhere. And even if that's the case, if you just remember this Hathi Ghoda Chuha technique, you can actually do this orally, just like that. And I'll show you how. It's very simple. This 10 is my mean. So this is my first standard deviation from the mean. Okay. Then this blue region is the second sigma from the mean. That means I'm moving one more sigma on the left or right. And this red region is going to be my third standard deviation here. What you're going to remember is this, that the probability density of the first sigma on the right, okay, this we conveniently call as Hathi because obviously it has the highest density. So I want you to visualize a king here in the center surrounded by his armies on both the sides. The first layer is elephants. Each elephant constitutes about 34%. Then we have Ghoda, okay, on both the side, which is a horse. This is elephant, this is horse. Each horse is 13%. Okay. And then finally we have Chuha. And each Chuha, which is a rat, is 3%. I don't know what kind of king it is, but it works for us. So Hathi Ghoda Chuha. 34, 13, 3. Now, these are technically 6 blocks. Think of it as 6 blocks. This is block 1, 3%. Block 2, 13. Block 3, 34. Then again 34, 13 and 3. Once you visualize this, all it comes down to is how many animals you have under your distribution for answering that question. For example, what percentage of CFA charter holders will earn more than 12? So when the word says more than 12, I have to go on the right. Okay. So that means I have to consider one Ghoda. This is 12, right? So I have to consider one Ghoda, one Chuha. One Ghoda is 13, one Chuha is 3. The answer to this question becomes 16%. You do not need to go to the normal distribution. Are you getting hang of it? How about more than 14? More than 14, I have to go on the right of 14. How much is that? One Chuha, that would be how much? 3%. So this is 3%. How about less than 10? So look at this. This is 10 in the center. I have to go on the left. So I have to take one Hathi, one Ghoda, one Chuha. How much? 50. symmetrical distribution, this is 50%. So you can answer these questions really fast on normal distribution with this framework. Hathi, Ghoda, Chuha, 34, 13, 3. Okay? How many of them will earn less than 8? So on the left of 8, 13 and 3, 16. Less than 6, 3%. That's it. Okay. How many CFA charter holders will earn between 8 and 12? So visualize. Now I need 2 Hathis between 8 and 12. So that will be 68%. How about between 8 and 14? 8 and 14. So how much? Now I need 2 Hathis and 1 Ghoda. Right? So 34 plus 34 plus 13. How much? 81. Okay? Now, slight twist in the question. How many of them earn between, let's say, 9 and 10? Now 9 and 10, I have half Hathi. Yes? Now there's a little trick with half Hathis. There's a little trick with all the half things. Full thing is easy, right? 34, 13, 3. Half is a little tricky. Now what you visualize is, and that's why you use the example of Hathi and then Ghoda Chuha just to fill in. You have to visualize the first half of the Hathi is heavier than the second half. First half is heavier than the second half, okay? So, if I want between 9 and 10, I can take half of 34, that would be how much? 17, but my answer would be a little more than 17, maybe something like 19. So the first half is 19 and the second half is whatever is a differential, jo 15 kuch aayega. Getting hang of it? Now, with that logic, how many charter holders will earn between 9 and 12? So, 9 and 12 means I have one full Hathi and I have half Hathi, but the first half of the Hathi, right? So 34 plus 19, 17 plus 2, 19, approximately 19. These are approximation, but they work really, really well. Are you getting hang of it? Okay. Now, sorry, how many of them will earn between 9 and 11? So again, I have 2 half Hathis, but both of them are heavier part of the half Hathis. Are you getting hang of it? I have half Hathi from 9 to 10 and I have half Hathi from 10 to 11, but these are heavier Hathis, right? Because they're first half. So I will not take 34, I will take 19 plus 19. Where did I get 19 from? 34 by 2 is 17. I'm adding a little bit more, maybe 2%. Is it okay? How many of them will earn between, let us say, 8 and 13? 8 and 13, so count. I have one Hathi here, I have one more Hathi here, but I have half Ghoda. Half Ghoda. So this is 34, but this is first half. So it should be a little more than 6.5, maybe 7, maybe 8, right? Let's say 7. Let's say 7. So 34 plus 7, 75. That's it. Okay? Will you be able to handle this? Good. Next concept, correlation covariance. Now we migrate from a single variate data to bivariate. Right now bivariate. Bivariate means two variables. Now when you want to analyze two variables and you want to look at their relationship with each other, as in how they are related to each other, you generally do three metrics. You do something called as covariance, you do something called as correlation, and you do something called as regression. Okay? Now, what does covariance tell you? Covariance can only tell you one thing, that whether the two variables are positive with each other or negative with each other, which means when one goes up, does the other go up or other go down? That's it. Covariance cannot tell you anything else. What correlation will tell you is how strong is that relationship. How strong is that relationship? Okay? And a regression will tell you a causal relationship. Causal means correlation, by the way, is not causal. That's a very good theory question. What do you mean by regression? It means when x goes up by 2%, by how much? By how much? By how much y will go up? So you kind of quantify them a little bit better. Now, it's the way to think about this is these are like steps. Okay, these are steps. For example, let's say what could first if I have two data points and I want to start analyzing, first I have to compute covariance just to get a sense of whether the data points are moving together or opposite. For example, let us say two stocks available in India in music licensing business, which is called Tips Music and Saregama. Now let's say you have a working thesis, you want to build some strategy on them. So you take data of Tips, you take data of Saregama, compute covariance. Covariance number doesn't matter. That number came out to be some 2000. We don't care. We care about sign. Sign was positive, which means Tips and Saregama are positively related, which means when Tips goes up, Saregama goes up. But it tells you only that, nothing else. Now you want to say, okay, but is that relationship strong? Right? Or is it a weak relationship? To measure that, you need what? Correlation. But then you go a step further and you say, okay, fine. Can I build some causal relationship, which means, can I say that every time Saregama goes up, it forces Tips to go up? Okay, and by how much? So if I convert that into a more measurable relationship, then it becomes regression. So 3 steps. Step number 1, what is the direction of the relationship? Step number 2, the strength of the relationship, and then step number 3, using that relationship for forecasting purposes. Understood? Covariance, correlation, and regression. Let's do an example. Let us say I have 2 data points here, A and B. Let's say A is something like 5, 7, 9, 12, 15. B is some random 12, 16, 20, 26, 32. Okay. Step number 1, we have to compute a covariance. How are we going to do covariance? So the formula is x minus x bar multiplied with y minus y bar divided by divided by n or n minus 1. That's it. That's the covariance formula. This is covariance formula. Okay. Then how would you compute correlation? So you would take covariance divided by standard deviation x, standard deviation of y. Then how would you compute regression slope? So regression slope will be covariance of x and y divided by variance of x. These are your 3 formulas. But there's a good news for you. You don't have to do the formulas yourself. I mean, you still need to know the formula, but you don't have to do the math yourself. Your calculator knows how to do it. Okay? So I'm going to show you how to do it. Please press second and 7, 6, second and 7 on your calculator. Then may say second and clear work. Second and clear work. Now you have x01 on your screen. Actually now we have to decide what is x and what is y. It does not matter for correlation and covariance, but it does matter for regression. You know? So see, it's let's keep it simple. Let's keep a as x, and I'll explain you in a bit, right? But first let's do the exercise. Please keep 5 as x01, and then y01 would be 12, and just keep on entering them sequentially. Have you entered them? Okay. Now, we are going to compute three numbers. Covariance, correlation, and then we are going to compute a regression slope. Okay? Now, what is a covariance? So on your, once you've entered this, please press 2nd and 8 on your Texas calculator. Okay? Keep on scrolling downward, you would see a number called sigma x. Look for that sigma sign. Have you found it? Put it in the first memory slot. Don't tell me, just put it in the first memory slot. Look for sigma y, second memory slot. Look for r, put it in third memory slot. Okay? Sigma x, sigma y, r, 3 memory slots, multiply the 3. How much? 25.28. Positive? Yes. That is your covariance. How to read will work on a bit. Now, tell me what was your R? R was 1. Then keep on going downwards and look for B. How much is your B? 2. Okay? Now, let's interpret the three numbers together. First, we'll learn the interpretation, then we'll get into a little technicalities of calculation. Now, stop doing whatever you're doing, just focus on the screen. Covariance between x and y is 25.28. I would have cared less if this number was 252 or 2.52 or 2.52 million, does not matter. I don't look at covariance as a number. The only thing I look at covariance is the sign. It's a positive sign. So that covariance told me, okay, x and y are positively related. Okay, which means when x goes up, y will go up. But how reliable is that relationship? Right? How strong is that relationship? That I do not know with covariance. Because I can have a positive covariance and have a weak relationship. Okay? So that will be told to me by correlation. Correlation is range bound. It is between -1 and +1. Now, when we have 1, we say that we have a very, very strong relationship. The strongest that's possible. But how about -1? -1 also means a very strong relationship. It's not weak. It just means in the opposite direction. So +1, -1 is a strong relationship. Okay? Now, if you get confused on the exam, I'll tell you a simple trick. You would say, okay, correlation 1, strong relationship. How strong? How strong? Because let's say now it's 1. What if I told you it's 0.8? Right? Is 0.8 strong? Yes. So how strong? So what you can do is you can take square of correlation. Okay, so right now correlation is 1. Take a square. How much is that? 1. Convert that to percentage. 100%. You would say 100% strong. Okay, what is 100%? 100% x can explain y. Matlab, y's behavior, y जो fluctuate कर रहा है, that I can figure out by looking at x. That's strong. Okay. If correlation is -1, take a square. 1 again, that means 100%. Again 100% I can figure out behavior of y by looking at x, but this time y will behave negatively when x changes. If correlation is 0.8, take a square. 0.8 square, 64%. So 64% of the behavior of y is explained by x. Getting hang of it? If correlation is minus 0.9, take a square. 81. So 81% of that behavior of y is explained by x. Then, what is the meaning of that regression of 2, that slope coefficient? This is also called, by the way, beta. Okay. So what it means is, it means if I were to build an equation, y is equal to a plus bx. Okay. I can figure out what y is. I can figure out what y is if I know a and b. The b is 2 here. That is the b. And in fact, in this example, a is also 2. Okay, because I designed it that way. So now see if this equation works. Take x, multiply with 2, add 2. Tell me how much are you getting? Take x, multiply x with 2. How much? 10. Add 2. How much? 12. 7 into 2 plus 2. 9 into 2. 12 into 2 plus 2. Is it working? So now see. Now we know there is a beautiful relationship between x and y, right? Covariance did not tell me much. That was a random 25 number. But covariance told me when x is increasing, y is also increasing. When I did correlation, it gave me 1. When I take a square of it, 100%. 100% of behavior of y can be explained by x. When will it not be 100%? If instead of 32, in one case it was 31. Then would the regression work perfectly? No. It wouldn't have worked, no? Because as per regression, y should be equal to 2 into 2x. So वैसे तो 32 आता. But if the actual number was 31, then not 100% behavior of y can be explained. Maybe 95% can be explained. Yes or no? Jabardasti mat bolo se. Are you understanding what I'm saying? This equation is working 100% of the time in my data set. When I take 5, multiply 5 with 2 and add 2, I get 12. Working everywhere. Therefore, I'm getting 1 square as 100%. 100% behavior of y explained by x. But in one case, had it not worked, then my correlation wouldn't have been 1. It would have been something like maybe 0.95 or something like that. That means 0.95 square, whatever that number is, that is the percentage we can explain. Okay? So I'll revert back to 32 again. And finally, if I want to actually quantify and use that relationship, then I convert that to a regression. This is called, B is called slope, A is called intercept, which in your calculator came out to be 2. And then use of that is y is equal to intercept plus slope into x. This will be learning in the regression class, where we exploit the relationship between x and y. Right now, just focus on covariance and correlation. Are we together here? Okay. Now, one more thing with correlation. Correlation captures only linear relationship. What correlation does not capture is non-linear relationships. Okay? What does it mean? It means if I plot x and y, and if my data is like this, then I'll say perfect, correlation is +1, perfectly linear. If I capture x and y, and my data is like this, you would say great, correlation looks like it's -1, negative. +1, -1. But if the data is like this, no relationship, then we'll say correlation is 0. But how about this? Is there a relationship here? Yes, but is it linear? No. So this is a non-linear relationship. Here, correlation will be closer to 0 or something like that, it will not be 1. Correlation will fail to capture anything that's non-linear. Correlation will always capture linear behavior of the two data points. And that's kind of a downside if you think about it, because in finance everything is non-linear, right? So, very interesting chart I want to show you. Right now, of course, we should look at silver chart, no? I've started selling my silver, by the way. Maybe I'm selling it too early, but I'm kind of doing a reverse SIP on silver. Every day I'm selling a little bit. I started selling last week. Originally I thought I'll not sell. I'll play the whole rally. But I don't know. I'm very skeptical with this particular move, right? This in finance we call as a parabolic move. Okay, and generally parabolic moves also exhibit an inverted parabola very soon. So maybe there's a lot of runway left, but see, this is called a parabolic move where you just go like this. You know? This is a non-linear, a linear silver move would have been like this, right? Parabolic move would be something like this. So whenever you have something like this, correlation will not be able to capture. I'll give you a beautiful example. Take this data, 1, 0, 1, minus 1, 0, 1, 1, 0, 1. Okay, please enter this into your calculator and calculate correlation. What's your view on buying physical investment grade copper? Okay, we'll discuss maybe in the break. Let's not break the rhythm. Correlation is coming out to 0. That means correlation is telling you no relationship. But there is actually a relationship. Okay, what is the relationship? Y is equal to x square. Look at this. Take x, take square. Is it working? Yes. But correlation didn't capture. Why? Because this is non-linear, right? And correlation captures only linear relationship. Okay. Now a little bit on those formulas. And what kind of question might come on the exam. So, correlation formula is what? Correlation formula is covariance divided by standard deviation of x, standard deviation of y. But whose covariance? Because we know there are two types of covariance, a population and sample. So, there are actually two formulas. Okay, what are the two formulas? If I take covariance of sample, then I have to take standard deviation of sample, and I have to take standard deviation sample of y. If I take covariance of population, then I have to take sigma of population, sigma of population. On your calculator, it actually works opposite way. What your calculator does is, your calculator gives you R, your calculator gives you sigma x, Sx, sigma y, and sy. Okay, this your data function will give you. So क्या करना है आपको? If on the exam the question says please calculate covariance of sample, okay, what you do is you take this R is same whether it's population or covariance, doesn't matter. This you will multiply with Sx and Sy. Sample standard deviation of x, sample standard deviation of y. On the exam, if the question says, please calculate covariance of population, then what will you do? You will take the same R, but multiply with sigma x, sigma y. Okay? And we're done. How many readings done? We have about 86 pages in the juice notes. We've done about 30 pages. Not bad. Yeah, let's talk something else maybe for a few minutes. What do you want to talk about? Tell me. I am not talking about CDs. 9:30, no, I think target time is right now 10:30. I'm hoping we finish early. I don't know how it goes. By the time we reach hypothesis and then we have to do parametric. What salary you want to talk about? I'll tell you my views on salary though. Opinion on Trump में क्या ही बोलूँ भाई वो साथ में क्या He's now president of US and Venezuela both. No? वो fake था रे भाई. No, that was just I don't. Is he actually enacting रे? It was just a joke, right? But a scary joke. Is FinTree hiring? Yes, we're hiring across the board, including teachers. Any one of you interested, reach out. No, I'm serious. We are hiring teachers. This year we're planning to hire 3 to 4 full-time teachers. So I'll tell you what salary though. So thing with salary, right? So let's look at different finance career. Okay, one is your non-core careers. Non-core profile would include everything and around ops, okay, which will reconciliation, accounts payable, lot of them, and then some of the core profiles. Now, what I've seen in my experiences, we were discussing about level 1 salaries earlier, right? Non-core profiles actually pay you a little bit more upfront. Okay, so maybe you earn a little bit more, maybe you can earn 6 also. Right now the markets are not good. For GCCs the markets are bad, but we've done plenty of 6, 7 like wholesale placements, 30, 40 kids in one go. We've done those kind of things. But the growth after this is fairly plateaued. In fact, the growth rate maybe initially will still be okay, but then you would definitely hit a significant plateau there. Plus, in non-core profiles, the probability of losing job is also very high because you're very likely to be replaced by AI, right? So if you're doing something which doesn't require a lot of thinking, then this is a high probability. Think from the folks who are building putting in billions of dollars in building AI engines. The easiest people for them to go after is actually GCC and within that ops. That's the biggest market. Billions of dollars. You crack one industry, you're profitable. So if we were sitting there in their strategy team, this is a segment I'll target. Easier to crack, right? Now, what's with the core profile? The thing we've noticed with core profiles is a lot of times the entry level pays are low, and probably some reason is why there's a lot of reluctance of employers to hire in core profile as a fresher. So why should they? Right? You notice everywhere they will ask for at least 2 years of 1 year of experience. And it's a classic chicken and egg problem that if no one is hiring a fresher, then where do you get your experience, right? But what we've noticed, and again and again, hundreds of case studies, you start very low, okay? And some people would take their first jump in a year, some people will wait for 3 years. But after this, you actually have a sizable growth, and for some folks, it can be a parabolic growth. Okay, so that means at a later stage of mature career, your pays are substantially better in these type of profiles. So, and therefore, I always recommend people to start working early to take the full benefit of compounding N. Plus, when you start working very early, employers are a little easy on you. You start working after level 1, they don't expect you to know a lot. You go in as an intern, work for a couple of years. Most of you, many of you are doing this along with your graduation, right? At least I can see some of you. So when you start working early, when you go to a research place, employer is not expecting कि भाई ये कोई multi-bagger stock लेके आएगा. Employer is expecting कि time पे office आ जाए बस, you know. Now, and that's a real challenge with, unfortunately, with some of the people we have recruited in this age group. When I sit with them, the basic work ethics and integrity, we have those kind of issues in that particular age group. So those people who just do the basics right, for some time, for us, they're like great resources. But you learn the skill, and you hang on in a good profile for some time, then suddenly your demand in the market goes up. Just had one case yesterday. I was in Mumbai, student called a couple of times. I knew he was in an interview, so I gave him a call back. He, level 2 candidate, I guess. Gunik is his name. He got placed through us in one investment bank here. Very low pay. About 3.5. Worked there for a year. Second job, investment bank in BKC. He was negotiating salary, so he asked them some 13, 14. Then he called me, मैंने बोला बहुत ज़्यादा मांग रहा है तू. He was like, ठीक तो मांगा मैंने कहा बहुत ज़्यादा, you're asking for too much. He negotiated, he said, sir, they're offering 9, I've given them a final of 10, I'll settle somewhere in between. It's not great salary in Bombay, by the way. Right, you're below poverty line at that salary also in Bombay because your cost of living is so high, but it's okay. Right, it's okay to start because he is in, now that profile is in IB in defense and those kind of spaces. Now imagine you acquire that skill for 3 years in that place. Now you're one of the very few people in the country who can crack IB deals in defense space, which is such a difficult space to be in. So now you get into the top tier people where supply of your skill is extremely low in the market. So value becomes very, very high. Therefore, profile and your boss in your first few jobs is extremely important even than your brand. JP Morgan, in fact, I would recommend don't work with big brands. Don't go to JP Morgans and GSs of the world because larger the organization, more narrow and specific the work role is going to be. Instead, go and work with boutique folks. Right? Work with a 10 people team, 5 people team. I think you end up doing substantially better that way. Hire me as a student, sir. You hire me as your teacher, why? Easy way to do it. Go on FinTree website and just click pay. How many countries have you visited? I don't know. काफी उम्र हो गया है मेरा ना तो of course by the time you reach my age you would also travel quite a bit. Is it true that level 1 exam has decided subjects in the first session which are yes, that is true, but I don't know which one. Does anyone? This is morning, first session and second session subjects are different, right, at level 1. Do you know that? Just go and Google, yes, but that's true. If you start writing again, let me know. I'd love to join you. Sure, Anirudh. Okay. Ready for the next one? Karna? Okay, good. So now we do probabilities. We have to do expected value, we have to do variance, and then we'll go to total probability. So let's start doing the basics first. Probability tree. Okay. Example 1. What would be your 10th year pay, since we are talking on salaries now? And I think that's one way to keep you engaged in the session. So we'll create 4 scenarios. Scenario 1, scenario 2, scenario 3, scenario 4. Okay. As I told you, if you get into right profile, your compounding is very fast. My guess is that compounding rate could be, average compounding rate over 10 years should be about 20%. That's my guess. Otherwise, in India, inflation is at 5-6. Everyone else will grow at 5-6, you would grow at 20%. How much would your pay be? Let's do the math. Let's say you start with a simple 3 lakh rupees per annum, second clear TVM, 3 present value, 20 IY, 10 N, compute future value. 18.5. Okay, so median number for a lot of people would be somewhere around 18.5. Let's keep that as our maybe let's say a base case scenario, 18. That's your salary 10th year out. But then there would be some laggards, some folks would probably perform less. So maybe some people will not grow, maybe they'll remain at 12. Okay, but then some people will grow faster, so maybe let's say some folks will reach at 30. And then since it's a distribution, there will be some right skew, and let's assume some of you would probably easily reach 100. Actually 100 would also be less, some of you would probably make a lot more money than that. Okay, so now this is your different scenarios. For each of the scenario, we assign a probability. Okay, so this is your salary, we assign a probability to each of the scenario. Now, how do you find out probabilities for your scenario? Depends on how optimistic you are in your modeling. So I'm going to do subjective scenarios here. So I'm going to assign this a 20% probability, this a 40% probability, this a 40% probability again, some clustering in the center, and I'm going to assign this a 20% probability. ज़्यादा हो गया क्या? 60 हाँ, so इसको 30 करो, 30 30 and 30. Now based on this information, what is your expected salary 10 years from now? Expected salary 10 years from now. Okay, so how would you do it? Simple, 12 into 20% plus 18 into 30% plus 30 into 30% plus 100 into 20%. So let's do the math. 2.4, 5.6, no 5.4, and then this is 9 and this is 20. Take a total, how much? 36.8. This is called expected value in the probability world. In probability world, when we say something is an expected value, it actually means a mean, nothing else, just a mean, which is nothing but a weighted average of sorts. Okay, now how would I convert this to a standard deviation? What is the standard deviation of these salaries? So your regular standard deviation formula is what? X minus x bar squared summation divided by n. Dividing by n under root, yes. Now dividing by n means what? Dividing by n means you're assigning equal probability to every observation. है ना? So if I have 4 observation, every observation gets what probability? अगर 4 ऑब्जर्वेशन है, सबकी प्रोबेबिलिटी सेम है, so everyone gets 25%. But here the probability is different, right? So the way we modify the formula is, instead of dividing by n, we just say probability multiplied with summation of x minus x bar square under root. Done. And I am showing you this so that you can derive the formula on the exam. Instead of dividing by n, we just multiplying with respective probabilities. That's it. Now you can do this manually, but the good news is your calculator knows how to do it. So I'm going to show you. Even this is known, but it's a little tricky, this one. Okay, so you have to do this with me. Please press second and 7 on the Texas calculator. Now, you have to be a little careful here. What you want to do now, in X column, you want to enter the actual salary data. So 12, 18, 30 and 100. 12, 18, 30 and 100. Wait a minute, don't do anything. रुको थोड़ा. In column Y, you have to enter probabilities. Now when you enter probabilities, please make sure that you are entering 20% as 20. Not 20%, 20. Okay. In the same way, 30, 30, 20. 30, 30, 20. So do that and don't press second and 8, just wait for me. Second and 7, enter this data. Yes, done? Okay. Now, the thing is, right now, your calculator thinks that x and y are two different variables. But y is actually not a variable. Y is what? It's a probability. So you have to let calculator know that I have a single variable. And you can do that by switching the setting of the calculator in the stat function. So please press second and 8. By default, it would have linear on your screen. You know? Now keep on pressing second and set till the time you do not see 1-v. That 1-v stands for one variable. Okay? Once you've reached one variable, now your calculator knows that y is nothing but probability. A quick test on that, when you press downward arrow, n should show equal to 100. Or it will show an error. Try it. Switch it to 1-v and press downward arrow. Is it showing n is equal to 100? Yes. On the exam, if you see an error here, it means you have not entered y column correctly. Only when your y does not total to 100, it shows an error. Okay? Now keep on pressing downward arrow and look for sigma x. 30? 32.27. That's it. That is how you calculate sigma when you have probability data. Okay, now good news is this also calculates mean actually. Go and look for x bar. It should give you that 36.8. Do you think you can do this? Okay, I want you to try one. Let's see if you can solve. Let me give you x values. Let me give you probabilities. 3, 5, 10, 12. 30%, 35%, 15%, 20%. Please calculate x bar and please calculate sigma x. कितना है? 6.55. Sigma x 5.51. मीन कितना था? 6.55. Done? Easy? Good. Now, total probability rule. Now, this thing I would like to combine with Bayes' theorem. After a break. Let's do a break. We're doing a we'll do a slightly longer break now. 30 minutes. We'll do 30 minutes because then after that I have to do a very comprehensive probability example to cover all the scenarios in one. इंटरनेट बंद है. एप्सिलॉन में शिफ्ट करू का? इंटरनेट बंद आहे. झालं. मला फक्त गरम पाणी ठेवायचं थोडं कपमध्ये, काहीच नको. Yeah, Vishal, you'll have to put me back in the frame. I think camera has moved. I'll show you the camera. Okay, I think this is all right. Should be fine. Yeah, so it was, this was a few years ago. Bought a new car. I was from showroom. I was going to my house. And I had to get some photocopy done on the way. So I parked my car and I was just about to get down. It was parked properly in the corner of a road. A lady came from behind, race, and it just hit the car. And then I got out and I tried to be a gentleman there. I asked her if she was okay and just being respectful. And then she got very aggressive at me. But then, and I think it happens, I think people are very, I don't know, I think we don't have very good, these things are not taught to us in the school way. And probably we need as a country someone to teach us like basic thing, right? For example, not jumping a queue, being respectful towards other people. It's
also fear-driven, right? Like every time you default or like that, you do something wrong, or then your insurance keeps going up, and people eventually have started.
that is true, yeah.
I have a friend who had an accident. His insurance is more than what he pays for the car.
That is true.
So I
Yeah.
think it's also a fear-driven motivation. I think we should do that here also.
Yeah, and the pedestrian rights. In the US and India, like what pedestrian, right? Who cares about pedestrians in India? And in fact, there are a lot of roads in India where there is no space for a pedestrian. Like forget pedestrian rights, there is no, the whole thing is road. There's nothing to walk on. It's crazy. And honking. And those of you who feel Pune honking is a lot, go to North India. No, should go to North India. People start honking the moment they leave their parking. I'm sure parking में बैठने के बाद ही एक हाथ हॉर्न पे जाता है. Deepak says, according to Elliott wave theory, silver is ready to move in a correction wave, so correction is on the way. It's bad only if you follow rules in India. Yeah, there's some things only we understand. I remember I was in, I forgot somewhere in Europe I was traveling, and it was a group, a bunch of folks, right? And there was a road, I had to cross a road. There was a car, it was like a lane, and there was a car at the beginning of the road. I was quite far. And in India, it's a very easy cross, right? But I was crossing with someone who was not Indian. And I crossed, and then that person followed me, and then they panicked. I was like, why did you cross? We are so cool with crossing. Like Indians, we are so chill, right? We are not scared of our lives at all. If the car crosses, it's their problem, not yours. My house is on the main road. I know honking. Yeah. Yeah, houses on the main road is a punishment in India. It'll be helpful if you keep these sessions on the weekends. Due to my office schedule, unfortunately, I'm unable to join. Yeah, Mohit, I would have loved to keep them on weekends, but I'm teaching the regular program. Since I teach every weekend for CFA, FRM programs, so I did not want to distort that schedule and plus do this. But a good workaround, it's on YouTube. It's going to remain there, so you can always watch it whenever you have time. Sir, Bihar jao, you will go deaf. Yeah, that's actually one state I haven't traveled at all. And honestly, I'm a little scared. I don't think I'm cut out for Bihar. Like, I just don't feel like I won't survive well in that state. I haven't done much of UP and Bihar. Though I had the courage to go to Banaras. No, I went to Banaras during Kumbh Mela. And that too on that main, it was called Mauni Amavasya Day, where I think, I don't know, that was the highest, highest footfall day. It was just experience. That's the only word I have. And it was insane. I mean, it's something, it's very difficult to believe until you see it in person. Just crazy. And when we reached to the river where you're supposed to take a bath, right? When we reached, I think I was with my mother. She was very enthusiastic, so she was the motivation. And we walked for like 30 kilometers to reach there. And I went closer to the water. She said, bottle mein pani bhar ke lo, all of it. So I went and tried to do it, and that water was stinking. And it was stinking so bad, I just ran away from that place. It's like, I'm not doing this. Yeah, and some people died, by the way, when I was there, just, I think, a kilometer ahead of me. There was a stampede. So I was lucky. It was just like, I was 10 minutes behind that stampede. So just got lucky. And good for you, otherwise there wouldn't have been this crash course. So I don't think so. Waha roads honge. I got stolen IG lol. Okay. It got stolen. What? Road got stolen. Achha. क्या रोड गॉट स्टोलन? हाँ? क्या रोड चुराते हैं? ब्रिजेस चुराते हैं? That is true. I've heard stories though, some of my biker friends who've, once I was very ambitious. I thought I'll do a cross country and go to that region. But then I went to speak to some of the experienced bikers, and I asked them if it's a good idea. I said, "Mat kar." So I was like, "मैंने नहीं किया." Carry a gun. Very nice idea, ma'am. बहुत ही अच्छा सिखा रही हो, हाँ? चलो, let us start. Let's start. Someone says in Sri Lanka, the capital and urban cities are noisy, but other than great country. Yeah. I think, yeah, I mean, I've been to Sri Lanka, I think, a couple of times. I really enjoyed it. I, in fact, drove through, I went on the other side. I kind of remember, that was quite some time back. Okay. All right. So now, probability. Need your 30 minutes. This, what we're learning now around that concept, I am very, very certain that you're doing maybe at least a question. I think you do more than one. Okay, results are out. That's a good news. बच गया ना 7? हाँ. Okay, I haven't received any message yet, so I'm not sure. All right, let's start. Probability now. Focus, everyone. So, first, a total probability rule. Okay, what's a total probability rule? Let us say probability that you will study is 60%. Probability that you will not study, which we call as study complement, 40%. Now, in each of the two scenarios, you will either pass or let's just call it fail. Okay, pass or fail, pass or fail. Now, if you study, there's a 90% chance you will pass, 10% chance you would fail. If you don't study, 30% chance you would pass. Still, the probability might work in your favor, and 70% chance you will fail. Based on that, if I ask you, hey, what's the probability of passing? This is called as an unconditional probability. Okay, so you apply a total probability rule. Understand how. So there are two scenarios. One, probability that I will pass given that I study. That's how we read this, right? So how do we read this 90%? It's a conditional probability. So you would say, दो तरीके हैं pass करने के, two ways in which I pass. I study and I pass, or I don't study and I get lucky and pass. So these are the two areas where I'm passing. First one, 60% probability that I will study, and after that 90% probability that I will pass, or 40% probability that I will not study, and after that 30% probability that I will pass. In probability world, whenever we use the word or, we use the plus sign. Whenever we use the word and, we use multiplication sign. So 60 into 90% is how much? 54, and this is 12, and your total probability is 66%, which is your total probability rule. Okay. So what I'm going to do now is set up one comprehensive example. We will probably set up the same one, and then using this comprehensive example, we will solve all possible probability questions you might see on the exam. Okay, so let us start. I'm building the tree for you here. Probability that you will study, probability that you will not study, which I'm going to call as study complement. Probability that you would pass, probability that pass complement. Probability that you will pass, probability of pass complement. Let's keep study probability at 70. Not studying, notice how there is a C superscript here which shows a complement. Complements means opposite. So if the probability of study is 70, probability of study complement is 30. Then probability of passing 80. So let's keep this probability of passing 20. Not passing 20. Probability of passing here, let's say 40. Probability of not passing 60. Okay. Now, based on this information, what you want to do? A, find out all unconditional probabilities. B, find out all joint probabilities. And C, find out all conditional probabilities. Find out all conditional probabilities. Alaga pasto. Okay. Now, I will solve this for you. I just want you to observe how to do it. Whenever you see a tree like this, okay, the first leg of the tree or first branch of the tree where you start typically is supposed to be an unconditional probability. Okay, so these are your unconditional probabilities. So we have two unconditional: probability that I will pass and probability that I will study, probability that I will not study. These probabilities that you see in the second stage or second branch of the tree, okay, these are called, anyone knows? Conditional probabilities. Okay. Now we have to use this and find out all unconditional, all joint and all conditional probabilities. So let us start doing. Let me just create a nice tree one more time so that we can start listing them together. Okay. I'm just repeating the tree one more time. Probability of S complement, probability of P complement, probability of P again, probability of P complement. So far the probabilities which are given to us, 70%, 30%, then we have 80, 20, 40, 60. थोड़ा आवाज कम करेंगे प्लीज. 80, 20, 40, 60. 40 and 60. All right. Now, step number 1. Let's compute joint probabilities. Joint means two things happening together. Okay. Now, whenever two things are happening together, we use the word this and that. This and that. So, and means multiplication. So, probability that I will study and pass. Study and pass. So, how will I write it? I will say SP. SP to indicate दोनों भी चीजें साथ में हो रही है. Both the things are happening together. S is happening, P is happening. S is what? Study. P is what? Passing. So 70 into 80. 56%. Okay. Then S P complement. 70 into 20. So what does this mean? It means I studied but did not pass. Study and not pass, this will be 14%. Then S complement P. 30 into 40, how much is that? 12%. And S complement and P complement, that will be 18%. Is it okay? Now, fine. We have joint probabilities. Okay. Let's start making what all things can we calculate from this. First, let's compute unconditional probabilities. Unconditional probabilities. Okay. What do you mean by unconditional? It means some event happening by itself. Has something gone wrong? 40, 60, 80, 20, 70, 30. Atul Beni says pass is 68, not 32. Sorry, where is that? I don't know. Okay, let's. Now, which unconditional probabilities can I calculate? First, I can calculate probability that I will study. Now, I don't need to calculate that because it's already given to me, which is how much? 70. Okay, given to me. But, I could find probability of study using my joint probabilities. Okay, how? Now I want you to listen. If you miss this, if you're multitasking right now, you might miss what I'm saying and then it will be difficult. So stop doing whatever you're doing, listen to this carefully. If I want to find out probability of study from here, all that I need to do is find out situation in which S is true. So this is a SP, this is a SP complement. Notice we have S here, right? All that I'm going to do is come to my joint probability matrix and add up the two. 56 plus 14, that's equal to 70. That's an alternate way to find out probability of study, though it was given in the question. Now, probability that you will not study. Okay, now probability of study is 70, so not study is 30%. An alternate way, go and look for S complement. Where is S complement here? Here and here. 12 plus 18. How much? 30. Great. Then let's find out probability that I will pass. Okay. Now, to find out probability of passing, which is not given directly, I have this probability of passing here, okay, but this is a conditional probability. By the way, I should not write it like this. I should write it as probability of passing given studies here. Okay, this is passing given studies, passing given no studies, passing, not studying. Okay. So again, how will I find out probability of passing? Please look at this very carefully. Again, I go to my joint probability matrix and look for situation where P is true. P is true where? Is it true here? Do we have P here? No. Do we have P here? Yes. Do we have P here? No. So 56 plus 12. So 56 plus 12, how much? 68. That's unconditional probability that you will pass. Probability that you will not pass. Now, just by looking at this, I know this is 68, so that should be how much? 32. But let's follow the same drill. Come to joint probability, look for probability complement. Is it true here? Yes. Is it true here? Yes. So 14 plus 18. 14 plus 18. How much? 32. So this is how you get your 4 unconditional probabilities. Is everyone okay with this? Now, we can also get 4. In this situation, we will have 4 joint probabilities, which we've already done. Joint probabilities. Okay. What are the 4 scenarios? Study and pass. Study and pass complement. Not study and pass. And not study and don't pass. Okay. How would I find that? Easy. SP 56, joint probability 70 into 80. So this is 56. SP complement 14, 12 and 18. So these are my 4 joint probabilities. Okay. Now I can also find some unconditional probabilities here. Sorry, some here. Which conditional probabilities? I will have a total of 8 conditional probabilities. Okay, so see, just with a small probability tree, we can calculate so many different probabilities. And I want you to kind of be able to do anything from anywhere. First probability. Probability that I will pass given that I will study. Now what do you mean by given that? Given that means it's conditional. कि पढ़ाई किया तो पास करेंगे, है ना? Probability that I will pass given that I don't study. Probability that I will not pass given that I study. Probability that I will not pass given that I don't study. Okay? Now, these probabilities are already given to you on the table. When I say probability that I will pass given that I study is nothing but given that I am studying, the probability that I will pass is how much? 80. So this is already given to you. This is, no, this is not 20. Probability of that I pass given that I don't study is 40. Okay. P complement S. P complement S, where is that? P complement, that means don't pass given that I study is 20. And finally the last one is 60. So these 4 are also done. Now the last 4, which is what? Which is probability that I will study given that you pass. Probability that I will study don't pass. In fact, we should do the other probability first. Probability that I will study complement pass. Probability that I will study P complement, probability of S complement given P complement. Okay. Now on the exam, if you see that your tree is built in this structure where it was given S. So S was an independent event, P was the dependent event in this structure. When it inverts in simple language means P given S became S given P. Ulta ho gaya. Then you know that you have to use Bayes theorem. Okay, so those are Bayes theorem questions. Okay, how would you know Bayes' theorem? When P given S becomes S given P. That means something that was unconditional earlier. Simple technique. Okay. First, you figure out what is your denominator to find out that probability. Where will you find your denominator? Please listen carefully, don't do anything. Denominator, you have to actually find out probability of P, which is there in the denominator here, like the way it's quoted. You just have to find out probability of P. Now from joint probability table, we know that probability P is 56 plus 12. You know? So here denominator is 56 plus 12. 56 plus 12. Then find out probability of P complement. Okay, so P complement is here and here, 14 plus 18. So 14 plus 18, 14 plus 18. Now, what will you take in the numerator? In the numerator, you have to take one of the two numbers. You have to take the one that represents S scenario. So look at what is 56 and what is 12. 56 is study and pass. 12 is study complement and pass. Which one is a S scenario? 56. So here numerator is 56. Here numerator is 12. In the same way, look at P complement, 14 plus 18. 14 plus 18 here. Okay. Study pass complement, not study pass complement. Okay. So which one has S in the numerator? 14. Which one has this? 18. So with simple probability tree, we can calculate so many different probabilities. Now, because this area is important, I want you to do one. Do you think you'll be able to do it? Okay. You try. Let's see if you can do it. Probability of A given B. In fact, I'll start with probability of A first. 60%. Probability of B given A, 40%. Probability of B given A complement. B given A complement, 25%. That's it. Now, only based on these three numbers, what are you going to calculate for me? First, calculate 4 joint probabilities. Second, calculate 4 unconditional probabilities. And third, calculate 8 conditional probabilities. If you've learned to do that, then you've championed the whole probability game. Come on, pick up some speed. I'm going to wait for maybe 2-3 minutes and start doing it myself. Done. Doesn't take a lot of time. I'll give you some hint. If A is 60, then A complement is how much? 40. Now B given A is 40. So B complement given A is how much? 60. B given A complement is 25. So B complement given A complement 75. So now tree is ready. Now calculate joint probabilities. Convert them to your unconditional 4 probabilities and then calculate your all 8 unconditional probabilities. Come on, pick up some speed. I'm solving this now. How many of you have been able to do all the probabilities? Come on, give me a hand raise. Let me put you on the camera. करो करो थोड़ा दिखाओ यार अच्छी बात है हाँ दिखाओ. How many of you got this right? Very nice. That's about 40-50% people here. Very good. Online, if you've been able to do all of it, give me an I pass. If you're able to do maybe 70-80%, फिर क्या? I pass 70% दे दो. Okay. Let's solve. It's easy. It's once you get hang of it, you realize probability is so simple, right? There's nothing to it. Of course, some part of it you learn with practice, but this part should be easy. The first question you would get on the exam is when I start. Chalo, abhi awaaz band, please. Now just look at the screen. The first question you would get on the exam is where do I start the tree? Okay, so I'll tell you a hint. You have to build the tree. Start the tree with the events which are given as the unconditional events here. B is a conditional event, A is an unconditional event. So you start the tree with, or simple denominator. It's not denominator, but think of it that way. So it's easier for you to memorize. So tree will start with A and A complement. Okay, so this is A, this is A complement. A complement is 60. So A is 60, so A complement is 40. Then obviously we go to B, B complement, B, B complement. B is how much? B given A is 40. That means A is given. How much is the chance for B? 40. This has to be 60. Then B given A complement 25, 75. Bas, itna hi hai. Once your tree is built, after that is very, very simple. Now what you do? You would say joint probabilities. AB complement, A complement B, A complement B complement. Okay. So 60 into 40, 24. 60 into 60, 36. 40 into 25, 10. And 40 into 75, 30. Done. How many of you got this part right? Okay. That's almost all of you. Very nice. So 4 joint probabilities are done. Okay. Now how do I do unconditional probabilities? So probability of A. Now I know the answer is 60, but how do I do it from here? Look for all the A's. A is correct here and A is correct here. So 24 plus 36. Probability of A complement. So A complement is here, A complement is here, 10 plus 30. Probability of B. So where is B? B is here and B is here. So 24 plus 10. And probability of B complement, 36 plus 30. Okay. So now my unconditional probabilities are ready. Now let's start doing conditional probabilities. So what do we have? We have probability of, we'll start with first B given A, B given A complement, okay. Then probability of, और क्या रह गया इसमें? Actually, I should have kept it as, wait a minute, sorry for this. B complement A, and then this should be B given A complement and B complement given A complement, and then let's do other ones also. Okay, so let us do probability of A given B, A complement B, then this should be what? A given B complement and A complement B complement. So these are my total 8 conditional probabilities. Now some of them are actually given to me directly in the table. Okay, but this time around, just for fun, we'll follow the same Bayes theorem logic and you'd realize it works everywhere. Okay, so first I'm going to solve denominator. The trick to solve denominator is to put that A here. Okay, put that A complement here, put that B here, and put that B complement here. Alright, so let's see if that works. A, probability of A, 24 plus 36, no? So here denominator is 24 plus 36. 24 plus 36. A complement is 10 plus 30. So 10 plus 30, 10 plus 30. Then B is how much? 24 and 10. 24, 10. 24 and 10. And B complement 36, 30. 36 plus 30, 36 plus 30. Okay. Now, once you've done this, how do you find numerator? Out of 24 and 36, find out when B is true. So 24 is B true? Yes. So here numerator is 24, here numerator is 36. In the same way, out of 10 and 30, find out where B is true. 10 and 30, where is B true? First one, 10. So this is 30. And finally, out of 24 and 10, find out where A is true. So 24, kahan pe gaya? 24 and 10, where is A true? 24. So this is 24, this is 10. Out of 36 and 30, find out where A is true. 36 and 30, kahan pe? A is true is 36. So 36 and 30 and done. That's it. What do you think? We started with 3 probabilities. And with the help of those 3, we were able to derive 16. किसी भी तरीके से question आएगा exam में, we should be able to handle it. Now the only layer to it is language. Right? This is where I'm just giving you a number, we are computing everything. On the exam, the question will be framed as probability that EPS will go up, this will go down. So you should be able to figure out how to put that in the tree and then solve. फिर हो गया. Do you think you can do it? कुछ confidence दिखाओ भाई, हाँ नहीं. Okay, ठीक है. So total probability is done. Bayes theorem is done. Next reading is portfolio mathematics. Good news, we've done some part of it. Let's do the portfolio standard deviation formula. We'll be doing this in depth in portfolio management class. Portfolio mathematics. Question number 1. 10 star. 10 star. 3, 3, 6, 8. Thus. Now what's with 10 star? You have two asset portfolio. Expected return 10%, 25%. Standard deviation 8%, 20%. Correlation 0.7. Weight 60%, 40%. RFR 5%. Compute Sharpe ratio of the portfolio. Now when you compute Sharpe ratio of the portfolio, you will have to compute mean return, you will have to compute standard deviation, and then you will be able to compute Sharpe ratio. So out of the three, one of the three will definitely come, it's my guess, therefore a 10 star. Alright, we have someone on the chat box saying I've passed my CFA level 1, Aditya Joshi with 1710 score. So congratulations Aditya, that's a great news. 1710 is a fantastic score. The minimum passing score is 1600, so you scored 110 more. It's great. Uday Patel passed with 1765. Nice. Congratulations, Uday. Feels good, no? हमारे साथ भी होगा. पास तो आएगा. $1710 means how many answers were correct out of 180, 1800? I don't know if upper cap is 1800. Is it 1800 upper cap? 1900 है शायद. हाँ. 1835. Who is that? Mahapurush. 1835. Crazy. Yeah, but I don't know if he can slice that in percentage terms. $1900 is the upper cap, right? Okay, are you done with this? It's easy. So what do you need to do? 3-step. Step number 1, expected return. How do you get expected return, weighted average? 60% into 10% plus 40% into 25%. 40% into 25%. So that's 6 plus 10 is 16%. Standard deviation. Weight 1 sigma 1 square, weight 2 sigma 2 square, 2 weight 1 weight 2 sigma 1 sigma 2 correlation. Some people who are seeing this for the formula for the first time, it's a little intimidating. But you do it a few times, you get used to it. So 60% into 8%. 60% into 8% square plus 40 into 20 square plus 2, 60 into 40 into 8 into 20 into correlation kya tha? 0.7. And then you put the whole thing under root. If you remember, okay, some of you might remember this. When you solve, do it in 3 parts. This you put in STO1, STO2, this you put in STO3. Solve the 3 independently, add them up, put under root. Tell me how much? 11.86 percentage. That's your standard deviation. And once you have standard deviation and return, then how do you get your Sharpe ratio? So your Sharpe ratio is return on the portfolio minus RFR divided by sigma. Return on the portfolio is 16. RFR is 5. And standard deviation is how much? 11.86. Done. How much? Easy? Okay. Now one trick on this, and we've highlighted that really well in the juice notes here. Notice. We just did this some time back. Sigma into correlation is equal to what? Covariance. So in this formula, the last 3 terms you can replace with covariance. Okay. All right. Now, how do you calculate covariance with joint probability function? I think this, I mean, there is a method some of you might have seen my main videos. There's a Rangoli method and 3-4 method there. I don't think this calculation, of this intensity might show up on the exam. So I'm going to take a pass on this one. Just taking a calculated call. But again, how to do it is use the same. I'll give you a general framework, how to create your own formula. You know the normal covariance formula. What is it? Summation of x minus x bar, y minus y bar divided by n. The moment you introduce weights, you can't divide by n. Because n means equal weights. So what you do? You multiply with p. So formula becomes summation of probability multiplied with x minus x bar, y minus y bar, khatam. Have a look at this later on, maybe. But again, if you're writing in Feb, maybe it's okay if you decide to give it a pass. Mean variance, MVP, we learn in depth in portfolio management classes. So I'm going to skip through it. Let's do safety first ratio and shortfall risk first. Okay. Shortfall risk means what? Probability of, it's a probability of earning less than what? Certain benchmark or threshold, less than certain target. Okay. Now the good news is you already know how it works. Okay. ध्यान से देखो. What is this? Normal distribution. Let's say थोड़ा आवाज कम करो यार पीछे, जहाँ से भी आवाज आ रहा है, that corner. thoda please. Mean return, let's say is 10 percentage. Okay. Standard deviation is, let us say, 2 percentage. Let's create that normal distribution chart. 10, 12, 14, 16, 8, 6 and 4. Okay. Now let's say they'll give you data like this, and then they will tell you that you have a client who says that minimum acceptable return for me, minimum acceptable return, let us say is 8. कम से कम मेरे को 8% चाहिए. Now what is the chance that the client will earn less than 8? Okay. So you've already learned that 10 to 8, this region belongs to whom? One Hathi, right? So when we say less than 8, what are we looking at? We're looking at one ghoda here between 6 to 8, है ना? And then we have one chuha on this side. Okay. So one ghoda plus chuha, how much would that be? 16. So there is a 16% chance. There is a 16% chance client will earn less than 8%. That's your shortfall risk. So shortfall risk is that simple. Probability that you will earn less than the threshold return. Easy? Now what is the Roy's safety first ratio? Roy's safety first ratio is simple. This is the formula. You remember the Sharpe ratio? Kya formula hai Sharpe ratio ka? Return on portfolio minus RFR divided by standard deviation. Just replace this with the minimum acceptable return. Done. So what is the minimum acceptable return? So RP is 10, minimum acceptable return 8 divided by 2, how much would that be? 1. So your Roy's safety first ratio is 1 and your shortfall risk is 16%. Okay. Let's move forward. This again we'll learn in the PM class, so I'm going to skip it here. And there you go, reading is over. Next reading is simulation method. I'm not taking a break, I'm continuing. Kare na? Ek aur khatam karte hain. Let's do simulation method. Simulation method. First concept is log-normal distribution. Now, how does a log-normal distribution look like? A log-normal distribution looks like, of course, I don't have the skills to draw them, but somewhat like this. What do you see is the property here? It's right skewed. Right skew. And one more property, anyone? It's bounded by 0. Bounded by 0 means what? Negative नहीं हो सकता. It cannot be negative, values will only be positive. Okay, now if you have a log normal distribution and if you take a natural log of your distribution, then it converts into a normal distribution. So this is a normal distribution. Okay. So typically, where is log normal distribution useful? It's useful in scenarios where you feel asset values will not go negative. Asset values don't go negative, right? So very useful for modeling asset values. Very useful for modeling asset returns. Asset returns. Those are the main differences. Continuously compounded, we've already worked on. So this part I'm going to skip. This part, again, is a pick. I'll give it a 3-star. So, if I would have definitely put this one on your test, And why? Because used very heavily in practice, this formula. It's called sigma scaling rule. Okay? How does the sigma scaling rule work? ध्यान से देखो. Let's say duration, return, and standard deviation. Let us say 1 day is the duration, your return is 2% and your standard deviation is 1.5%. Okay? Now this I want to convert into 1 week. So daily I want to convert to weekly. Now typically in a week, how many days? 5 days. For us, 5 days. In a year, we have only 250 days. 252. क्यों? Markets बंद है ना? So Saturday, Sunday markets are closed. So number of trading days 252 in a year, 5 days in a week. When I want to convert a daily return to weekly return, what I'll do is I will do 2% into 5. But when I want to convert a daily standard deviation to a weekly standard deviation, I will do 1.5% into under root 5. Sigma scales with root of time. Okay. Now this you want to keep in mind. How is this important? Think of a situation where I tell you monthly standard deviation is 3%. What is annual standard deviation? Some of you might think it's 3% into into 12, but it will be 3% into under root 12. Sigma scaling rule, very useful in risk management world. Standard deviation scales with root of time, not directly with time. This goes into assumption. You can watch main videos for that in terms of how scaling works with root of time. And this primarily comes from the assumption of normality. But I'll give you simple way to think about this. Think of a variance formula and think of a standard deviation formula. When I'm doing variance, x minus x bar square by n. You know? So think of a situation where my x is increasing. If my x is doubled, all the values of x bar will also double. You know? So this numerator will be double, therefore variance will be double. But think of standard deviation. Standard deviation is x minus x bar square divided by n under root. So when my x values double, variance will double, but standard deviation will not double, it will increase by root of 2. Did you understand what I'm saying? जैसे ये ओरिजिनल फॉर्मूला है ना, अब इसको 2 से मल्टीप्लाई कर दिया, so variance double हो गया, but that under root 2 is what will carry forward in this formula. So that means I'm multiplying with what? Root of 2. This is a simplified explanation. There is something else to it, but we'll stick with this right now. Okay. Monte Carlo. CFA Institute loves this. This repeats in all the 3 levels and maybe repeats in all the subjects, everywhere. So get hold of the concept. Monte Carlo simulation. What is this? I'll give you a maybe a real life example. Think you have a client, okay, a family. Let's say a family of 4. Let's say this family of 4 today has a total net worth of let us say 2 crore Indian rupees. Okay, and monthly income minus expenses saving, or let's say monthly SIP, they can afford to make maybe 50,000 rupees. 50 come ho gaya, let's say 1 lakh rupees or 100,000 rupees. Now, they want to retire in about 40 years, 30 years. In between, this kid will go to college in third year, this kid will go to college in, let's say, 12 years. This kid will take inflation adjusted 0.3 crores, this kid will take inflation adjusted 0.7 crores. At 30 year, when the couple retires, you have calculated that they have to have a minimum corpus of, let's assume, 8 crores to take care of their retirement. Now, this is a very realistic scenarios that one would build if you're helping your clients figure out how much to save and how to invest. Now, a big question that you would have in practice when you're working on problems like these is, how do I split clients' asset allocation? Okay, so generally what you would do is, you would build 2 or 3 model asset allocations, A, B, C, D. In asset allocation A, equity will be 20, 30, 50, 70. Okay, debt, just for simplicity, I'm rounding it off, finishing it in 2 assets class. Of course, not adding gold or anything else. Now, which asset class is good for the client? Should I do A for them, B for them, C for them, D for them? Okay, now that's a very complex problem to solve, because the idea is, this is going to compound over a long period of time, right? So what you do is, you make certain assumptions. Assumptions about what would be the returns on equity, what would be the returns on debt, what would be the correlation between equity and debt, because that will determine your volatility. Then you say, okay, if I choose asset allocation A, all right, and then equity return turns out to be 10% and debt return turns out to be 6%, then how much that money will become by the end of year 8? But what if equity becomes 12% and debt becomes 8%? Or what if equity reduces to -5 and debt increases to +12? कुछ भी scenario हो सकता है ना? So you will ask your software to build 10,000 different scenarios. Okay, and in 10,000 scenarios, the software will compute what will be the remainder future value. Software will also, in your software, you can also make assumption of what will be the university fee. उसको भी variable कर सकते हैं. So then, your software will give you, for asset allocation A, 10,000 ending values. Now you just calculate what is the probability client will have less than 8. Because retirement के लिए कितना चाहिए? 8. So what is the probability client will have less than 8, which is nothing but shortfall risk. And then you compute that, okay, if I do asset allocation A, on an average, shortfall risk is coming out to be 60%. Now how do I know what is the probability of less than A? So remember, I simulated 1,000 returns or 10,000 returns. So these are 10,000 portfolios. Some of them will give me value more than 8 crore. Some of them will give me value less than 8 crores. I just have to count out of my 10,000 how many portfolios were less than 8 crores. Are you understand? In the same way, I will do the same exercise with portfolio B. And maybe in portfolio B, my shortfall risk came out to be 40%. Maybe with portfolio C, it will come out to be 25%. Maybe with D, it will come out to be, let us say, 27%. So then for my client, the suggested portfolio will become C, the one that minimizes the shortfall risk, the one that minimizes the probability of not meeting their financial goals. All right, this is called Monte Carlo simulation, where you just simulate thousands of different scenarios and create your own distribution, and then based on that distribution, you take certain decisions. समझ में? Okay. When are we learning PM in the class after this? After this we're doing PM, right? Okay. Maybe if we get time, I'll show you, we'll build a simulation for some hypothetical family this time around. Okay. Next process is called bootstrapping. Now, after this, it gets a little tricky. So I want you to be a little careful here. Someone is asking what is a software. I would most probably use a software called Crystal Ball. Minitab. Okay. So I've worked on Crystal Ball before. It's a Oracle software. I think it's an add-on that sits on top of your Excel. So it's easier to run formulas. But I'm not sure we'll experiment. Okay. Now, bootstrapping. I want you to focus here. What is a bootstrapping? It's a process of sampling. So, अब थोड़ा इसको ध्यान से सोच लो एक बार में क्या हो रहा है. See, I want to figure out on an average how many hours do CFA candidates study. Okay, but unfortunately I don't have access to all the CFA candidates. So you guys are my sample. Okay, now how many people here? Let's assume we have some 70-80 people here. Let's say 70 is the N. But CFA का population तो बहुत बड़ा है ना? 70 is relatively a small sample, and that's only one. Now how do I build a sampling distribution out of it? Because remember, in order to reach to some conclusion in statistics, आपको distribution लगती है. So what will I do? Very elegant technique. Out of 70, I will pick up random 30 students from you, calculate how many hours do you study, take an average. Let's say the first 30 people I chose, they told me on an average I study 4.5 hours. I said, great. But now, how many people are left in my sample? 40. Now the thing is, how many samples will I draw? Let's say 40 are left. I take 30 more. Okay. They told me that we study on an average 3 hours. Now we are not left with anyone. That means I can get only 2 samples. So here's a trick. I will take the first 30, calculate an average, then I will put those 30 back. Right? Mix it a little. That means now I will take the next 30, calculate an average, put those 30 back. Then I will take one more 30, calculate average, put that, and then now I can repeat this process 10,000 times. Then I will have 10,000 means. Probability distribution, I can draw conclusion. This is called bootstrapping. So this is a very elegant sampling technique when you have to deal with smaller samples, but you need a larger sampling distribution. Okay, so look at this. This is your population. Now, ideally from population you want to take samples, but you don't have access to the whole thing. So here's what you do. You take a small sample, you assume your sample is your population. And then you bootstrap sample 1, sample 2, sample 3. You calculate mean 1, mean 2, mean 3. And then you build your sampling distribution. Okay, this is called bootstrapping. Expect some theory questions around this. And with this, reading is done. Want a break? Or no? No? Great. Okay, good. So let's go reading number. क्या है reading number ये? Huh? 7. Okay. Estimation and inference. Now, again, we have to learn different type of samplings here. Okay. We have something called as a simple random sampling, and then we have a systematic sampling. Lot of discussion on sampling here. देखो ध्यान से देख लो. I have a population of 100 students here. If I go and pick up random 30, that is called simple random sampling without any logic. Now, in statistics, achieving randomness is very important. कि जो मैंने सैम्पल चूज़ किया है, जैसे एक टीचर के लिए, I'll tell you where a lot of teachers, including me, go wrong, right? If I want to evaluate efficacy of my session, कि आज सेशन ठीक गया है नहीं, my generally way of getting a feedback is looking at your faces. शक्ल देख के पता चलता है. Now the problem is, if I'm looking at faces of the first 2 row, that's a biased sample. These are highly motivated folks who'd come 30 minutes in advance to the class, right? Grab their seats. If I look at them and then decide, then I'm getting an incorrect feedback. My sample is not random. Are you getting it? So random means selection without any bias. So I should randomly pick up 30 people and then get a feedback from them. Now, believe it or not, there are softwares built and there are algorithms developed to ensure randomness. बहुत सारे, and this is an area of study by itself. We don't need to go there, but simple random sampling means I'll randomly select 30. Now what is systematic sampling? Now maybe my randomness will have a bias. So I'll do a simple logic. I will say हर एक row से एक लड़के को उठाएंगे. Every row I'll pick up one student to take a feedback. This is now some rule based, but will still give me some level of randomness. That's called systematic sampling. Understood? Now, what would be a stratified sampling? So now, even if I pick one student from a row, there's a chance that my data will get biased. So better way, I will take all the 100 students and divide them into 5 buckets. Okay? Let's call them smartest, smart. अब आगे वाले आप वर्ड दो प्लीज. एवरेज, ओके, लेस स्मार्ट, लीस्ट, डम बिम नहीं यार, लीस्ट स्मार्ट. ठीक है. नाउ आई विल डिवाइड ऑल द स्टूडेंट्स इन दिस 5 buckets. हाँ, कौन है वो स्मार्ट कॉम्प्लीमेंट वाला? इधर ही डालता हूं मैं देखो. So now, from this I will take a sample of 6 people. From this I will take a sample of 6. From this sample of 6, 6, 6. Now what beauty of this style is that, bolo? I'm getting, in my sample I'm getting all the representation. That is referred to as stratified random sampling. समझे आप? So let's read some theory. Simple random, equal probability of being selected. Systematic sampling, every kth member, every 5th student, every 7th student, 1 student from every row. That's systematic. Then stratified random sampling, you divide population into stratas and then pick up people from there. Then cluster sampling. This is also, on the face of it, looks like a stratified sampling, but it's not. What do you do in cluster? So you divide students into groups of 25 groups. Okay. Now, how do you divide the students? Either you do the division based on certain logic, or you do it randomly. And you pick up one entire cluster by itself. And you assume that that cluster is representative as a whole. That is called cluster sampling. Within cluster, you have 2 subpaths. Okay, you have a 1-stage cluster. You have a 2-stage cluster. Look at this. If all the members in each sample cluster are sampled, this plan is referred to as 1 stage. If a subsample is randomly selected from each selected cluster, then it becomes 2-stage cluster sampling. So to a large extent they are similar, stratified and cluster sampling. Here's a difference. A major difference in a cluster and stratified sampling is, in a cluster sampling, whole cluster is regarded as a sampling unit and only sampled clusters are included. Matlab, in a strata, when I told you smart students, not so smart, we selected 6 out of every group, right? In a cluster sampling, you'll pick up the entire cluster as a whole. You'll not pick up some of them, you'll pick up all of them together. Then convenience sampling, the name suggests. जो data available है उसको use कर लो. So you sample the one which are easiest. People sitting at the back are sleeping. So I'm just joking. पीछे मत देखो. So then for me, if I have to pick up a sample, it's easiest to just pick up the top 5 or top 10. That's convenience. The problem with this sampling is what? Biased. It's biased. And the last one is judgment sampling. Let statistician decide which students to take based on whatever judgment they have, which generally also results into a lot of bias. All right, central limit theorem. Very, very high probability it shows up. Okay, so this would again be a 5-star pick, CLM. Now I'll tell you what you need to know for a concept perspective and also give you exam summary. What are you doing in a CLM? You have this population. From this population, you're repeatedly drawing a sample. You're ensuring that sample size is greater than or equal to 30. This population can follow any distribution, it does not matter. You keep on picking up large number of sample, and if you do that, you build a sampling distribution. Okay, your sampling distribution will have 3 properties. Number 1, mean of your sampling distribution will be mean of your population. Mean of your sampling distribution is mean of your population. Number 2, the sampling distribution itself will be normally distributed. Remember, my population was not normally distributed, but my sampling distribution will be. And third, the standard deviation of sampling distribution will be equal to the true population standard deviation divided by under root n. Not available, then sample standard deviation divided by under root n. This, by the way, is also referred to as a standard error. Standard error. Okay. Now, there is obviously some meaning to this theory. It's not random, but since it's a crash course, I'll just ask you, if you've not understood the meaning of it, just memorize it. 3 things. Repeat with me. Tell me which 3. Mean of sampling distribution is mean of population. What else? Sampling distribution will approach normal distribution. And standard deviation of sampling distribution is sigma by root n or Sx by root n. Done. Fantastic. Okay, very nice. So this is repeating, there is a little bit of bootstrapping or resampling equation here. You don't have to worry about this. It's the same standard deviation equation, just looks fancy. Then the process called jackknife. Okay, now what's a jackknife for a theory question? Let's say my data is like this. 3, 5, 7, 9, 10. Okay. What you do is you take your first sample, you remove 3. And you take your first sample as 5 plus 7 plus 9 plus 10. And divide by 4, that becomes my first mean, whatever that number is. Then you replace 3, remove 5. So you say 3 plus 7 plus 9 plus 10 divided by 4. Then you put back 5, remove 7. 3 plus 5 plus 9 plus 10 divided by 4. So, every time you remove 1 and then take a mean. समझा ना क्या किया मैंने? 3 को हटा दिया और mean ले लिया. Then I put 3 back, I removed 5. So 3, 7, 9 and 10. So which means if I have total 5 observations, then I will have 5 samples. This is called jackknife. Now, is this a good method? No. Bootstrapping was more elegant, right? It was more random. But what is the beauty of this method? The beauty of this method is It's repeatable. What do you mean by repeatable? When I'm writing a computer algorithm, when I run a bootstrapping algorithm, if I run it once and then then put the data back and run it again, the two will give me very different results. I can't repeat that. It will not give me the same thing. With Jackknife, when I repeat, it gives me the same thing. So it's a repeatable process. So there are certain software applications where you need that thing to repeat, predictable. That's where Jackknife is useful. Is that clear? Okay. Hypothesis testing. Up to break. Take a break. I think we're doing good. We should be able to wrap up by 10:30, 11. Okay. 20 minutes. 20 minutes is okay? 10 minutes? 20 minutes. Come back in 20 minutes. हाँ जी, चलो, settle down. Most important three topics after this: hypothesis, parametric, and regression. Then there is one on big data, which is mostly theory.
When did they introduce big data?
I mean, it's been 3-4 years. It's such a small topic, mostly theory, big data, even machine learning. But CFA Institute did so much of marketing around it. There was so much of hype on the internet that there is a machine learning now in the CFA syllabus and big data in the CFA syllabus. Someone on the chat box, if I do the crash course and I do the questions, am I good for the exams? Do you see how difficult that question is to answer from a teacher's perspective? Because I don't know what you've done in the past. But assuming you've done your syllabus once, I think that's a good idea. The more questions you do, the better you're going to be. So yeah, in general, that's always a good idea. Okay, all right, time to start. Everyone settle down. Chalo. hypothesis test is a statement about certain belief. First, ये गेट खुला है क्या इधर वाला? Can we shut it down, please? Hypothesis test. Hypothesis test. Okay. First, you have two types of hypothesis: null and alternate. Null is what you, and when I say you as in statistician, what you want to reject, disprove, right? So in our classes we call this, this is, kiska statement? Bua, ha. This is your Bua ka, okay, I don't know how to do that, Bua ka statement. Or this is your Bua ka comments, right? Now, you want to prove a wrong, so you call that as a null hypothesis. And what is the alternate hypothesis is what you believe is to be correct. So you believe alternate to be correct and you believe that null is going to be wrong. Aniket, would you please stop spamming on the chat box? And I'm not going to answer just because you've spammed so much. I'm going to keep that question on hold for a bit. So, null, what you want to reject, alternate, what you want to accept, what you believe is correct. Okay? Now, the general rule, I'll give you some guideline. I don't think on the test you have to do the whole hypothesis thing. I don't think you'd have to do the entire step-by-step hypothesis. I think the questions on the exam would be some sub-part of it. One sub-part of it would be just defining the null and alternate hypothesis. So your null hypothesis, okay, your null hypothesis can take one of the three scenarios. Okay, if it's a two-tailed test or it's a one-tailed test. In a two-tailed test, you have these two scenarios. In a one-tailed test, we have only, two-tailed test, you have one scenario. One-tailed test, you have one of the two scenarios. Now, what would that be? So let's define that for mean, okay? So mu is equal to 0. This is called two-tailed. So in two-tailed, you're typically looking at equal to or not equal to. Alternative, mu is not equal to 0. Can it be opposite? Can we have mu not equal to 0 in none and mu is equal to 0 in alternative? No. A null hypothesis will always have equal to sign. Okay? Now in one-tailed, we have two scenarios. Mu greater than or equal to 0, mu less than or equal to 0. Notice I have equal to sign in null hypothesis in all the three scenarios. Okay? Alternate hypothesis will be what? Mu less than 0, mu greater than 0. Now, this is two-tailed, this is straightforward, this is one-tailed. Now, which tail is this? Is this, think of the first one, is it a left tail or a right tail? It's a right tail. So left tail. भाई एक मिनट तू तेरा लेफ्ट और राइट कौन सा है वो दिखा. Which is your left? डिसाइड कर ले कौन सा है. So whether it's a left tail or right tail, you use right. You determine based on thinking of an arrow, but that arrow has to be of alternative hypothesis. Okay, so this is indicating towards this side. Which side is this? Okay, great. So this is a left tail test. So you think of it as left tail test. Okay, in the same way, this one becomes a right tail test. So that's how you figure out which is a left tail, which is a right tail. Okay. Type 1, type 2 error, obviously a very high probability of showing up on the exam. You have to know this, and you have to know this really well along with that confusion matrix. There's a confusion matrix, right? So a type 1 and a type 2 error. What works for me, how I remember it is something like this. I don't remember which meme did I exactly see, but this one is the most popular one. And doctor wala. Here you go. And somehow I just love the expression, whoever created this meme, right? Just look at the expression, this fellow. Now, which one do you think is more offensive here, type 1 or type 2? Come on. Type 2 is...
You're calling someone when she's mad.
Okay, so anyways, so now this is called false positive. Okay, so here positive being the pregnancy. So you're saying you're pregnant, but false means wrongly. I'm saying that you're pregnant wrongly. That's a type 1 error. Type 2 error is false because both of them are error, right? So they have to be false negative. Okay. Now, what does it mean? It means, remember in hypothesis testing, whenever you reject something, it's a success. So here you have rejected. That's why you're getting a positive result. Positive means you rejected. So you rejected when you shouldn't have. When you shouldn't have. Okay, is a type 1 error. And failing to reject when you should have rejected. Failing to reject when you should have rejected is what? A type 2 error. Okay. So I'll give you a few scenarios. You tell me what kind of error are you making. Let us say that you have some abdominal pain. So you go to a doctor. मतलब आपके पेट में दर्द है. So you go to a doctor. They do some, I don't know, sonography or whatever tests they do. And then they see that you have an enlarged appendicitis. And then the doctor performs a surgery. What error is that? Type 1 or type 2? No error. Right? This is no error. But you do not have appendicitis, but the doctor performs a surgery. Type 1 error. मतलब आपको बीमारी नहीं थी, but doctor surgery कर चुके हैं. So that's a type 1 error. Now you have appendicitis, but the doctor says, you know what, you don't have any problem, go home. That's type 2 error. So a false positive, type 1. A false negative, type 2. Let's bring this to financial markets. Online, I want you to participate and answer. Let's say there is a trading strategy you're working on. Okay, some trading strategy that you feel will make you a lot of money. Now, your boss says, okay, the trading strategy is good, let's use it. But actually it was an ineffective strategy. मतलब strategy, your strategy was flawed, but your boss said, okay, let's use it. What type of error is that? Type 1 error. Accepting something that is not working. False positive, type 1. देखो, always remember, type 1 errors are dangerous errors. ठीक है? It's a little bit like this. Let's think cancer. You go to a doctor, you don't have cancer, but they diagnose that you have cancer. आपके पास आपको है नहीं, but doctor says कि आपको है. That is false positive. That's type 1. You have it, but you get misdiagnosed. Doctor says no, you don't have it. Then it becomes type 2. In the same way, this trading strategy is not working, but your boss allows you to deploy capital on that. Type 1. Your trading strategy is working, but your boss says no, don't use it. Then that's a type 2 error. Let's think of and these errors we're making all the time in our lives, right? Let's say I'm hiring. Now there is a fantastic candidate who comes across, but somehow I feel अच्छा नहीं है, I decide not to hire. What type of error? Type? I decide not to hire a good candidate. Type 2 error. Now, I interview a candidate who's actually not so good, but मेरे को लगा कि ये hero है. So I hired a candidate who's not good, but I thought he was good. Type 1 error. Are you getting feel of it? So, focus on the word, don't focus on the word false. Okay, because it's an error itself, so it has to be false. Just focus on the word positive and negative. Okay, it will become easier. Whenever I accept something and I commit a mistake, type 1. Whenever I don't accept something, negative, and I am committing a mistake, type 2 error. So this false word will cause confusion to you. Anyways, it's an error, so we don't need to worry about that false. Error means false, no? So whenever I say, yeah, positive, it will work. Okay? But it actually didn't work, type 1. Negative, it will not work, but that was an error, type 2 error. Bas, that's it. That's what it is. Are you comfortable here? Look out for scenarios where they will give you some financial scenario and ask you to identify if it's an error or not and which error. You should be able to handle this confidently. Now, some theory revolving around this, okay? Type 1 error probability is same as probability of type 1 error is same as your significance level. Okay? And when I do 1 minus probability of type 1 error, it gives me confidence level. When I do 1 minus probability of type 2 error, it gives me power of test. They're compensating of sorts. And if someone says that, I have figured out a way to reduce type 1 error, what are they saying? They're saying I have figured out a way. So for example, let's say we are interviewing people. Okay, our job is to select 1 or 2 good candidates. Now, I'm very scared of type 1. Type 1 is what? False positive. That means selecting a wrong candidate. So what I'll do is, if I'm very conservative and scared of selecting a false candidate, then I will end up rejecting a lot of people. That means I'll end up committing what? Type 2 errors. So when I'm trying to compress type 1 error, I will end up making a lot of type 2 errors. Let's say I'm scared of type 2 error. I'm thinking FOMO, right? What if I miss a good candidate? So let me roll out a lot of offers. So now, what will happen? I'm trying to reduce type 2 error. What type of error will I making? Type 1 error. There are compensating errors of sorts. If I try to reduce one, the other one will increase and so on. Now, statistically, you can try to reduce both by increasing your sample size. Okay, that's one way to achieve that. This is called confusion matrix, what you see here. Your null is true. Okay. Now, if you're not rejecting, good news, correct decision. Your null is false and you decided to reject, good news, correct decision. But your null is false and you accepted, that means not rejected, type 2 error. Your null is true and you rejected, that is type 1 error. Samjay? Okay. All right. So now this is what we have as a syllabus for hypothesis testing. We have total 1, 2, 3, 4, 5. 5 hypothesis tests in this reading and then some in the next reading. 3 of these 5 tests are about mean. 2 of these tests are about variance. A lot of people are scared of some of these large formulas, okay, but they are actually not that difficult. And I feel, and I'll tell you, but I also feel the probability that you would be required to memorize the formula and reproduce on the actual test is also very low. The questions are generally peripheral. Okay, so I'll show you what to remember, and depending on your level of difficulty, we can decide what to skip. Here's example number 1, test of single mean. Okay, now we'll do curriculum, this juice notes example itself. Suppose you are analyzing a fund. During the past 24 months, it has achieved mean return of 1.4 with a sample sigma of 3.8. Given the level of market risk, this mutual fund should have earned 1.2 monthly during that time period. Assuming returns are normally distributed, are actual return consistent with 1.2? Use a 5% level of test. Now, this is the question you might see on the exam. This causes confusion to some people. Kya confusion? After doing this, they don't understand what is my null hypothesis and what is alternate hypothesis. So I'll give you a simple trick. If you listen to me for next 30 seconds, you'd never struggle. Okay? What is it that I'm trying to do? So you remember, you're a statistician. The number that you have calculated, you have to believe in that number. Now, as a statistician, when you did data analysis, what was the mean return? 1.4. So that is your true mean parameter. Whichever other number you see competing with mean, वो तो बुआ का number है ना? So you calculated 1.4. Now your buwa came, and she said mean is how much? 1.2. So which means null hypothesis will be, okay buwa, mean is equal to 1.2. Alternate mean is not equal to 1.2. Bas khatam. So how to decide? First, figure out as a statistician what have I calculated. That is a true number. The other competing number for mean obviously has to be your null hypothesis, hypothesized value. Once this is done, which is your step number 1. Okay. Mu is equal to 1.2. Mu is not equal to 1.2. What do you do in step 2? In step 2, you will calculate the test stat, which is what? Sample mean minus hypothesized value divided by standard error. Okay, so 1.4 minus 1.2, this will become how much? 2.578. This is simple, straightforward formula. Now, a mean test you'll have to do with t-table. In a t-table, you have to read with something called as a degrees of freedom. Okay, again, very less chance that you have to read the table on the exam, but if you have to, it's like this. Look at this. You would be given a table like this. You have to go and look for 23 degrees of freedom. This is degrees of freedom. And if it's a one-tail probability of 2.5, in two-tail it becomes 5. Ye yaad mein rakhna. In the t-table, if they give you a one-tailed t-table, you double the probability to convert this to two-tailed. If they give you two-tailed, half of it will become one-tailed. So this is one-tailed 2.5. So two-tailed becomes 5. Anyways, we want 5. right? So 2.5%, 23 degrees of freedom, what is the critical value? 2. Otherwise, इसको याद कर लो. Okay, you can also memorize this number about 2. For what level? 95%. Generally, it will be around 2. Okay, for a reasonable sample size. Now, is your calculated number inside or outside the range? Inside. So, fail to reject. Fail to reject means what? We go to our BOA. BOA is, remember, BOA is your null hypothesis. So, we go to her and we say, you are not wrong. We cannot say you are correct. We will say you are not wrong. That means fail to reject. Fail to reject was null hypothesis, which means I calculated this number to be 1.4, but it's possible that this number would be equal to 1.2 for the whole population. That's your test for simple mean. Easy? Okay. Now, second test. This is a test for differences between means with independent sample. Okay, now test 2 and test 3 can be confusing. Someone is asking on the chat box, why not Z test? Typically, your sample size needs to be more than 30 for Z to be used. And it needs to say that it follows a normal distribution. The question did not. So t-test is a more real-world version of the z-test, Madhav. Okay. There are two tests here. One is called differences between mean. The second one is called differences between means again. It's almost same, but this is dependent sample. So, if you have independent sample, you will have to memorize certain formulas, which I'll show you. Not that difficult, but we will have to. We often want to know whether a mean value, mean return differs for two groups. Is an observed difference due to chance or underlying mean? We test this by drawing sample from each group. Samples have to be from populations that are normally distributed. Samples are also independent of each other. Now, here's an example. We want to test whether returns of FinTree high yield index shown below are different for two different time periods, period 1 and period 2. Generally, on the exam, if you get two period-based question, same variable but different periods, typically it will be under this category. क्या हो रहा है मतलब variable same है but time period is different. Okay. In the other test that you would see that there would be two variables but same time period. Your time period वो common factor बन जाएगा. So now, period 1, period 2, mean 1.2, 1.5, standard deviation 5, 6, sample size 400, 600. That's another hint. You would find two different sample sizes. So when you find two different sample sizes, you know it is a independent sample. Now, once you have this, what do you need to do? 3 steps. Step number 1, whatever BOA is saying is correct. Why? Because as a statistician, you clearly believe they are not same, no? You calculated this, so you know they are not same. But now you're being asked to test which is same. So you say, okay, fine, BOA. Let's assume for a minute what you're saying is correct. Mu of period 1 is equal to mu of period 2. Then test statistic. Test statistic is a 2-step process. Step number 1, you have to calculate something called as a pooled variance. Okay. Now, pooled variance has a very fancy formula here. Now, for your level 1 exam, I'll give you a simple trick. It's okay not to memorize this formula. Okay. How? You can avoid memorizing this formula if you simply take a weighted average of your variance using the sample size. Sample being the weight. For example, what do I mean by this? Patch is the standard deviation. So what is the variance? Variance is 5% square. Okay, so help me out. 5% x square on your calculator. 0.0025 and 6 percentage square 0.0000 or 30 0036. Okay, this is my variance. यहाँ तक तो ठीक है. Now total how many days? 400 plus 500. How many days? 900 days, right? So 900, 400 as a ratio to 900 is what percentage? 44.44. So let's round it off to 45% and 55%. Okay? What I simply did is I took number of days, the sample size as a weight. And now what you simply do is compute a weighted average. How will you do weighted average? Just multiply. Okay? So 0.0025 into 45%, STO1. .0036 into 55%. STO2, add up the two. 0.003105. That's your pooled variance. So this formula looks very fancy. It's nothing but a weighted average formula. So you don't need to memorize this such a large formula. Just a weighted average. It will not be precise because they do it on degrees of freedom, but doesn't matter. It doesn't change much. Is this okay? So क्या करना है? Step number 1, pooled variance. Once you have the pooled variance, then step number 2 is your test statistic. Okay? Now, how would you do your test statistic? So, sample mean minus hypothesized value, same how we did previously, divided by your pooled variance divided by, multiplied by 1 by n1 plus 1 by n2 under root. This is your test statistic formula. Let's see if it works. Do this with me. We'll solve for denominator first. We'll do the denominator first. 0.003111. Okay, divided by bracket open. Actually, वैसे नहीं काम करेगा. Let's do the bracket first. 1 divided by 400. STO1. 1 divided by 500. STO2. RCL1 plus RCL2. RCL1 plus RCL2. Multiplied with 0.003111 equal to under root. STO3 में डाल दो इसको. And then what is your numerator? Your numerator is 1.2 minus 1.5 equal to percentage divided by this RCL3. Minus 0.80. So there you go. That's your T-stat. Minus 0.80. And once you've done that, then what do you do next? Figure out what is your critical value. Okay. Critical value you find from T table, but if your sample size is so large, just use a Z table. I told you just memorize 2 for 5%. This is close to 2, no? It doesn't have to be precise. Approximate chalta hai. Now, is your calculated number inside or outside? Inside. So what is the conclusion? Conclusion is BOA is not wrong, which means the mu from period 1 is statistically, it's not wrong to say that it's same as mu from period 2. This is called the pooled variance test. Okay, I told you 3 tests for mean. One was which one? A simple mean test. Second one, independent sample. Now the last one we do, which is on dependent sample. Okay. Now, how do you do it with dependent sample? It's actually very simple. They will give you data like this. Now notice, here in this, the hint that you will have is that you will have only one sample size. Okay, there you had 2 sample sizes. Now, it becomes so easy on the exam, because if you have to do polled variance, you have to have two sample sizes. You don't see two sample sizes in the question, you automatically know I have to do the other mean of differences test. Now how would you do it? This is a written on FinTree high yield, this is a written on FinTree triple B. The difference between the two is here. Okay? Now this is a written on, this is the standard deviation of the two. This is the difference of the standard deviation. It will be given to you in the question. All that you have to do is you have to take this column and do your regular test that we learned in the first one. So it looks like you have 3 tests. This is actually only 2 tests. जो पहला वाला test था ना, sample mean वाला, this is exactly the same test, but you have to do it on differences. So technically only 2 tests for mean. Now how would you do it? So you would say, okay, the difference is equal to 0. Difference is not equal to 0. Same formula, mean divided by standard error. Check whether it is fitting inside or outside. This one is going outside. That means reject. Reject means what? Difference is not equal to 0. Difference is not equal to 0 means what? BOA is wrong means what? We are right means what here? You are obsessed with, Are ha bhai, reject. What is the economic interpretation? Economic interpretation is that they are statistically different from each other. You're right. Niket Singh is saying, कुछ समझ में नहीं आया. Okay, और आपको भी नहीं आया. नहीं आया ना? Let me show it to you. Okay. May I assume the first 2 tests you are okay with? सही में? Okay. If you are okay with the first 2 tests, then you would have been okay with this one. This is a simple mean test. Then this is your independent sample test, and this is your dependent sample. Okay, I'm going to do this test with you. What do you do in this test? In India, we have Nifty and we have Sensex. Both of them are broad market index. Let's assume I take data for 100 days and I plot the returns 1%, 0.7%, 2%, 3%, जो भी daily returns. Plot the returns for Sensex 1.2%, 0.9%, and so on. Okay. Now, logically, would you agree that Nifty and Sensex more or less should show you similar returns? Yes. Now, you calculated mean for Nifty, and just for simplicity, mean for Nifty came out to be 2%. You calculated daily return. ऐसे example है. You calculated mean return for Sensex. It came out to be, let us say, 1.8%. Which means the mean return of the two are same or different? Different. Difference is how much? 0.2. So difference is 0.2%. Now your BOA came and she said, no, this is wrong. What you've done is completely wrong. Nifty and Sensex are always same. So what do you want to do now? You want to prove your BOA that she is wrong. So how would you do it? So you will say null hypothesis, which is always for BOA, is difference between the two is actually 0. It's like हम लोग बोलते हैं ना कि 1 मिनट के लिए मान लेते कि आप सही हो. So it's a little bit like that. Okay. Alternate hypothesis, difference is not equal to 0. Then you would calculate the test statistic. How would you do it? So you will say, what is the difference? 0.2. Treat that like a mean. Divided by standard error. Now standard error would mean I need a standard deviation here. Okay, so whatever standard error will be given to you, which is nothing but standard deviation divided by under root n. ये तो किया है ना formula हमने. This is a central limit theorem formula. Now once I do this, it might give me some number. Let's assume it gave me 2.5. Now I will create a critical value range -2 + 2. Is 2.5 inside or outside? Outside. Outside means what? Reject. Reject means I go to BOA and tell her that you're wrong. You're wrong means difference is not 0. Means what? Economic interpretation क्या है मतलब? That means average return on Nifty and average return on Sensex are different, they're not same. बस वही है. Does it make sense? Abhay, Niket Singh, I hope you've understood this now. So 3 tests done for mean. Next one. Now we have to do 2 more tests for variances, which looks like this. We have to do 1 test, which is called the chi-square test. This chi-square, this formula is my 7-star pick. Okay, you might have seen my star intensity is going up. Probably reflecting a little overconfidence of your teacher. But I think this has a high probability of being tested. These formulas you have to remember. Okay, chi-square and maybe even F. You have to know this. What is a chi-square test? Test of variance, single variance. And what is a F test? Test of differences in variance. Similar to how we had differences of mean. How to know when to use when? Very simple. If you have 2 different populations, then obviously you have to use F test to compare them. If you have just 1 population, then you use a chi-square. Let's look at an example. Let's look at, okay, here, look at this. FinTree Equity Fund, a small cap growth fund that has been in existence for 24 months. During this period, equity achieved mean monthly return of 2% and a standard deviation of 3.5. Using 5% level of significance, test whether standard deviation is less than 4%. Now, this is the first time they're using a one-tailed test. Abhi tak all the tests that we did were two-tailed. Here they use the word less than or greater than, so it becomes one-tailed. Now, the moment you see this, it creates a little bit of confusion because you would not know how to define your null or alternate hypothesis. So I'll tell you how to do it. If you get a one-tailed test on the exam, here's how you're going to think. Null, please listen to me next 30 seconds very carefully. I'm giving you a very elegant trick, will always work. Alternate. Start here. Okay, with alternate. Write down variance and write down the hypothesized value. What is the hypothesized value? 4%. Okay, so let's just say 4 square. Now, in your head, and this is a trick, in your head, what is the correct number for variance? 3.5. Okay, so just write it down for reference. You think it's 3.5 square. Your Buba came and told you it's 4.5. Buba is correct or wrong? Obviously wrong, right? So, is 3.5 greater than 4 or less than 4? Less than 4. So, I have to create a sign like this. Is this correct? That 3.5 square is less than 4.5 square. That means, question for you, sir. Arey wah, shabash. He was ready. Before I asked you, he's like, left tail. पिछले आधे घंटे से वही कर रहा था ना, तो सच बता. ये left है, ये left है, ये left है. Okay. So 3.5 square is less than 4 square. This is a left tail test. So then we have to set up hypothesis for Buba, obviously on the opposite direction, that sigma square is, bolo, greater than or equal to 4 square. So this is your null hypothesis, this is your alternate hypothesis. What is your test statistic? Sample variance divided by hypothesized variance into n minus 1. Easy. 3.5 square divided by 4 square into 23. Okay. That will give you 17.60. Now you go to chi-square table. Again, very high probability it will be given to you on the test. In the question itself, they'll give you critical value. The critical value is given to you as 13.091. Now, how do you know where to reject? So this arrow itself will tell you. It was a left tail test, so you reject on the left hand side. Samjhe? That's simple. So, Siddhi, arrow towards left, so you reject on the left hand side. So here 13.091, rejection on the left, but my calculated number is on the right. So what is the conclusion? Fail to reject. Fail to reject means what? BOA is not wrong, which means possible that variance is more than 16, 4 square. That's it. That's your test of a single variance. Easy? What is the formula? N minus 1 multiplied with sample variance divided by population variance. Okay. Now there's a little bit of trick in how to read the chi-square table, but you know, for all practical purpose, if you're preparing for the exam, you don't care. Will be given to you on the exam. And very unlikely you'd do all the 3 steps on one question. One question would just be a small sub part of it, just doing step 2 or step 1 or something like that. Okay, now finally we go to test of a single variance. Okay. You're investigating whether population variance has changed after a change in market regulation. The first 121 weeks occurred before the regulation change. Next 61 weeks occurred after. Variance before was 8, variance after was 3.9. Are the variance of returns different before the regulation change versus after? Okay. So you have calculated them to be different. Before it was how much? 8. After 3.9. So obviously they're different. But BOA says no, they're same. So you would say, okay BOA, this is your null hypothesis. Before is equal to after. Alternate, before is not equal to after. Formula, variance before divided by variance after. So 8 divided by 3.9, 2.05. Now in a F test, again, you have to memorize this. Rejection will always be on the right hand side. F में हमेशा by default right में ही rejection बनाता है. Why? Because they designed the test that way. F is a asymmetric distribution. Rejection will always be on the right, no matter what test you're doing. So then you go and find critical value 1.47. Your calculated value is 2.05. Are you going on the right? Yes. Conclusion? Reject. Reject means very happily go to BOA and say, you're wrong. That means variance before is not same as variance after. That's it. That's your F test. And then there is a little bit of theory on parametric versus non-parametric, but okay, we'll do it here itself. ये theory में से questions आता है, so I'll highlight the important pieces for you. In a parametric test is concerned with parameters. What's a parameter? A mean of a population, a sigma of a population is parameter. This test will force assumption on the population. Remember, so many tests we did today, it said use a normal distribution or use a F distribution or a chi-square distribution. A non-parametric, you use this test when your data is not meeting the assumptions, okay, or when you have lot of outliers, or your data is in ranks, okay, typically some sort of a ordinal scale. Ordinal scale would be, बोलो कैसे? Credit rating, है ना? AAA, BB type of ratings. Those are ordinal scales. Or you're doing a test which has nothing to do with parameter. That means you're not testing mean. Then what are you testing? You're testing that, boss, I have this data. I don't want to test about mean or variance. I want to test whether my data behaves in a particular way. Is my data following a normal distribution? Or is my data random, right? So if I want to test, create a test but not with respect to population, that's a non-parametric test. And rest of the stuff is okay. We'll let that go. Now, unfortunately, this is a 3-star table. Why I say unfortunately? Because you have to memorize these names. Okay? If you want to do a test with respect to a mean, if your data follows distribution, use a t-test or z-test. Otherwise, use this पता है क्या Wilcoxon signed rank test. If you're doing differences, then you use this MWU test or Wilcoxon rank sum test. And if you're using a paired comparison test, then you again have to use Wilcoxon signed rank test or a sign test. And then finally, this is a summary with all the degrees of freedom and all the formulas that we looked at in this reading. And hypothesis is over. Let's summarize. Core essential concepts. Type 1, type 2 error. Type 1 means false, positive, false, negative. Then 1 minus type 1 is called confidence level. 1 minus type 2 is power of test. Good. Then null hypothesis is what I want to reject. Rejection in statistics is success. Alternate hypothesis is what I believe is to be correct, what I would like to accept. Then we have to do test on mean, we have to do test on standard deviation. Within mean we had 3 tests. One was a simple mean t-test, other one was independent sample and dependent sample. How will I know which is independent, which is dependent? Here I will have 2 sample sizes. Here I will have only 1 sample size. Now technically we know that this test and this test is same. My computer is tired. Okay. This test and this test is same. It's just that here I do that hypothesis on the mean. Here I do test on the difference of the mean. But otherwise the process is exactly the same, formula is same, everything is same. Here, when I do the test, my test statistic is made of 2 parts. Step number 1, pooled variance. There is a fancy formula, but shortcut to memorize formula is to calculate a weighted average. Weight being what? Sample size. Sample size. You know? And then step number 2, then my test statistic becomes same. Your क्या है बोलो? Mean minus hypothesized value. है ना? Divided by mean 1 minus, she is right. Here mean 1 minus mean 2 divided by pooled variance multiplied with 1 by n1 plus 1 by n2, this thing, under root. And then you reject with the same t table, same rule. That's it. These are your 3 tests. Do you think you can handle them? Good. Then standard deviation, we have 2 tests. One for simple variance, one for variance again. This is a single variance. This is a before-after test. Before-after test. Now, a single variance test, which test? Chi-square. How do you do chi-square test? N minus 1 multiplied with sample divided by hypothesized value, variance. And how would you do F test? Before divided by after. In a F test, rejection will always be on the right side. And in a chi-square, rejection is a function of whether it's a two-tailed or one-tailed. If it's a one-tail, either left tail or right tail. If it's a two-tail, then same logic. Beech mein hoga to fail to reject. If it goes outside, then reject. Finish. That's it. And then little bit on your parametric. So this is your mental model. This is your mind map. If you just remember this reading is more or less done for you. Okay. मजा आ रहा है? That's it, last 2. I might not do that big data with you. That will be your self-study. But that's mostly theory. I don't have much to do that. But I have to do these 2. And these we have to do nice. one is parametric, and then one is regression. Let's start. क्या हो गया? How is the Josh? Hi, sir. सुबह से बिठा के रखा है बेचारे बच्चे. What is your family saying about these sessions? Do they believe कि ये सही में आप class? Do they believe that you are sitting for an 8-hour class? ये पारस को तो बिल्कुल नहीं है, तो शक्ल देगा अपनी. हाँ क्या लगाया? लोड़ा लगाया ना. क्योंकि इसके पहले ऐसे किया ना तूने. लोनावला नहीं, खड़क वासला में देखा था मैंने. देखो नहीं, उधर नहीं जाता. अच्छा, कॉलेज के पास किसके साथ? शर्मा रहा है. ठीक है, चलो यहाँ पे पैरामेट्रिक, नॉन पैरामेट्रिक. द फर्स्ट टेस्ट इज ऑन कोरिलेशन. सेम टेस्ट, एग्जैक्टली द सेम टेस्ट लाइक मीन. मीन टेस्ट किया हमने 3 steps. This is also same, only difference being step number 2 is different. आपकी भावना है, आपकी फोन बोल रहा है अभी. Okay, so how do you do this? Step number 2 becomes correlation into n minus 2 under root divided by under root 1 minus r square. The process is exactly the same. Define hypothesis, calculate test statistic, compare with critical values. Which table will you use? T table. Let's say we have an example here. Okay, correlation between 2 variables is 0.5. Perform a 2-tailed hypothesis test. Okay, assume a sample size of 12. अब आपने correlation निकाला 0.5. You are a statistician, you calculated 0.5. Your बुआ came. She said what? कोई तो स्टोरी, you don't know anything. कौन बोल रहा था? हाँ, so what did बुआ say? बुआ said you calculated 0.5, but you're wrong. The true correlation is 0. Okay? Whenever hypothesized value is not given on the exam, the default hypothesized value is always 0. मतलब because when correlation is 0, it means no relationship, no? So Boa is saying kuch nahi hai. But you calculated it's how much? 0.5. So you follow the same drill. Correlation is equal to 0. This sign is called rho, by the way. Correlation is not equal to 0. R into n minus 2 divided by under root 1 minus r square. I want you to use this formula and solve. करो. याद है formula? करके दिखाओ. Use the formula and solve it. R multiplied with under root n minus 2 divided by under root 1 minus r square. How much? 1.825. Okay. Then you go to T table like this, find out your critical value. Is it, look at this, is it, chalo, is it inside the range, outside the range? Conclusion. So what do you go to Bowa and say? You're not wrong. That means it is possible that correlation can become 0. correct? And if your correlation can become 0, then we say it's statistically insignificant. Something that can become 0 is insignificant. ठीक है? आया समझ में? That's it. That's the test for correlation, nothing else. Now, what happens if sample size changes to 32? If sample size changes to 32, the same question, okay, but what's happening now? This value will come out to be 3.1. Conclusion now will become reject. That means this time we can go to BOA and say what? You're wrong now. Correlation is not 0, right? So correlation is same, but notice how sample size changed and your conclusion changed. So higher sample size adds to the statistical reliability is what this is trying to show you. Okay? Let's move forward. Next one. Now, this is where it gets a little tricky. Up to now, the correlation that we calculated on your second 7, second 8 setup, that is called as a Pearson's correlation. Now we are going to learn to calculate a different correlation that is called Spearman's rank correlation. Okay? When do we use this correlation? When your data is not normal. When you're dealing with a non-normal data set, data is not following normal distribution, you use a rank correlation. Now how would you do it? Step number 1, rank the observation. Okay? Step number 2, rank Y. Step 3, calculate difference of the rank. Then square those differences. And step 4, use this formula. Squared differences summed up multiplied by 6 divided by n into n square minus 1. And this term you need to deduct from 1. Okay, it's a little bit of mouthful, but you practice this a few times, you should be able to memorize. क्या करना है? I have x data, y data. First rank x, rank y. Take the difference, square the difference, sum the difference. 6 into summation divided by n into n square minus 1. And then this term, no, 1 minus this term. That's your formula. Okay, let's try. Easy, not difficult. Look at this. You would understand what's happening. Let's assume this is my data, fund 1, fund 2. If I have to arrange fund 1 returns in ascending order, ठीक है? तो क्या रैंक आएगा यहाँ पे? सबसे ऊपर कौन सा आएगा? Doesn't matter, right? So let's take, let's rank returns of fund 1 and fund 2. If this is how I'm plotting the data, 10th as a return is what rank? Okay, so think about it. Which is the rank number 1 here? 20. So 20 gets rank number 1. आ रहा है समझ में? Easy है. Then which is second highest? 15. So 15 gets rank number 2. 14 rank 3. Then 12 rank 4. Okay? क्या रह गया अभी? 11. क्या rank है? 5. And then 10 will become rank 6, and then this is 7. And then you follow the same drill, get ranks for fund 2. Easy? Ranking to आसान है. Once I have the rank of the 2, take the difference of the rank. 6 और 4 का difference कितना है? 2. Square it. 4. So this is the difference. This is the square of the difference. Sum it up, 30. Put it in this formula. Okay? So you do it. Karo. Use this formula and find out what is your test statistic. What is your Spearman correlation? Six multiplied with 30 divided by, how many observations do I have here? 7. So 7 into 7 square minus 1 deducted from 1. 6 multiplied with 30 divided by 7 into bracket open 7 square minus 1. So that's 7 into 48. 0.464. That's it. That's your answer. Spearman rank correlation. Very easy. Now, how would you do hypothesis testing of this correlation? Okay, good news for you. Bolo kaise? Same as the previous one. So there is no hypothesis test separately. वो जो previous correlation वाला hypothesis test था. After seeing this much confusion, me and my boa don't talk anymore. Yeah. Your boa still wants to talk to you. You're not letting her talk. Okay. Now, this is done. अब थोड़ा सा chill नहीं. Now we'll get into slightly complicated piece on contingency tables. Okay, so this part is done. Correlation test is done. Can you recall the formula for me? R, correlation hypothesis test formula, R into what? Under root n minus 2 divided by under root 1 minus r square. Okay. And then Spearman was easy, right? Spearman was what? One minus 6 into summation of d square divided by n into n square minus 1. Okay. Okay. Now, this one is called hypothesis of test of independence. It's a fairly big test. You'd see how long the test continues. But it looks long because I've tried to avoid memorizing any of the formula. So I've broken it down into multiple smaller steps. If you look at CFA curriculum, you'd find that there are some very confusing formulas here, which I don't want you to follow. I want you to follow this method. Let's learn. It's not difficult, it's just a little procedural. When faced with categorical or discrete data, we cannot use the methods that we have discussed up to this. When classification of data type is discrete, we cannot use correlation to assess. Now, if we have 50 funds categorized based on size and value, the contingency table will look as follows, which is kind of easy. Think about it. It's just a 3x2 matrix of sorts. You've total 50 funds. Value funds are total 30. Growth funds are total 20. Small cap funds 15. Mid cap 11. Large cap 24. How many funds are growth and large both? Growth and large. Large cap growth funds कितने हैं? 4. How many are mid cap value funds? 5. So ऐसे टेबल पढ़ना है. Easy है? Okay. क्या बोलते हैं इस टेबल को? Contingency table or a two-way table. Okay. Now let's start doing a test of independence. Okay. We have to test whether relationship exists between size and investment type. Okay, so we can perform a test of independence using a non-parametric test statistic that is called chi-square distributed. Okay, now chi-square is typically parametric, but here we are using chi-square in a non-parametric test. Remember, here we are not testing a parameter. Are you testing mean, variance, correlation? No. A parameter means property, characteristic of population. No. Here you're testing independence. Right? Because you're testing some other aspect of population, it's a non-parametric test. This is the formula. Chi-square is equal to O minus E. ये थोड़ा आपको IJ confusing दिखेगा, but you'll understand. And this E is your total row into total column into overall total. Now let's start doing it here. You don't need this formula. The reason why we have such a large table here is to avoid memorizing the formula. Alright, let's look at this. perform the test of independence using contingency table in FF4 for 50 funds. मतलब ये वाला table. This is FF4. We have 50 funds. Okay. First, step number 1, calculate M as the multiplication of number of rows and columns. Look at this. How many rows? कहाँ पे 3 rows? ये तो total है. How many rows? 2 rows. This is row number 1. This is your row number 2. नीचे वाला. 2 rows. Okay. How many columns? 3 columns. So number of rows into number of columns. How many? 6. So this is your 6 here. Now calculate expected value for each cell using total of row into total of column divided by total of the table. ठीक है? इसको कहते हैं mean value. How will we do it? It's not difficult. Notice. How do you get 5 here? So you take total, what is the total of the row here? 30. And total of column? 15. So क्या करना है आपको? You have to multiply 30 with 15 divided by this 50. So here expected value will come out to be how much? 9. So that's the expected value for the first one. जो इसको यहाँ पे लिख लेंगे 9. Okay? In the same way. If I have to calculate mid-cap growth expected value, how will I do it? 20 into 11 divided by 50. करो 20 into 11 divided by 50. 20 into 11 divided by 50. How much? 4.4. So that I will write here. So in this fashion, you calculate expected values for each of the cell. कर सकते हैं? Have you understood how expected values are done? Okay. Once expected values are done, now you have a new table that looks like this. Okay. Now step number 4, for each cell, calculate actual frequency minus expected frequency squared divided by expected frequency. So how will we do it now? So look at this. We have to look at these two tables together. Okay, this is expected value. मतलब ये सब mean है. Actual value here was how much? 5. Expected value is how much? 9. So we will do 5 minus 9 square divided by 9. करो. 5 minus 9 square. 5 minus 9. 4 square divided by 9. How much? 1.78. So here you go. 1.78. In the same way, let's calculate growth mid-cap. How will we do it? Growth mid-cap. 6 minus 4.4. 6 minus 4.4 equal to square divided by 4.4. 0.58. So this is now called scaled squared deviation. Okay. Step number 6, test statistic is nothing but your total of scaled squared deviation. That's it. So scaled squared deviation, ये 6 values का total ले लो, it will come out to be 10.87. And what are your degrees of freedom? Degrees of freedom is number of rows minus 1 into number of columns minus 1. That's coming out to be 2. So 2 degrees of freedom. My test statistic is 10.871. Here we go. Null hypothesis. The fund size and investment are independent. Alternate hypothesis, they are not independent. You will have to memorize the null and alternate here. Okay. So null is are independent. So your null is of independence. Alternate is of no independence. Step 2. Test statistic, uske liye we've already done 6 steps, 10.87. And then finally, here in this test, rejection will always be on the right. So your critical value is 5.99, calculated value is 10.8, you reject. That means you're rejecting independence. Means what? They are not independent. That means they are related to each other, which is a logical thing to conclude here. और एक बार repeat करें पूरा process. It was a 6-step process. Again, why are we doing this? We are doing this so that we check whether the data set is independent or not. Actually, the step number, वो जो 6 steps किए, that was actually just step number 2 of hypothesis. If you memorize this formula, that you don't need those 6 steps. But what is this formula? Actual value minus expected value squared divided by expected value. But how do you get expected value? Correct, by doing that table, right? So instead of doing it directly like this, we converted them to 6 simple steps. How did we do it? Step number 1, multiply number of rows with column, you got 6. Okay, this is called as a M. Now, calculate expected value for each cell using total of row into total of column divided by total of table. So how did you do it? 30 multiplied with 15 divided by 50. So we first calculated expected value for each of the cell, which came out to be here. These are my expected values. What did we do next? We did actual value minus expected value squared divided by expected, which is called scaled squared deviation. So we got these numbers. Then we did what? Just add them up. That's my chi-square statistic. And then if my calculated number is more than critical, reject. If it's less than critical, fail to reject. What do you keep your null hypothesis here? The data set is independent. Alternate is not independent. And if you reject, that means what? They're not independent. Okay. हाँ जी सर. वो सिर्फ दिखाने के लिए. उसका यूज नहीं है. हाँ. वो नीचे वाला टेबल दिखाने के लिए. Okay. Now, there's a little bit of theory and mosaic graphic here, which is a visual representation of how your data is. So, see this small cap, medium, large. The size of the box indicates what? Sample size. So, it's a very easy way to show where the data is clustered. For example, out of the 6 or 9 quadrants, where do you have the most number of mutual funds or investment type? You have large in where? In blend. उस तरीके से. And then you can also show, use a color code and show something called as a studentized residual. It's like some metric of standard error. So 2 data points you can show on the single graph. There's a little bit of theory here which I'm going to skip. And there you go. Now we have to do just one large last reading. Would you like a break? आपको खत्म करके तो नहीं जाना है. Break चाहिए ना? Okay. Let's do 10 minutes. 10 minutes is okay? It's going to be a 15 minutes break. I'm putting on a timer. When is your exam? Mid mock में ethics करो. We have dedicated time slots for ethics. हर 8 हफ्ते के बाद 2 हफ्ते ethics के लिए मिलता है. You can study then. You have time. That's the story with whole country today. Not the whole, I think, humanity. Everywhere you go, you see people doing this in their phones, no? No. Okay. All right, I'm ready when you are. I think I've overstretched my vocal cords this month. Yeah, 15th is the election day, right? I don't know what to do. No, keeping the class is fine. Because anyways, it's a half-day class. Some of you, do you guys vote? So you can. No. Because, why? Sure. Voter ID was cancelled. It got cancelled. Why? Okay. Yeah, we'll do it in the classroom. We'll see how it goes. But right now, we'll start in the classroom. In case if we have disturbances or troubles here, then we'll shift it to online. So we'll see how it goes. Okay. All right. Everyone, get back. Let's start. कहाँ पे हमारे? Where is the? नहीं खाना बिना खाने चले गए शायद. अब ये रिग्रेशन खत्म करके ही आएंगे. Do you think you could, if you had to live without your smartphones, you'd be able to manage? How many of you think you'd be able to manage without a smartphone? Not here means what? If I ship you to some island.
So if you're doing some interesting activity, then it's fine. But if your mind is occupied, then it's fine. Otherwise,
So you need your mind to be occupied 24/7. Are people doing like some sort of a detox or something? That must be a trend, I'm guessing, no? Just how we fast. Do people fast from phones? Has anyone tried Instagram? Instagram before exams. Acha, 4 months, nice. Yeah, I think I had this stupid idea last year. I wanted to switch to Nokia phone. I thought those phones were the smartphones. These are the dumb phones. They're making us dumb. Uh, everything, huh? It's a good idea, no? Yeah, but the problem with that idea, I realized very quickly. Uh, I think it's been quite some time I've stopped carrying cash. I don't carry cash. I don't carry cards. मैं कहीं भी बस फ़ोन उठा के निकल जाता हूँ. So which means you will not have access to very essential UPI. Then Google Maps maybe we can still work around. You can do that in what? Zing. Ring. You can use a ring for payment. What kind of ring? You can pay with a ring. Is it? And you can do that with a ring now, with like a fitness ring, is it? It's a dedicated ring for making payments. But even if you don't have your phone with you? Oh, nice, okay. Phone helps us keep updated. No chat GPT. Oh shit, I just came online. How about the people on YouTube? How are they feeling now? Huh? Doesn't work always. Aditya is consistent out middle of this chat. He's just constantly asking one question: when will we do fixed income? भाई अब पूरा schedule डाल दो ना chat box में नहीं है क्या? Vishal sir, schedule of the crash course. Where does anyone know the date for fixed income? 22. 22 Aditya. We're doing fixed income on 22nd. 20, sorry, 20. Tw- 22 is derivatives in AI, okay. Is that the last session? Do you think it's a good idea to do a feature phone now? We're discussing. Yeah, I'm strongly considering moving to a Nokia type of phone. That's a dumb phone. I think that's the smartphone. No? There's a phone what? It blocks. You don't have apps in that phone. I bought a tablet like that. I really love this. In fact, I don't know what it's called. It basically is a tablet which does not have apps. You can just write and read. Remarkable, remarkable. When I was buying it, I thought it was probably frivolous and I was just wasting money, which I do a lot of stupidly. But this one, I think I've used it quite a bit. I'll say it's probably the best money I've spent on a tech device for a long time. Yeah, it's like a Kindle device, but it also lets you write. So you can write and read just, and it doesn't have any apps. You can't even browse internet, I think, on that one. So makes it very easy. उसको blackboard बोलते हैं. सर एथिक्स भी कर लेते हैं. Exam on Feb, should we wait for your revision or start giving mocks? I gave 2 mocks, got an average of 75. No, you should write mocks, not for revision. Don't wait for crash course. Start writing mocks. Fit in these sessions between the 2 mocks. Again, how many FEB candidates here? इस बाकी सब तो टाइम पास करना है उधर. नहीं नहीं अच्छा. 1 2 3. Are you finding this useful or whatever we've done so far? Okay. All right. Good. Chalo. Someone is saying these sessions have increased my attention span. Nice. Good to know. It will definitely increase your endurance for sure. है ना, एक जगह पे आप you've been sitting here for how long? 7-8 hours. Ready? Excited? Had your break? Okay, great. All right, let's have fun with this. Simple linear regression. Just, you have two variables. I gave you a primer some time back, which is when I have two variables, A and B together, okay, then I can either do a covariance, or I do a correlation, or I do a regression. Covariance will just tell me the direction. Correlation will give me strength of what type of relationship? Linear. Now here we actually build that linear relationship. We extrapolate that linear relationship. Okay. In a very simple concept, for those of you who struggle with regression, it works a little bit like this. Let's assume this is X. Let's say X is Nifty. Okay, and let's take some really small cap stock. Which one should we take? Let's take Max India. Now, I've been sitting on this for, I don't know, close to 3-4 years. Lost quite a bit of money on this, still holding. Now, this stock is basically play on the retirement living theme in India. In India, we don't have a lot of retirement homes. These guys are building them, right, for senior folks. So, let's assume that Nifty goes up by 7%. Nifty has gone up by 7%. Now, Max India is a very small company. When Nifty goes up by 7%, do you think it will have some impact on Max India? Yes, right? So, let's assume that Max India went up by 24%. Okay. Can I say that by how much Max India is going up, that will have impact on Nifty? I'll give you an idea. Max India is like 1,000 crore company. In Nifty is made of 50 large companies in India. The smallest in Nifty is 100,000 crores. Okay. So Max India is like peanuts. It's probably how much Reliance Industry makes every day. The whole net worth of Max India. So you tell me, will Max India have any impact on Nifty? No. But can Nifty movement will have impact on Max India? Yes, because that's a sentiment, right? So in regression, it's very critical you determine which is your dependent variable and which is your independent variable. Here, Nifty happens to be your independent variable. Max India will be your dependent variable. Nifty will tell you what happens to Max India. Let's assume next day, Nifty has gone up by 2%. This will go up by, let's assume, 10%. Let's say next day, this has gone up by 5%. Let's say this has gone up by 19%. Then this has gone up by 10%. This has gone up by 34%. Okay. Again, we'll follow the same drill. We want to first calculate covariance to see whether the two numbers are positive or negative. Then we want to calculate a correlation. And then finally we want to build a regression. Okay, so I want you to put in these numbers. Don't use the percentage, just ignore the percentage. Just ignore the percentage. Plug in these numbers. What is the covariance? 25.25. Positive? What does it tell you? Positive. What does 25 tell you? Nothing. Doesn't matter. Second, correlation. How much is correlation? 0.99. So I made a mistake somewhere. Wait. 21, 6, 15, 19 चाहिए 25 चाहिए. Sorry, can you please go? My mistake. Now it's correct. Can you please go and make the first one 25? Okay. Correlation is 1. Now, when you see correlation of 1, it basically means everything is fitting on a perfect straight line. It's perfectly linear. Okay. Now, how do you get regression? Y is equal to A plus B x. What is the A here in your Texas calculator? Search for A, 4. Search for B, 3 into x is equal to y. 4 plus 3x. What is 4 called? Intercept. What is 3 called? Slope coefficient. Okay. Covariance will change. Now covariance is 25.5. Okay. Fair enough. Now let's see if this is working. 7 into 3 plus 4. How much? 25. 2 into 3 plus 4. 10. 5 into 3 plus 4. 19. And 10 into 3 plus 4 is 34. How accurate your regression is? Take correlation square. How much is that? 100%. Because everything is fitting perfectly on the line. And look at this. How they give you gradual incremental information. When I have regression, I can actually use it for prediction. For example, if tomorrow I know that or I feel that Nifty will give me 3%, can I figure out how much Max India will give me? How much? 3% into 3 plus 4. 3% into 3 plus 4. This equation, no? 4 plus 3x. ये समझा ना कैसे है? So 3% into 3 plus 4, how much? 13%. So I can now use it for prediction purposes. If I know Nifty, I can figure out returns on Max India. Is it okay? Now, in real world, of course, you will not find a data which has a correlation of 1. Correlation of 1 means when I take 1 square, कितना गया? 100%. Which means 100% behavior of Max India is explained by Nifty. Max India, how it goes up, how it goes down, everything is explained by Nifty. Right? Real life, it will not be the case. So think of a scenario where this number is not 34. This number is, let's say, 32. Okay, so let's go to your data function and make it 32. Just change the last y, make that as 32. Okay. Now figure out what's your correlation. 0.99. Take a square of 0.99. 0.99 again. So now I am 99% accurate, which means changes in Nifty can explain 99% behavior of Max India. So in matter? Now, when this will happen, you would notice that your A and B has also changed. Now it's giving you a different regression. But is 0.99 still good? Yes. Now what you do is, let's mess up this last one. Let's make it minus 10. Completely off the track. Our equation tells us it should be 34. Make it minus 10. Now figure out what is your R, new R. Huh? Minus 0.47. So it's become negative now. Negative 0.47. Take square of it. 22%. Now my regression is kind of not so good. Nifty can explain only 22% behavior of Max India. It was doing good till the third point. Suddenly in the fourth point, something strange happened. And in fact, correlation changed from positive to negative. When correlation changes from positive to negative, go and check your slope now. you'd notice that now your slope is also negative. Now it has become -2. The whole regression changed. Now it's not a great regression anymore. So obviously regression is not magic. If your data is linear, regression will do a job. And what honestly we're doing in real world scenario is, let's assume this is your data. Okay, all that you're trying to do is you're trying to fit in a straight line like this in your data. That's it. Now this straight line, the way you want to build a straight line is the distance between the actual data and the straight line. This is referred to as what? Error. What you want to do is you want to take square of those errors and you want to sum them up. And you want the total of squared summed errors to be lowest. Kam se kam. So I can maybe fit in a red line and I can also maybe fit in a blue line. Okay. For blue line also I can calculate the same. Which one should I select? Should I select red or blue? The one that has the lowest squared summed error. The line that produces the lowest error, squared summed, is the line that I'm going to select. Alright, let's get back to juice notes. Now, everything in regression is always about this. Okay, the whole regression is always about this. In our example, Nifty and Max India, who's the focus here? Max India. So think of that Max India as a kid and think of Nifty as parent. Okay, so okay, let's think of it this way. If you've ever been in a flight or in a train where there is one crying kid around you, kabhi experience kiya? Har baar hi hota na? And I get really unnerved, right? Especially if it's a long flight and there's a kid cranking with all its energy. Who to blame? Kid or the parents? Obviously it's bad parenting, right? Yes, it is. No, you don't agree? It is bad parenting. Because like you would want to train your kids, at least I believe that, right? You would want to train your kids to behave in a particular way in public places. No? Achha, how old as in 4 or 5 year old? Not babies, like 4 or 5 year old kid. Now, think in our example, Max India is that kid. And parents are Nifty. Everything is, in today's class, is about how volatile that kid's behavior is. Okay, which is y minus y bar square. Y minus y bar square. And how much of that random behavior of the kid can be explained by random behavior of the parent? How much of random behavior of that kid can be explained by random behavior? This time, just I think 10-15 days ago, I'll tell you what happened. There was this, I was at the airport and there was this kid, 5-6 year old. वो अपना कुछ तो भी पूरे एयरपोर्ट पे चिल्ला चिल्ला के इधर उधर with all at the top of his lungs was shouting and parents were pretty chill about it. So now that random behavior of kid explained by random behavior of parent. Okay, that's the main game. Now once you get hold of it, then I think you would be able to understand ANOVA table really well. So ANOVA table looks like this. ANOVA table looks like this. Okay, here we go. Okay. This total variation of the kid, which we call as y minus y bar square. Okay. This we call as total variation. Now, some part of the variation of y can be explained by x. Generally, what we do is we say y minus y bar square, let's assume it's 500. How much can x explain? Let's assume x explains 300. Y explains, sorry, x explains 300 and what is not explained, which we call as error, which is 200. So what percentage of y's behavior can be explained by x? Can you compute the percentage? 300 divided by 500. How much is that? 60%. This 60% is referred to as R square. R square stands for coefficient of determination. Okay. Now, how is R square calculated? Explained variation divided by total variation. So 300 divided by 500, or an alternate way to compute that R is correlation coefficient squared. So all this while we were calculating correlation, we were taking a square, we were actually calculating R square, coefficient of, bolo, coefficient of determination. Correlation coefficient ka square, correlation coefficient square is called coefficient of determination. It tells you, what does it tell you? The percentage variation of the kid or the y explained by percentage variation of the x, the parent. Okay? Assumptions of simple linear regression. Expect a question around this. So this is a 2-star for a theory question. First assumption, the data between x and y is linear because you're building a linear regression. These are very important assumptions. The second one is called homoscedastic, which means variance of the error term is constant. You want a homoscedastic error. That means variance of the error term is constant. What you don't want is heteroscedastic error, which is variance of error term is not constant. Now it sounds fancy, but you want to remember it a little bit like this. Let's assume this is your regression line. These are your errors. Okay, now suddenly if your errors become like this, then what has happened? What has happened is here the error variance was lower, but here the error variance is very, very high. So this is a problem. This we call as heteroscedasticity. Do you want this or you don't want this? You don't want this. This is an assumption violation. What do you want then? You want homoscedastic, which means variance of the error term should be constant. Then error term should be independent of each other. That means there should not be a correlation. Error term should be normally distributed. If you don't remember these assumptions, I'll recommend you to remember them. There's a chance you might see them on the exam. Alright, this is how your ANOVA table looks like, we just discussed. Explained error, total. Sum of square, degrees of freedom, mean square, F value. Let me just give you a nice example on this. Definitely a question around ANOVA, so you have to know this. So ANOVA becomes a 5-star. Let's assume we are building a regression. Nifty is going to try and forecast Max India. Okay, it's going to look a little bit like this. Explained error, total. First, we will have a degree of freedom. For explained, degree of freedom is K. For CFA level 1, it will always be 1. What is K? Number of independent variable. Since in level 1 syllabus, we have a simple linear regression. Just one independent variable, which means x side mein ek hi hoga. We will not have x1, x2. Error? N minus k minus 1. Total? N minus 1. Okay. Then, this is your total sum of square. Okay, let me put in some random numbers. Let's say 300, 200, and this is 500. Let's put in some number here also. This is 1. This should be, let's say, 61, and this will become how much then? So I'll have to assume this will become 62. इनका total होगा ये 1 plus 61, this will become 62. Now what we also calculate is mean sum. Okay, so mean sum of error. Mean sum. Even if you struggle with regression, I want you to remember this. How do you calculate mean sum? Very simple. Sum of square divided by degrees of freedom. 300 divided by 1. How much? 300. 200 divided by 61. How much? 3.27. So these are called mean sum of regression, mean sum of error. Mean है ना? So उसको बस n से divide करना है. Appropriate n. Once you have your two mean sums, then you compute something called as the F stat. Okay, I'll explain what that F stat is for. But F stat, which is calculated as 300 mean sum of regression divided by mean sum of error. So how much is that? 91.5. This is your core of ANOVA table. ठीक है, क्या क्या आएगा? सबसे पहले we'll have degrees of freedom, then we will have sum of square, mean sum of square, and then we will have F stat. Now, the job of mean sum of square primarily is to reach to the F stat. The job of F stat is to see whether the whole regression is working or not. So if you want to do a hypothesis testing on the entire regression, कि क्या मेरा regression काम कर रहा है नहीं, then the test that we do is called the F test. Okay. R square we've done, have we? R square means coefficient of determination. How is this calculated? Two formulas. One, correlation square, or explained divided by total. Alright. Hypothesis test. But now we are going to do hypothesis test on slope coefficient, which is beta. Look at this regression. Tell me what is the beta here? 1.2. Okay, beta is 1.2. Now, you've been asked to do a test of significance. Okay, a test of significance. That means what is your hypothesized value? 0. हमने किया है ना discuss. Whenever I want to do a test of significance, hypothesized value कितना होता है? 0, always. With correlation, test of significance, hypothesize is 0. With regression, hypothesize is 0. Now, you calculated 1.2. What is BOA saying? 0. You would say, okay, my slope is 0. Slope is not 0. What is the calculation? Slope minus hypothesized value divided by standard error. Same like mean. It's actually same like mean, this test. So 1.2 minus 0 divided by 0.25 is 4.76. Which table will you go to? T table. Degrees of freedom 23. Your calculated number outside the range. If it's outside the range, what's the conclusion? Reject. And reject means you go to BOA, you say you're wrong. That means slope coefficient is not equal to 0. That means it is statistically significant. That's it. That's your simple t-test. Okay. There's some technical theory bit that I'm going to skip. Now, next one is called dummy variable. Okay. Dummy variable, an alternate name is indicator variable. Now, how does dummy variable work? कौन सा example दे? Okay, maybe that's controversial. Let's do something else. Okay. Now, let's predict return on Venezuela market, which will be, let's say this year, minus 10% plus 20% multiplied with the dummy variable. Okay, dummy variable is is going to be, Donald Trump is going to be the president or not? If he becomes the president, or DT is not president, okay? Which scenario do you think Venezuelan markets will make more money? क्या आप बात कर रहे हो? Had that been the case, then they would have made money all these years, no? I don't know if you know the history of that country. They've gone through massive hyperinflation, and I've heard stories of people killing cats to feed themselves. Just khana hi nahi hai. Anyways, I mean, that's an exaggeration, but there are stories where you enter into a Venezuelan mall, like a grocery store. By the time you finish shopping, the rates of your vegetables have gone up 3 to 4 times because of inflation. So they used to have those rings like ghanta. So every time they'll ring a bell, that means prices have just gone up. So you'd be a smart guy if you go pick one item, pay for it, then go and shop other items. Because if you decide I will shop everything and pay, by that time rates have gone up 3-4 times. Anyways, let's get back to topic. Now, what are we doing here? We created a binary variable. Okay, it's a yes or no variable. We'll say what would be written on Venezuelan market if the scenario is no. If scenario is no, then -10 plus 20 into 0, kitna aega? -10. But what if the scenario is 1? Whatever scenario you've chosen, then it would be how much? -10 plus 20 into 1, it will become +10. This is called a dummy variable or indicator variable, where you have a binary variable as dependent or independent. Y side में, इस side में है ना? So, sorry, X side में है ना? So, binary variable is which variable? Independent variable. Binary variable is an independent variable. Is this making sense? Okay, good. Now, some small trick here. This is, I think, a very, very elegant question, might show up. If you are modeling, generally we use dummy variable to model something called as a seasonality also. Okay? So if you are modeling quarterly data, in a year, how many quarters? 4 quarters. So I will need how many dummy variables? I will need 3 dummy variables. I want you to remember this. You always need 1 less dummy variable. Okay? If you are modeling monthly data, how many months in a year? 11. 12 months in a year, 11 dummy variable. Make sure you don't miss out easy questions on them. Then the next one, it's called p-value. क्या है p-value? इतना कैसे रट्टा मार लिया आपने? अच्छा, जैमिंग से अटक गया क्लास में. ओके. लोवेस्ट level of significance at which null can be rejected. Okay. Now, how does it work? So when you have to do hypothesis testing, at times a standard p-value would be given to you. Let's assume p-value is given to you as 0.0325. Okay? And you've been asked to do a hypothesis test. Now, first thing I want you to remember is p-value is always given with an assumption that your significance level, your hypothesized value is 0. Okay? So if I were framing questions for you, what I'll do is I'll give you p-value in the question, but I will keep hypothesized value as non-zero. A lot of people who would look at p-value and come to a conclusion, they'll get it wrong. P-value can be used only when hypothesized value is 0. Okay, not otherwise. But let's assume p-value is given to you. And then the question says, please perform a hypothesis test at 5% level of significance. Okay? Tell me, this is p-value, you want to do 5% level of significance. What will you do? इतना तो रट्टा मारा अपने लोअर लेवल ऑफ, then you don't know how to use it. Reject. You will reject. How many of you will you think you should reject? That's correct. So, कौन सा एग्जाम्पल था? पुतिन वाला. ठीक है. So you think Putin, or think any P character in your life. I think it works better if you have some P character in your life. और कोई है क्या पुतिन का सब्स्टिट्यूट? बुआ को पुआ करना पड़ेगा अभी. पुतिन does not like tall people. Or taller is better actually. Putin does not like tall people. So Putin height here is 3.25. Okay. A 5% significance, that means higher than 3.25, reject. 4% significance, reject. Exactly 3.25 significance, reject. Same भी नहीं पसंद है. So then 3% significance, fail to reject. Fail to reject. So that's how you're going to memorize it. P-value is the lowest level of significance at which null can be rejected. So we compare P-value, we compare significance level. Okay. Then how do you do prediction? They'll give you a regression like this. They'll ask you to, this is your regression, and then they will say, you know what, x is equal to 3. How much is y? So you just plug it in, you find out y. Y is 16. Then, at times they will ask you to build a confidence interval on your forecast. Okay? So let's assume you have forecasted value to be, how much is the forecasted value? 16 in the previous example. What is a confidence interval? A plus, a minus. Standard error multiplied with the critical value, T table. Standard error is given to you, which is 3. Standard error is 3, so we'll take 3. Critical value 2.08, so let's round it off to 2. So your range becomes 6. All that you need to do is you need to add 6 to 16 and remove, so it becomes 10 and 22 approximately. That becomes your range. क्या किया हमने? We took the forecasted value in the middle, then we said plus minus a range. What is that range? Standard error multiplied with critical value. This is called a prediction interval. इसका मतलब क्या है? Even though I forecasted my value to be 16, but of course at the end of the day, I'm just working on a sample. Actual value can be between 10 and 22, and I can be 95% sure about that. That's called prediction interval. Okay, and this is a comprehensive example where we repeat everything, but of course we have done most of it, so I'm going to skip through this part. And finally, 3 types of models. A log-lin, nin-log, log-log. Okay? What is this? You have x value and you have y value. Now, if your dependent variable, dependent means what? Y. If y variable happens to follow a logarithmic form, that technically it means it's exponential. So one data is linear, one data is exponential. You convert, you make this a log-lin model. Okay? If your x variable follows a logarithmic form, then you convert this data, you create a lin-log model. And if both of these variables follow logarithmic form, you use a log-log model. This is what you need to know as far as exams is concerned. Log-lin, lin-log, and log-log. Let me ask you. Let's say if y is Non-linear, okay, it's exponential, x is linear. Which model will you use? Log, lin. If y is non-linear, x is non-linear, log. And if y is linear, x is non-linear, lin log. So you should be able to identify which model to use where. And done. Big data, you'll have to prepare yourself. But I'll add the juice notes of big data in the class notes so that whoever wants to revise, they can make use of it. Okay, done. When is the next session now? Day after tomorrow, 15. What topics? PMN? Economics. That's another long day. I think every session is going to be a long day. But I'm very proud of you. I'm extremely proud. You guys came in at 8. This is 11. How many hours is this? Acha, you came in at 2 and 11. Kitne? 8, 9 घंटे हो गए ना? No, 9 hours you're sitting straight. That's super impressive. Proud of you. You keep up the momentum if you do it. I think all of you deserve to get your CFA charters and you will someday. So thank you very much. क्या? क्या करना है? Someday, हाँ अभी तो दूर है भाई. अभी तो level 1 पढ़ रहे हो आप. Okay. Thank you very much. Good night. Bye bye. Ride safe on your way back. I hope you're wearing helmets. Huh? Match. Okay. Thank you, folks. Good night. कल तक भूल जाएंगे. जामिंग करना है अभी. Bye bye. हाँ, standard error of forecast you can skip. Yeah. We'll start with PM and then go to econ.